All right, welcome everybody. Doesn't that intro animation just get you hyped up for the conference? I know every single time I watch it, it does. And I'm super excited to once again be doing this year. It's crazy that this is already the 4th annual trading conference. And I think this one is going to be the best one yet. So thank you guys so much for tuning in. And welcome to the conference. Just want to say that one more time. We've got a great lineup of speakers for you guys over the course of the 4 different days. Again, we're holding this Saturday, this Sunday, next Saturday, and the Sunday after that one. We've got a great mix of market wizards, veteran voices, as well as new traders, new ideas. And I think you guys will get a ton of value out of this. So hopefully you guys are as excited as I am. And I'm very curious right now. Let us know down in the chat who you're most looking forward to learning from. Which speaker are you most excited to listen to? Be curious to see your guys' results. Again, I think every single one of the speakers this year is fantastic. It's a great group of presenters, and also kind of a wide variety of different styles, systems, as well as topics. We'll be discussing everything from trading psychology to trading setups, journaling, mindset. All of that will be covered, and this is the perfect place to improve your trading and accelerate your learning curve. So kudos for you for showing up, and thank you so much for being here. Here's just a small sample. There's literally too many speakers to fit on one slide. We've got Stan Weinstein, Linda Raschke, Dr. Brett Steenbarger, Ross Haber, Mark Minervini. I know many of you guys are excited to learn from him. Mark Ritchie II, Amit Rai, Oliver Kell, Marius Stamatoudis. And again, this is just a small sample. I literally couldn't fit all the presenters on one slide. We've got near 30, and I'm sure you guys are looking forward to many of them. So again, let us know in the chat who you are most looking forward to. And with that, let's keep on moving. So next up, we work very hard every year to put this thing together. Hopefully you guys have enjoyed the previous years. It'd be great to hear if this is kind of your 2nd or 3rd time attending. That'd be awesome to hear in the chat. But in exchange for us putting this together and all the speakers taking their time out of their days to present, we do have one ask for you, and that is to help spread the word about this free resource on Twitter. So we've got a link that we're putting in the chat right now. It's also located in the description that allows you to basically tweet out the stream, tweet out the conference, and we'd be super glad and grateful if you would do that. Help us spread the word. Help us, achieve our goal of helping spread solid trading education and risk management principles. We really appreciate it, and thank you so much for everybody who has tweeted it out. Again, the link is down below in the description, as well as down below in the chat. With that, let's dive right into the day 1 schedule. Again, we're super excited for the lineup this year. Starting things off is Marius Stamatoudis discussing the 2 layers for building trading mastery. Going to be an excellent presentation, I'm sure. Moving on, we've got Marsten Parker, Market Wizard, and he'll be giving a survey of systematic trading strategies. Then we've got Dr. Steenbarger turning more towards trading psychology, discussing turning personal strengths into trading strengths. Definitely going to be a fantastic presentation. Then we've got a quick break for lunch. And then moving forward, we've got Pradeep Bonde, who I'm very excited to hear from, and I'm sure many of you guys are as well, discussing swing trading catalysts and momentum bursts, his bread and butter. It's going to be a fantastic presentation. And then next up, we've got John Burns of the Rethink Group discussing how to tap into your intuition, turning your mental game into a trading edge. Really looking forward to that one. We've got Roy and Wes Mattox discussing tracking market trends and market environments. Definitely an essential part of trading. And then finally, to wrap things up strongly, we've got John Pocorobba discussing building confidence, trading earnings gaps. Definitely a very useful setup to learn. So we've got, as I mentioned, a great breadth of topics here, everything from trading psychology to setups to mindset. And hopefully you guys will, get a bunch of great golden nuggets away from today's session. And again, we'll be right back tomorrow for the next group of excellent speakers, but I'll have that schedule. I'll discuss that at the very end of today, who's presenting tomorrow. Moving on, I put this slide in because I'm sure I'll be answering this question a few times today. Will today be recorded? Yes, it will, and it'll actually be available right at this URL. I believe even right now, you can scroll back in time and rewatch different parts. If you want to listen to me give my spiel again, you can go ahead and do so. But the recording is located right here, And for each of the presentations over the course of the next few months, we'll be uploading them so each of them can get their own time in the limelight that they deserve individually. So yes, it is recorded, and you can rewatch it right at this URL. And I do ask, if anybody asks in the chat, please kindly answer them and say yes, it is being recorded. And please do be kind, but please let them know to make sure that they're aware of that. All right, so how to get the most out of the experience? Well, there's definitely a few ways. First, I would ask that you would subscribe to the TraderLion channel if you're not already. We're getting pretty close to 100,000 subscribers, and it'd be great if you could help us get to that goal. Not only do we put on this conference every year, but we also have regular podcasts with market wizards, top traders. Just next week, we'll be posting one with the current leader in the U.S. Investing Championship, discussing his strategies, going through his trades, and we really work hard to be the place to go for quality trading information where you can learn how to improve your performance and your mindset and learn solid risk-based strategies. So definitely go ahead and check us out. We've got tutorials, webinars, many other resources. Definitely go ahead and subscribe and check out those resources if you haven't already. Also, this is something I really want to highlight. In addition to this conference this year, we have a special VIP, which is 100% free. That's available via the QR code on this slide right here. You can scan that with your phone and sign up right there. And you can just go to the conference page and sign up for the VIP there. And basically what this gets you is access to the slides, a spot where you can take notes, as well as request questions from the different presenters. So there's a lot of benefits there. We'll also be doing some special giveaways for VIPs only, such as signed books from Mark Minervini, a few other speakers. So you definitely want to go ahead and do that. Sign up for the VIP via the QR code. Again, it's 100% free, and it'll help you kind of get the most out of this conference, which is the end goal, of course. So definitely go ahead and do that. Also, I highly recommend engaging in the chat with other viewers as well as the speakers. Definitely, stay in tune. If you need to take a break, go ahead and do so, but come back, stay focused, take notes if you can. You can always rewatch this if you want to take more diligent notes. So just go ahead and be as active and engaged as possible. Also on Twitter, I'd love to see people sharing notes, key takeaways. If you tag me, if you tag TraderLion, we'll go ahead and retweet those, help spread the word. But it's always cool seeing people's takeaways and notes from these great presentations. Also, as I mentioned, you can go ahead and rewatch your favorite presentations. Even that day, you can scroll back in time. So don't feel like you're missing anything. If you need to get a quick bathroom break or drink of water, you can always rewatch things as well as rewatch them in the coming weeks. So definitely go ahead and do that. But yeah, I just want to once again emphasize, definitely go ahead and join the VIP through this QR code. It gives you access to kind of the full breadth of this conference, and all the education that we can provide is through there. So definitely go ahead and do that. Also, in addition to the VIP access for this conference, we also have many other free resources available on TraderLion University that once you're signed up for that free account, you have access to. So this includes model books going back to 2019, the Price Cycle Mastery resource, which is Oliver Kell teaching you his price cycle. Excellent resource that you can really learn a lot from. This has kind of taught me so much, learning his price cycle in terms of how to interpret charts more effectively, find those buy points. So highly recommend that. Also, we're setting up kind of past annual trading conference resources, which again will have more information, the slides, everything in one place that you need. We've also got and are building TraderLion podcast resources, so kind of show notes. So definitely check that out. And finally, we've got the Ultimate Trading Guide Lite version, which is basically turning the Ultimate Trading Guide that many of you guys downloaded last year and a resource that many of you guys love into kind of a complete course that's 100% free. That's a fantastic place to learn, as well as, let your friends know about if they're interested in learning trading and mastering the fundamentals. So definitely check that out. And all this is available for free on TraderLion University. You can scan this QR code and you're brought right to the registration point. And then you can go ahead over to available courses, and all these will be available to select right away. So again, definitely check this out. Just scan the QR code and it should be available right there for you. Then finally, if you're ready to move on from the excellent free resources that we have, my next recommendation would be to check out TraderLion University, which houses all of our master classes. We'll soon have multiple TL webinars as well. Hint, hint, we've got a few great announcements and exciting projects coming up, but these 5 masterclasses are fantastic. This is kind of like your graduate school, degree here. We've got the best educators, Stan Weinstein, market legend, Oliver Kell, U.S. investing champion. He'll be presenting later on just tomorrow. Then we've got the excellent lifecycle trade team discussing IPOs and super growth stocks, how to find them early and when to buy them and when to sell them. Then we've got a trading psychology masterclass from the Jared Tendler. This class can complement any trading style and help you master your trading psychology and identify, your strengths and weaknesses. Excellent resource. And then finally, we've got the historical analysis masterclass with the market guide, John Boyk, who is the perfect person to guide you through the history of market cycles, leading stocks, as well as market wizards from the past to really learn the blueprint for market success. The same patterns repeat over and over again. He goes through every market cycle going back to the early 1900s, how market wizards traded them, what stocks they traded, when they bought, when they sold. It's really a one-of-a-kind resource that is a fantastic foundational course. So definitely check this out. And to do that, to check any of these classes out, go to TraderLion University at TraderLion.com, and you can find these right there. Highly recommend them. The Swing Trader Masterclass is a great spot to start if you're just looking to choose one and aren't quite sure where to turn first. But with that, I do also want to thank our sponsors for helping us spread word about the event, both DeepView and StockTwits. They've been instrumental in bringing this together. If you're not familiar with DeepView, this is the same group behind TraderLion is behind DeepView as well. We're developing the go-to platform and trading tool for screening, charting, watchlist management, alerts, heat maps, breadth analysis, and soon to be much more. So definitely check this out if you haven't yet. We've got a special offer, 2 months for $39. And our goal, as always, is to create our ideal trading platform, and we're well on our way to do that. And if you tried DeepView before, go ahead and check out the new features that we've added. There's so many to talk about. And a big strength of ours is our ability to listen to our customers, innovate, bring new features regularly. So if you're on a legacy platform that isn't really investing back into the platform and hasn't released many new features, this is the perfect time to check us out. And I think you'll be really impressed. So definitely check out DeepView. We work incredibly hard every single day to make the platform better, 1% better every single week. So definitely check us out at deepview.com. With that said, this is something that I definitely want to highlight as well. It's great that we can put up this conference every year, and in addition, do it for a great cause at the same time. So once again, we're providing a fundraiser for St. Jude Children's Research Hospital. I think a cause that every single person can get behind. To donate, all you have to do is go right under the chat, and there is a donate button right there for you. It's just a few steps. I actually donated yesterday. I kicked things off, and our goal is $20,000. It would be amazing if we could surpass that. And so my ask to you is, if you find any value in this conference, which you 100% will, please go ahead and donate at least $1. That's all we ask. Again, this is available completely for free. So if you want to thank us, if you want to thank the speakers, this is the way to go ahead and do that. So go ahead and donate now if possible. It'd be great to have a bunch of donations all throughout. It's a great way to pay it forward as well. Get some goodwill from the market gods as well. So definitely go ahead and do that. If you can do $1, that's great. If you can do $5, that's fantastic. $10, $20, you're the man. I'll give you a fist bump on Twitter. If you donate, send a screenshot, I'll give you a fist bump. And I'll thank you personally if you go ahead and do that. So thank you guys so much in advance. Again, this is a great cause I think everybody can get behind, no matter what your politics are. So thank you guys so much. And hopefully we can, surpass well over $20,000 this year. Also, just one last time, I do want to mention to please subscribe to the TraderLion channel. Again, we've got the TraderLion podcast, tutorials, free webinars, key clips. This is the best place to go to for trading education. So if you're not subscribed already, definitely go ahead and do that right now, 100% free, and help us reach 100,000 subscribers. If we can do that this weekend, that would be awesome. But that's a lofty goal, but let's go ahead and hit it. So please go ahead and subscribe if you haven't already. And with that, my spiel is over. Thank you guys all for your attention. I know you guys are excited to get going with the presentation, so I won't hold back any longer. Thank you so much for tuning in today. I really look forward to all the presentations and looking forward to your feedback as well. So thank you guys all for tuning in. Leave a like down below on the video right now if you're excited, and we'll be right back with Marius. So stay tuned. Take care. All right, welcome everybody to the 2024 TraderLion conference. Super excited you guys are all here, and we're kicking things off with a bang. Really excited for this presentation and to have Marius Stamatoudis to kick things off. Really excited to have him here in particular. Marius is a momentum trader. He's a top performer in the 2023 U.S. Investing Championship with a return of 291% in 12 months. We previously recorded a podcast this year where Marius discussed his trading journey, full process, how he learned to trade. And this podcast has had a tremendous impact on viewers. And I'm really excited to kick off the conference with Marius and his presentation on unlocking the second layer of trading. So Marius, thank you so much for being here. Everybody in the chat, please welcome Marius and leave a like down below. Subscribe if you're excited for the conference. And Marius, thanks so much for being a part of this. Really excited.
Hello, Richard. Hello, everyone in the chat. It's a pleasure to be here. As you said, Richard, it hasn't been long since my last interview on TraderLion, but this conference is circled around a really good cause as well. So I'm really happy to participate. All right, so guys, I have prepared a presentation today because I'm known for my long interviews, so this should be short. And yeah, the core topic of it is layer 1 and layer 2 of trading. So basically, we're going to discuss about setups, rules, but most importantly, getting into the layer 2, which is about changing the perspective, going beyond, and achieving great performance. So basically, I will try to give as much condensed information as I can about how I approach the market, setups and rules I use, but make sure to stay through this presentation until the very end, because in the last maybe half of it or even more, I'll be discussing things that are sometimes overlooked, and these things are beyond setups and strategies, but are so important and key to help you increase your performance and see the markets from a different point of view. And it's, as I told you, it's all about shifting the perspective of knowledge you already have in the markets to make you think and find new things that can dramatically help you. So if it's good, Richard, should I start from my backstory?
Let's dive right in.
Yeah, so many of you guys might be familiar with it, so I'll give the short version for the ones who are not. So as Richard said, I categorize myself as a momentum swing trader that tries to position himself into places that asymmetric opportunities exist, with high focus on hot trends and hot themes when they emerge. So I started the trading back in 2015 during my first year at the university, and I was definitely not good at this game for the first 2 years, as I had a completely backward progress. So I got really serious about it in 2017 when I started researching deeper into the markets and started connecting the dots. And I started to reverse engineer other traders' processes and methods. So that was a key change for me. And I did quite good after the 2018 up until 2020. where I started shifting more into swing trading. And that shift happened for many reasons that I had previously stated in an interview here. But one of them is that I did not like the volatility my equity curve had, and I also did not like the environment that I had created for me around trading, both in life and both in my process. So yeah, after 2020, I made the decision to start being more of a good risk manager rather than a chart reader specialist. Something that I still follow today. And yeah, after focusing on these things, I started discovering myself more and more, and I finally felt that there is a scalability and there's sustainability on what I do and my performance. So yeah, in 2023, I decided to join the US Investing Championship and ended up running as a top performer. And after the competition ended and 2024, I started, working with a team of developers to make my studies in the markets and my approach much more efficient. I have also found out that being on Twitter and interacting with so many people every day without expecting anything in return as well is a job by itself, but I'm still enjoying every moment of it, and I'm grateful for that. And yeah, lastly, I'm working on research projects with some experts on quantitative finance, with a focus on trading concepts, and we're writing some research papers around that as well. So yeah, that's about it. Now, getting into the presentation, as I said, the topic today is the two layers for building trading mastery. So you might wonder what these two layers are. Well, this is a term that I use to describe the different levels in a trader's journey. And these are two layers you need to understand and unlock to achieve a sustainably good performance year over year in the markets. So think of the first layer as your bachelor's degree in the markets. That layer is about acquiring knowledge, putting things in order, learn your setups, have a clear process, clear rules, clear risk management. Basically, having a solid and robust foundation about trading. Now, the second layer is like a PhD degree. It's about using the knowledge that you already have in the markets and mixing and experimenting and stretching it until something profound happens. So you can think of it like cooking, right? You take 6 ingredients, you make something tasty, but if you give the same ones to a well-known chef, he can make a remarkable something remarkable out of them. So this is what the layer two is about: making deep, multi-level connections on your existing knowledge, changing your perspective, and uncovering hidden nuances from existing things. And not many people talk about this, and not many people as traders open the door to the second layer because it's hard to do. And secondly, you don't even know that this layer exists when you're starting out. So you're kind of stuck to setups, to basic risk management and strategies. Well, the best performance does not root solely from setups and rules and strategies, but it roots from sneaking into that second layer and exploiting things that very few people think about. And we're going to talk about all that. So uh, let's start with the first layer to set the ground, because I guess not everyone here would be aware of how I approach the market. So as said, the first layer includes the setup, the general methodology, my risk management principles, and what I wanna see basically in stocks I buy and all that stuff. And then we will touch base on some key areas of layer two. So to start this off, um, here are some principles that can help you unlock the first layer, which is equally important, guys. Okay, like without unlocking this first layer, you can't go beyond. So some of them are technical and some of them are not, but all are important. So the first thing is really important, and it is that you need to find a passion for trading beyond just opening and closing trades. And what I mean here is that the market will make you feel stupid many times. There are going to be moments where you're going to feel helpless. There are going to be moments that you will want to quit. And it happened to me many, many, many times. So you need to have a deep passion to keep going because it's not easy. And when you're starting out, you'll almost certainly get into trouble. Of course, you can avoid some of it by learning from good resources. And you guys that are here with us right now, and I'm speaking mostly about newer traders, you have already done a good job in that aspect by being here. But you still face challenges. We all face challenges. They never stop. They just become less frequent. So this is your tuition fee. So a really strong passion about what you do is needed. And for me, the passion came from studying other traders and diving deep into the stock market history and seeing the whole thing as a complex puzzle that I need to solve. And for some weird reason, I was born with that researcher's bug in me, so that really helps in this field because this kept me going through tough times. Even if I was feeling heartbroken, even if I was feeling helpless, I still like to explore. I still like to do research to find new things and combine the dots. So this helped me overcome a lot of torture. The second thing is not again technical, but yeah, you should pay attention to that as well. And it is to maintain a positive mindset along your journey. That should be accompanied with a stance to be objective about all the things you hear and see. And you should focus on what is happening now in price, not on stories or the sentiment around you. And Richard, we have a phrase in Greece that goes, um, από αυτά που ακούς μη πιστεύεις τίποτα και από αυτά που βλέπεις να πιστεύεις τα μισά, which means from what you hear around you, believe none of it, and from what you actually see, believe half of it. And that's a great phrase, right? Because in trading, you should focus on what you actually see and not what you hear around you. So you have to have that filter that everything goes by to lead to better conclusions, right? So if we go back to extreme panic around the markets, these periods like 2020, which was the pandemic, these conditions provided some of the best opportunities, even when the sentiment was negative, right? So in 2020, you had the lockdowns, you have the panic, but if you watch the price and if you watch the underlying stocks, if you absorb the sentiment around you, you might have missed some great opportunities. And the same goes with some situations of big euphoria like 2000, right? So the nature of humans doesn't change. So my advice is to forget about the macro things and try to see what is happening now. Because literally, guys, no one knows how the world will look in 10 years. Like, no one knows how the world will look in 2 years. Because surprise event happens. And not even the CEOs of the most high-end companies know. They might have some clues, but they don't know the full chain of events, right? Because there's always a disruption. There's always something new. There's always a surprise. And I think that's the key reason for us, that chose to be traders, because it's easier to take advantage of something that is happening 2 steps ahead rather than 15 or 20 steps ahead, right? And the third thing is finding people with great accomplishments and to study their methods extensively. So you don't need to reinvent the wheel. Advancements in trading and the general knowledge is like science. It gets better, it gets more broad, it gets more easy to find over time. So you don't need to find everything on your own. When I was day trading, I studied intensively day traders. When I transitioned into swing, I studied extensively successful swing traders. You kind of skip a lot of trouble by learning from their experience and methodologies. And the key thing here is lending parts from other people's, works and process and adjust them to fit your style and personality, all right? The fourth thing is to develop a foundation of setups that have worked historically for many decades and are still, relevant and evident. And what I mean by that is that you can't trade randomly. You need to understand why certain setups appear and verify their occurrence over past data. For example, the classic breakout formations and that we use appear for hundreds of years in the markets. If you go and look at the commodity markets, I don't know, 2 centuries ago, or even the stock market 30, 40, 20 years ago, these formations appear again and again because this is how supply and demand is expressed, right? So yeah, we'll discuss about specific setups, but the point here is you shouldn't search for setups that occur one time every 2 months but also not search for setups that occur 100 times every day. There needs to be a balance within occurrence and evidence and TEDs in past data. All right. So the other thing is you need to develop and fine tune your entry position sizing and selling tactics, and this is crucial. To execute your setups correctly, you should develop rules about position sizing to manage your risk effectively and create a system for selling that rewards you for the market's randomness. For example, and we'll get on this later, I sell parts into strength and I leave most of my shares to trail the weakness because I want to put myself in a place of asymmetry. And I also want to have the market's randomness as an ally, not an enemy. And this is how you keep your interest in the market as well, besides making money, of course, because you never know exactly how powerful something might be. And this occasional asymmetry that happens is so much self rewarding, both in psychology and in money making and in excitement as well. And the last thing is, you should create a really robust routine and process to track the best momentum leaders day in and day out, because setups themselves are nothing. Uh, it's the vehicles you choose plus the setups that make the difference. So as I have said many times, trading is like a sport. If you go into a match and you haven't trained properly, you haven't studied, you're gonna feel anxious. You will be more vulnerable emotionally. So the same applies with trading. You need to have a robust routine and process to track the best momentum leaders, know what's moving, what's not, to do your homework, because that is how you feel confident and that's how you feel professional, and you don't get the bad side effects of it. So yeah, hopefully this is kind of some introduction. So now let's get into the setup I use. Um, all right. So the first setup I use is breakouts. As I said before, if you look at decades of stock data and specifically the best performing stocks of all these years, you will see some commonalities. So stocks tend to move, with legs up followed by tightness, then new legs up followed by tightness. And I'm talking for the best stocks out there, right? So what I'm tracking is to be close to the moment the stock moves from this tight range with the probability of continuing up. So the key here is I don't take breakouts randomly. I'm tracking breakouts on the momentum leaders that are showing relative strength, that print big volume, that get tighter into the right side. And I also employ some moving averages like the 10 and 20. And I'm trying to track where this supply zone is, because this is the zone that the stock needs to surpass from moving into higher ground. So I put an alert above the zone when price is forming, and I try to take the trades on the breakout day. So getting into more details, as you can see, these are the things I look before taking breakouts. So as I said, I focus on momentum leaders, and momentum leaders are a small fraction of the overall universe. So you need to have tools and track those, because these are the stocks that are supercharged and blessed by the current market, right? These stocks can be commodity names as well, like steel, like copper, like gold, right? It depends on the market cycles and events. The second thing is, stocks that show relative strength compared to the index, especially in the bear trends of the market. And this is something that separates us momentum traders from other participants in the markets, because we don't look at the markets as discount stores like many people see them. A stock drops 50% and many people go buy it because it's cheap. Like we don't see the stock markets as a discount store, and I think it's a good thing we don't see it that way, because the best vehicles out there are going to seem more expensive. The same thing that you can't buy an Aston Martin in the price of a Toyota or a Nissan. The best stocks that are meant for power, that are meant for speed, most of the time are going to look expensive. And the reason I say, especially in bear trends or bear markets, is because you can easily spot these stocks that are picking up in price compared to the index in bearish conditions. Uh, and when we have a corrective market, some of these stocks that are showing extreme strength possibly are going to be the next leaders in the upcoming cycles, and this is where you should be. The third thing is tightness and development with higher lows. So I don't need to, explain this fully. Tightness is an expression of supply and demand, right? And you need to be patient so that the liquidity when the setup gets tight kind of drains. And also higher lows are evident because if higher lows are evident, this shows signs that demand is still there visually. The other thing is volume picking up compared to the past. So we don't move the markets, right? Funds and institutions move it. So a big volume footprint can give you clues about what these other major participants do, right? Thus making the probability of the outcome more, better. The other thing is volume slowing down during tightness. And this has to do again with the point three, right? So when you see the volume kind of drying on the tightness compared to the prior move, it kind of tells you that indeed the liquidity is getting kind of drained, and maybe the supply zone can be surpassed uh, more efficiently, right? The other thing, as I told you, is that I track the 10 moving average and 20 moving average. So the reason that I use this is because they kind of smooth out the trend, right? It makes things more evident in your eyes. And I use the 10 moving average and the 20 moving average, kind of picture them as rails, right? That I wanna wait the stock to catch before moving higher. Um, yeah, the other thing is the average daily range, the ADR, which I want to be above 2.5 or preferably more than 3.5. So I think many of you guys are aware about what that is, right? Is how much a stock moves in a percentage on average every day. So this is a good categorization of stocks that are fast and slow, right? Stocks that are fast are gonna show, bigger percentages of ADR, and stocks that are slower are gonna have smaller percentages. So, yeah, I always want to have a portfolio with names that are kind of, average to fast, because this gives a better chance of faster compounding. But this depends also on other, periods, because there are periods where speculation names are not being held, and the slower names are the leading names that move the market. And we had this, this recently. This is what we have recently, right? So yeah, I'm focused more on the medium or to faster names, but I might get to slower ones if I see, the environment not to be fertile. Um, all right. So the other criteria that I mentioned as bonus are not strict for me, right? So I use them, as bonuses to determine a textbook or powerful setup. So the more of this I have, the more textbook the setup I have, right? So the first thing is if the stock is being held by by an emerging theme. So this is important because when you have stocks that are supported with current trends and fulfill the previous criteria, you gain more conviction. So, for example, we had the artificial intelligence stocks as an emerging theme, a trend, a lot of time right now, right? So, if a stock is within that industry, it gets a little bit more fuel. Um, yeah, the other thing is the acceleration of earnings. So, as you see, this is one of the main differences of mine from maybe some other swing traders, because I count acceleration of fundamental metrics as a bonus, not a strict criteria. So the reason for this is when I did research in the markets, I saw that many stocks moved 200, 300, 500, and even more based on just hype, based on great stories, without having extreme fundamental numbers, or sometimes no numbers at all. Like uh, there are a ton of examples. Like a few weeks ago, I took this ACB trade right here. Right, this stock has no uh, earnings and sales. It hasn't have any extreme fundamental numbers, but it provided good returns, right? So I've seen that many times in the past. So that's why I use kind of this, the acceleration of as a bonus, not as a strict criteria. Um, The other is acceleration of sales. So sales are even more important than earnings. And the reason for this is because, earnings per share can be manipulated, but sales cannot. So, for example, a company can fire employees, can cut expenses, and show really big earnings per share. But if the sales are the same or have dropped a little, you know, this might show up in a future. So, if a company does not drive sales, then the growth will stop at some point, and because you can't cut costs indefinitely, right? So sales is much more important because it can't be manipulated. The other thing is, triple digit returns. So of course, when you see, you know, a company announce triple digit returns, it's awesome because it shows that the company has doubled or even more within a year, which is a great milestone, right? It's a remarkable feat by itself. So yeah, it's a great bonus. The other thing is big analyst estimates for the next years, and the last one is um, linearity of past price actions. So this is something else I look as a bonus. The more clean the chart looks on the left side in the previous months, and if it's not extremely choppy, the better chance you have not to get as frequent fake outs again and again in breakouts, right? So I use different variations of the setup. Sometimes it's on leading names, as I told you, and sometimes it's on beaten down names that can create a new theme, a new emerging theme. Um, so I kind of have, NVIDIA, as an example. So as you can see, NVIDIA basically had all the criteria in check, right? It was a momentum leader. It showed extreme relative strength compared to the index. It started getting tighter and tighter. The volume was picking up, prior to the move, and it slightly was getting slower during the tightness. The 10 and 20 moving average on the right side started catching up, and there were other rails, to the price action. The ADR was above 2.5, right? And we had all the bonuses as well. The stock was being held by, an emerging theme. We had the AI. There was a huge acceleration of earnings and sales, as you see on this table right here. This is the true essence of acceleration, right? You get, triple digit results, even better. You also got great guidance from the company. You had crazy estimates for the next years, and you had also linearity of the past price action. So you can't get more textbook than this, right? So this is a textbook setup, and this is something key. Like, you have to compile and stack up these bonuses and all these criteria together, and once you have, the full list of them, then you have, a textbook setup. This is what I do. Um, so Richard, let me know if you have any questions so far,
No, I
and
think
I'll
I'm
move
good
to
on
the
my
second
side.
setup.
Yeah,
All
let's dive
right.
in.
So uh, yeah, the second setup is the catalyst gapper. So this is a setup I really like because it can't have easily an edge erosion. So on this specific setup right here, even if all the people around the world learn to do this, it won't matter because it's based on surprise events. And surprise means something unexpected, means big volume, means a lot of participation, means, emotions being amplified and in a bigger scale. It means stronger greed or fear. So you kind of have to have a stock that might be moving kind of sloppy or sideways or even slightly up, and then you get, a big gap up. And these gap ups happen because of a catalyst, or to say it more simply, because, of important news regarding the company itself or the sector or the industry, right? So there are many reasons why stocks gap up. It can be, a new policy by the government. It can be an acquisition. It can be an analyst upgrade. If it's a biotech, it can be, FDA approval or clinic trials. So yeah, it can be an announcement of a new product, but mostly it happens because of earnings, right? Every quarter. So as I said, the reason I like the setup is because surprises get everyone off guard, and that's the meaning of surprise. No one can see it coming, or a few can see it coming, right? And that's important for the following reason, because as I said, most of the market participants, either individuals or in the form of funds, are not exactly trading but investing. So classic investors or funds base their decisions on price action and not not on price action but on valuation models, right? They track many fundamental metrics like cash flow, EBITDA. They do discounted cash flow models, and when a big surprise happens, these models change overnight. If there's a big difference in than the consensus estimate, these changes create a dramatic change of these valuation models overnight. So even if the stock, was considered overpriced yesterday, it might be undervalued on the next day based on these models, right? Uh, yeah, so this creates a lot of competition. This creates, amplifies the emotions of greed and fear, and creates, a combo of massive participation. So I really like this setup because it has some underlying, deeper fundamental factors in it, and I really like it. So the things I do is, I track, um, the catalyst. So most of the times it's an earning announcement, and I have seen that, the best performing catalyst gappers are due to earnings. I want to see stocks that gap up more than 5 or 6%, right? I want to see big pre-market volume, and this is important because it's showing indeed that there is a participation. I want to see big earnings surprise, like unexpected beat of the consensus estimate, right? And the bonus things that I'm looking at is I want to see a neglect of a long period. So this is important because it gives you clues that indeed this event was a surprise, and there was not a big rumor or insider knowledge of some sort of this. Uh, the other thing is guide and raise, right? So this is equally important because uh, it's how the companies themselves view the upcoming announcements. So if you have a company being positive for future growth, this ensures more fuel into the action. Sorry, and yeah, the other thing is, if it's an emerging theme, if you have a stock that is held by trends and the sentiment, even better. The other thing is if the stock is gapping up above a multi-month or a multi-week range, tightness range, right? So this is kind of the similar concept like the neglect that I said, but it can be smaller. Like if the setup is getting tight, right, and it's not choppy and all around the price, I might, a multi-week period might be fine for me. If it's just choppy or sideways, I might say, I want 3 months, the gap to clear 3 months or something. Yeah, another thing is big estimate for the next years, and this is something that I really look at this setup because I want to see the analysts give big estimates for the next year. And the other bonus is, if the announcement is about triple digit earnings and sales, like we said before, right? Um, and last but not least is, the earlier the bull cycle, the better. I might get more conservative on later on the bull cycle on these setups. So I really, really try to be early on this. I don't want to have a stock that moves up, I don't know, for 1.5 year and then gap up, because sometimes you will see that when this happened, this is sometimes an exhaustion gap or the exhaustion is near. So I really want to be early. So this is, you can see the acceleration again on this stock right here. So again, this stock fulfills all the previous criteria, and something important that I want you to look is what I said about the big analyst estimates for the next years. So if you look at this stock, it had 0.7, 0.07 and 0.18 on 2021 and 2022, right? And then it moved to 1 and then moved to 2.93. This is, a breakout in the fundamental numbers. Like this is huge. And this drives really a big fuel into this stock. So I really look at this, and of course you can see the earnings and sales acceleration on the right side. So yeah, that's about it. So uh, you know we have covered a lot of examples in our interview. So, everyone can go and see, these examples and how I do these things, or many setups, many different variations of things that I do, right? So I don't know. I can talk about, how I find these setups kind of my process or routine, or I can go, to my basic risk management principles, whatever you prefer, Richard.
Yeah, I think just because we covered so much in that first interview, we'll link that down below and in the chat now. Let's keep moving on and focus on risk since that's so important. Um,
Okay.
yeah,
So I won't get guys into the full process of my weekly and daily process. Of course, you can go and look it up. I will just tell you about my how my screen looks for the people that are new. So as you can see here, it's simple, right? I use the moving averages, the 10 and 20. Like I told you, I track when the next earnings are. I use the ADR and the ATR, right? I kind of put the news of the chart because I want to know the story when I open the chart, right? I want to be able to see, right, how the the story escalated through time, and I also put a small summary right here because I want to know some underlying things about the company. Maybe if it's in a good theme, or maybe it's making something remarkable. So I can link the news with the summary to have better clues. And yeah, I also look at the volume, and I also put the dollar volume. And the reason I have the dollar volume is because sometimes stocks split, right? So you might get big volume, but the money moved might not be as equal to that, right? So having both can help you understand if, or even if you have dollar volume, preferably you can see actually if a big money is moved, right? Okay, so these are the basic principles for my risk management, right? So I calculate shares based on entry minus stop loss distance. I'm not using a universal percentage stop, right? So this method that I use basically auto adjusts for positions for volatility, right? So I'm gonna get smaller positions on faster moving names and bigger positions on slower moving names. I'm limiting my positions to 25 max of my entire portfolio, right? And a smaller percentage for biotech. The other thing is I risk around 0.2 and 0.3% of my account, right? And I use progressive exposure to get into positions when I'm back in cash. And the other thing is I kind of rarely use margin. I use it, but I have a lot of criteria that I need to check before it's optimal for me to get into margin. So as I told you in the start, my job is to be the best risk manager that I can do, that I can be, not just a trader, right? So my win rate is around 25 to 35%, depending on the period. I always look for more than 4 to 5 hour moves, and on big wins I could get like 30, 40, 60 hour multiples. So that's the asymmetry that I'm talking about, right? um, yeah, so the basic principles of my entries are, when the price moves above an alert, or based on anticipation on the 5 minute, I might enter on a trade on breakouts. I put my stop loss on the low of the breakout day most of the times, and my stop loss distance, I want it to be preferably below 1 ATR. So that even better if it's below zero point 0.5 ATR, because I'm always looking for tight entries, and I will explain that once we get into second layer and the importance of it. But yeah, this method ensures tightness, and I don't enter on a stock when, if I don't have a position already a week or a few days before the earnings announcement. So on the catalyst gappers, I enter on the first day uh, based on an OR, yeah, on the 1 or the 5 minute chart, opening range breakout, right? And if the low is violated, or the day is violated, I might retry again if the stock, moves again up, reclaims VWAP, and then I will try an entry again there. And if the stock closes red or weak on the first day, I will preferably wait for a sideways action and the 10 moving average to kind of catch up. So this setup kind of converts into a hybrid version of a catalyst gapper and the breakout, right? So one example of that is, you know, SOUN, right? We had the catalyst, but then the stock moved sideways and the 10 moving average cast up, and then it became, kind of a classic breakout. So this is kind of the hybrid, um, setup that I'm talking about. Now for adding, I will add if another setup forms in the daily that fulfills my criteria. And the new stop loss that I'm having is I want to have it above my new average price. So I always perform free roll odds, right? So when I add, and then I add when I have an initial position, and then I add again higher, I calculate where my average price will be, and my stop is above it. So that ensures that I don't lose anything, even if the stock reverses, and I actually get something back for me waiting all this time, right? So yeah, that's about it. And the basic principles of selling, just to end this off, is I always sell some shares into strength and I leave some for weakness, right? I told you I leave making randomness an ally, right? I take partial 1/5 or 1/4 at 2.5 to 3 ADR multiples. And if the stock closes below my entry or less than 0.5 bar distance on the first day, I might close my entire positions, because I don't carry red positions overnight, or positions that are in a small profit on the first day. Stop loss is not updated unless I take my first partial, right? And then if I take the partial, I move it to break even, or split it into two parts, one part at break even, one part at the original stop. So after the first partial, I will trail the 10 moving average. If the stock closes below there, I will take, maybe 1/3 off. And if the price closes below the 20 moving average, I might close the full remaining position there. Only if I have a really big cushion and many R multiples, I will leave just a tiny position for the 50 moving average, just in case something extreme happens. So as I told you guys, my interview with Richard is still relatively new, and I might have gone, I don't know, Richard, like maybe 40, 50 examples, right, of how I apply all these rules. Yeah, so this presentation, since time is limited, is meant, as I told you, to entertain the brain and help you leave this session thinking and having new perspectives. So these things that I have discussed, I have discussed in this previous interview with Richard with much more detail. So I take them for granted. So I'll start getting into the second layer of trading, and we'll cover some examples there as well. So, but we'll look at them from a different angle and point of view. So, yeah, the reason that I say that I take this, these things for granted is because what we have covered so far, most of the things that we have, talked about the concepts of them, have been talked by many people, right? Of course, you might have learned some new details here and there, but most of the things are small variations of knowledge that many people have. So, since they have been covered again and again, it's a verification that these things belong to the first layer, where most people are. And I want you guys to think, of the following question now, like, since all those things are being spoken and covered so many times and people know them, why are so few traders that can make it big in the markets for years? Like, everyone that is involved in momentum trading for some months or years knows how to filter stocks, knows how to find tight setups, knows how to apply risk management, knows how to calculate his shares, the earnings, the acceleration, the estimates, all that stuff. And all that stuff matter, right? But why are so few people make it big and make it big year over year? That is my question that for you to think. And you might think that it's it's emotional control or discipline that these people have. that make it big, but these things belong to the first layer as well. And I don't believe where your focus should be is there, because no one is optimal in these aspects. We all got our issues. No one is perfect, and and most of the lack of discipline and emotional control are due to not having studied enough or using proper risk management. So what's the answer here? Like, the answer is that these things of the first layer are good, but are not enough to ensure a great performance year over year. There are things that extend beyond setups, beyond strategies, that have huge effect in the performance and profitability, and that's what second layer is about. So to set the ground, remember what I have said in the beginning. Layer 2 is using the knowledge, stretching it, mixing it, until something profound happens, or until some new nuances emerge from the knowledge you already have. And you might already know examples of people outside the markets that went beyond and unlocked the second layer, because this is not a concept just only for the financial markets. So actually, let's ask you guys, or even you, Richard, like, because it's interesting to understand the context and the nuances of it. Like, so which one of you guys, or you, Richard, know the story of Billy Bean that revolutionized the baseball industry, right? You know it, right?
Yep.
So, yeah, back in the days, baseball teams primarily scouted players based on simple statistics, right? Based on the look and the physical appearance, and the whole process was fully subjective about who is talented or not. And then this guy Billy Bean came around and introduced data-driven approach and advanced metrics. And what happened is, through this process, he was able to discover players that were extremely talented and at the same time were extremely cheap to draft. So he was finding undervalued players that the whole industry had no clue about. So what he did is he basically applied value investing into baseball. So the key point here is that even if all participants had available, the same data and knowledge around, this guy just looked deep and figured out things that no one else was aware of, and he was able to stand out. And that's the true essence of layer 2, spotting little details and mixing them in a way that helps you profit the most. So to get into the markets, right, when you profit from the markets by following by following your system, it's not that you tricked the market. It's because your strategy steps into the collective wisdom of the market better than others. So you are using an inefficiency of some sort that it's not overly used. And the reason that momentum trading works is because we are so few people out of all the participants that are doing these things the way we do them. These things are still small inefficiencies that are not overly used by market participants, right? But if you want to make it big, you have to look even deeper. And I'm not saying that you can't have a really good performance through what we have said so far. But if you want to stand out and maintain this good performance year over year, you have to look deep. And the deeper you look, the better chances you will find yourself in tune with the collective wisdom of the market. So here are the 5 keys that can unlock the second layer in trading. So these are things you need to understand and use more and more to get deeper into the mechanisms and the dynamics of the market, right? So key number 1 is changing perspective on what is dynamic in the markets. Key number 2 is thinking in terms of inner mechanisms of the collective. Key number 3 is changing perspective in risk management applications. Key number 4 is developing strong market awareness and intuition. And key number 5 is applying different implementations on the same profound ideas. So, of course, these things need many hours to fully expand. But the point of this presentation is to inform, possibly guide, and make you guys think and leave, this session more knowledgeable. So, like, if you were focused, I don't know, like 60 or 70% up until this point, now I want your full attention, because it's not that these things you haven't heard of them, but we will look at them at a totally different angle and perspective. So let's get into the key number one. So key number one is about what is dynamic in the market, right? So we all have different opinions about what is dynamic in the markets and what is really worth our attention. The thing, though, is that if the opinions you have are lended from others and are not yours from experience, you might be in a less fortunate place than someone who has a broad view, who does not take everything for granted, who has lended opinions, he has put them into test, he has verified them or changed them and solidified them through experiences. So I will ask you a common question, right? And Richard, you can participate. Like, just to understand this, like, um, do you buy stocks below the 200 moving average? Yes or no? That's
No.
simple, right?
Yeah.
No. All right. So uh, another question, like, do you only trade stocks with strong fundamentals and acceleration and strong numbers? Yes or no?
Yeah, for the most part.
All right. So I'm asking this because everyone has different opinions, but these opinions can really separate a mediocre performance from an exceptional one. Because based on these opinions, you are going to create the universe of stocks that you are tracking. Based on these opinions, you are going to filter out stocks and put them into your focus list. And based on these opinions, you're going to act on these stocks that are on the focus list. So even if you have the same strategies, the same rules, the same risk management, and the same setups with another person, these opinions are going to create totally different watch lists and different outcomes. So one trader, might pick only companies with great sales and great earnings above, you know, as I said, the 200 moving average. So he has a more strict point of view, a more closed universe, right? And there can be another trader that might have a more broad approach, like use technicals more and use fundamentals as a second weight of his approach. Uh, so who is correct? Well, there's not a right or wrong answer, but there is a right answer, and it is the one who has formed these opinions from researching the history of the market. So the one who took advice from others and went back to verify if what he read is true or not, or if it was true in the past, what may have changed now, is in a better position. So someone who is only limiting, their universe in companies with strong earnings and strong sales and great management team. And sorry, Richard, it's not personal, right? I'm just,
No worries.
laying out the facts. But yeah, but if you have a strict and closed universe, and it's not wrong. You might have never been able to catch those big moves that happen again and again in the markets, like, this, I don't know, this APT back in 2020, right? This INDO back in 2022, this LEDs back in 2021, this GameStop, this, I don't know, this the AMC, CVNA back in 2023, right? Lunar back in 2023. So many crypto-related names, a few months ago. ACB that I took a few weeks ago, and many, many other examples. So guess what these things have in common? I told you, no big earnings, no big sales or numbers. Some of them were below the 200 moving average, yet they made bigger moves than many of the classic fundamental stocks. And also many of these names were also liquid. So they had one thing in common. They had a great story on an emerging theme. So are these things good to invest long term? Of course, no. But that does not mean that they are not dynamic. Good sales and good earnings are always going to outperform the stocks in the long run. But I'm not an investor. I'm a trader and I want to be where the money is. So I'm telling you, it's not right or wrong. But if you go back and study the stock market history, you're going to see how many of these stocks with no fundamentals and weird looking charts provided extreme returns in short amount of time. And where is the setups in this? Like I didn't talk about any setups because it's not the setups. It's how different opinions, create a perception of what is worth our attention and leads to different selection of stocks and different outcomes. Even if we all use the same tactics. So whoever traded these stocks along with the others who had great numbers and earnings and sales, he's gonna have on average a better performance than someone who did not. And I'm saying trading this effectively, right? Now, what you do depends on you, right? You might feel uncomfortable, but being uncomfortable does not mean that you should be out of the true essence and reality of the market. And this is what the second layer is. It's about putting your truths and beliefs into a test, conflict with them, change your perspective into the new dynamics, and search for new opinions, accept them or reject them, and solidify them through experience. All right. Um, so the second key is thinking in terms of inner mechanisms of the collective. Now, getting into the second key, like basically what thinking in terms of inner dynamics and mechanisms mean, and I will have a question for you to answer that. Like, whatever happens in the markets, even if it's rumors, if it's news, if it's feelings, if it's profound ideas, if it's estimates, whatever it happens, in what ways do all these things express themselves? In what means is all that collective of data, of feelings, rumors, ideas, estimates, how is everything expressed? I'm telling you guys, like, this is a presentation that makes you think. So in the markets, if you see it really deterministically, every idea, every rumor, every news, every agreement, every possible announcement, everything has only one way of expression, and that is price. There's no other way of the collective expressing itself rather than price. So what does that mean? It means that inside the price footprint, it's contained the collective wisdom of the market with both evident and majorly hidden variables. And that's what the key is, that if you develop ways to study price action or see it from a different point of view, you're going to get a chance to look into this collective and inner mechanisms and find some of those hidden variables, which is an inefficiency, right? So many times, the price is going to signal you in advance for the probability of some events before they happen. And this happens both for entering and both for selling and stock. And I'll show you the proof. Like, let's go back before the 2020 pandemic, right? And see how the index looked. Let's go up until 21 of February. So if you were here, like, the index looks perfect, like there's nothing wrong. Even if the whole pandemic situation started, being around, the index didn't leave any clues. It was looking perfect, right? But look at this stock right here, right? Why is this stock showing such an extreme strength? What on earth happens in this stock? Nothing major significant has happened yet, right? If I go back to S&P, nothing significant has happened yet, right? So if you think, that's why you have to track, the relative strength and big volumes and all that stuff, because this is how you find these stocks. But getting back to the point is, if we think that there is an infinite number of possible realities that may follow, some of them are more probable than others. So one or two people might have some clues, but the collective signals the most probable realities because it contains all the data and expresses itself for us to see it, if we look for it, of course. So that is a cheat code that you need to take advantage because it happens again and again. So if you search this stock was making protective masks, right? And it's showing extreme strength, which is abnormal because nothing major has happened yet. Well, when SPY S&P started, dropping, look what the stock did, right? It has went up, like 500%. And the same thing, happened, with Zoom. Like this stock is showing extreme strength when S&P is falling. Why? The collective leaves clues. You just need to look at them. And the collective leaves, clues of the most probable events that may follow because it's the collective, right? And I told you the examples I showed are before the entry. Check something for selling a stock, right? Check this out. Like I showed the Zoom stock. So check this out again, and I'll be quick, right? So this stock back in 2020 had extreme numbers of earnings per share, like 900%, 500%, 900%. Still up here, 900%, 700%. So if you look at this, at just the fundamentals, you would say, whoa, it's a perfect opportunity right here. I may have to buy, right? But why, if everything is good, why the price, gets hit? So it was after, the stock moved down 80% that bad things started, to show up because the collective somewhat, in some cases, knows and signals us. That's why price is really important because it leaves clues. You just need to kind of approach this, at a different angle. Um, all right. So the key three is changing perspective of um, and having different risk management applications. So I have already said that the reason the things we do as momentum traders work because they remain as small inefficiencies yet because they are used by a small fraction of the market participants. The thing is, though, that the slight edge erosion of the classic setups, sorry, I wanted to say like an erosion of these classic setups if we look through the decades, prior decades up until now. And this is not, an if. It's not an if there is an edge erosion, right? So, uh, if you look at, trend following tactics or momentum tactics 40, 50 years ago, you will see much more linearity. It's a fact. So if you applied momentum setups 40 years ago, on average, you would have made better performance than doing the exact same things now, right? And you might think like, then why do you trade breakouts? Well, because they are extremely powerful and still evident as they were 20, 50, 100 years ago, and in all different markets. But edge erosion does not mean that these things are not evident or that they don't make money. They do make money. But edge erosion means that the probability of them working out every time they occur has dropped a little. So here you can take three paths. You can approach this, phenomenon and don't look at it and convince yourself that, it does not exist and apply methods straight out of the books that were written 30 or 40 years ago, right? You can be the exact opposite and be scared of these setups and not trade them. Or you can be smart, accept the truth, and find workarounds. The choice is yours, but I'll try to show you some workarounds, right? So the question here is like, how can you manage against the slight edge erosion? So how can you hedge against this edge erosion? And I'll make it even easier. Like edge erosion means lower win rate on average, right? So how can you hedge against a small win rate to ensure the same profitability? Richard? Like
I'll throw a
the
guess.
question is,
Yeah.
how can you hedge against a small win rate to ensure the same profitability?
You got to manage risk a lot tighter in those situations and
Exactly.
make that your edge.
You've got to increase your risk to reward ratio. And you have to, and how can you increase your risk to reward ratio without changing your selling tactics? You get your stops tighter. And you might think that this is dumb because you might think that if you decrease your stops more, making them tighter, right, you reduce your win rate even more. Well, that's true again. But I told you, second layer is about looking deeper. So if you look deep, you will see that the decrease of your stops with your win rate do not follow a linear relationship. Meaning that if tomorrow you made your stops 2 times tighter, increasing your expectancy and average risk reward by 2 times as well, your win rate does not drop in half. So the question for you, until I show you, an example to visualize it, is the following. So let's say you have a 40% win rate on average, right? And you make 3 times your risk per trade. If I told you that you can make on average 6 times your risk per trade, but your win rate from 40%, which was initial, does not drop to 20%, but remains on 30%, right? Would you take that bet all the time? If I told you that you can double your average expectancy and reward without halving your win rate, would you take that bet?
Yeah, I would.
Yeah, so that's exactly it. And this is, a table to illustrate it. So, these are hypothetical numbers for you to just understand the concept. So on the right side, imagine you have, the ATR multiples. So this is how big your stops are, right? And down, you can see the win rate ranging from 100% up until 0%, right? So, if the tightness of your stops and your win rate follow the linear relationship, right? What you would see is something like this, where if you risk, let's say, 8 ATR, which is extremely big, let's say, you would get a win rate of around, 87%, right? Just for example. So if you halved this ATR multiple into 4, right, you would get exactly half of your win rate. And if you halved it again, right, 2, you would get into 23, 24, again half. But in reality, that doesn't happen. So what happens is you get this, line. So look at this. We're gonna do the same things. If you risk, 8 ATR, you're gonna get like 93, let's say, right? If you go half, you're gonna get, let's say, 82. So it's not even close to being half. If you reduce for 4 to 2, right, you're gonna be to 63, let's say. If we go to 1, you're gonna be to 50 or something. If you go to half, you're gonna be to 30 or something. If you go to 0.25, you're gonna be to 20 something. So you see that's a completely different reality, right? Um, and do you understand how much edge this gives you? Like, you can tighten your stops as much as you want and halve and halve and halve them. But in reality, your win rate that does not halve as well. So this is a cheat in the game, an inefficiency that can't be easily broken. because most of the market participants can't use really tight stops. And also it's an inefficiency that fixes the edge erosion of another main inefficiency we just talked about. All you have to do is, play around with the knowledge you have and look deeper. So if you haven't accepted this yet, I'll just ask another questions, like, just tell me your honest opinion from your experiences. If you take the best momentum leaders and the best breakouts that occur in the market, right? Take the best stocks. Do these stocks that are really powerful frequently violate the lows of the first breakout day, or they just shoot up day by day? What's the answer?
They just go.
Just based on your experiences. Like, the best stocks out there just, break out and shoot up. That's the reality of the thing. So if we open up SMCI, let's say, right, and we go back here on this kind of nice breakout, okay, so let's take this breakout, for example, right? All right. So the question is, like, if you have put your stop loss here, would you have been stopped out? No. If you put your stop here, you wouldn't be stopped out. If you would put your stop here, would you be stopped out? No, again. If you put your stop here, no. If you put your stop here, no. You put your stop here, no. Right? So what's the difference between, let's say, this person that risks this distance and this person that risks this distance? This one has, I don't know, 10 times more expectancy, and it's making 10 times more money by exploiting an inefficiency, right? So once again, guys, different performances in traders do not come solely from different tactics, but from different applications of the same things you already know about. So let's get into key 4. The key 4 is developing, strong market awareness and intuition. And, since time is limited, I won't get fully detailed about market awareness because most of you guys are aware of it. But keep in mind that it's extremely important, right? Because if you have developed ways to understand quickly enough if the environment around you is fertile or not, you can adjust your actions. So you will know when to be aggressive or when to be defensive, where you should increase your risk and the trades you open, or where you should decrease and shrink your positions. And these adjustments are no joke because they can really separate a superior performance from a mediocre one. If you study the markets, you will see that we get, most of the times on average, like 3-4 really good months every year. The others are kind of more difficult. So if someone is using the exact same risk all year around and he's aggressive all year around, you are going to massively outperform him if you push the really good periods and adjust your system for all the other choppy and bad ones. So I have talked again in my other interview about some ways that I use to kind of understand the breadth of the market. And literally you can use many methods, right? Other traders track the stocks that are above, are every day above 25% or below. Others check the volatility or how crowded are, the markets. Others check the 10 and 20 moving average. Other, check the, 52 week highs net or lows. So just develop your own thing and learn to adjust. All right. And the second point in this key 4 is intuition, right? And intuition can really help you have a better performance than the rest with the exact same knowledge. And intuition is basically that gut feeling that you get when you see something that you may have a profound idea, right? That it came out of nowhere of what may have happened or what may happen next, right? Is that gut feeling sources from, the unconscious, subconscious deep part of you. You know how many times you see a chart and you say, "Whoa, I know that. I've seen this a couple of times." Well, that ability to understand what might be good or bad, right, comes from your experience and memories. The more memory of events you have and more experiences, this gut feeling gets stronger and stronger. So our brains work kind of like algorithms in machine learning process, right? The more data you feed them, the better they become. The more data and the more good quality data you feed them, the better prediction power and the better outcome. No data at all, random results. So intuition has so much impact in trading, and I will prove it to you because I have done a recent experiment about it. So for people that don't know, I recently contributed to a research along with an expert in quantitative finance, right? And we wrote a paper which was about the power of intuition. So what we did is we studied all the gap up events of 6% or more after 2026 up until 2023, and these were around 10,000 examples. And we found out that the majority of these stocks that gap tend, to plateau or drop a few days after the gap, right? So when my partner looked deeper into the stats, he saw that there are, a select few outliers in the data set that went against, this trend, and they continue to move up, right? Uh, of course, this makes sense because this is the catalyst gappers we look for to trade. But look at the results right here. This is, the end table. As you can see, if someone traded the full data set of events, of the gap up events, like he gets, the strategy is not even profitable, right? It's break even or even a downtrend if you take all the gap up events. So my partner, said, well, Marius, like, how about I create an environment that you don't know anything about the news, the name of the stocks, the fundamentals, specific prices, the overall market, and provide you random charts, and you approve or discard them based on 2 years price history. Um, so this was a test to just see if we could improve, the bad outcome that we were seeing of this, the results. So I became a test subject, and I approved or discarded the charts based off how the price action looked. And then he created another environment that we basically could micromanage these positions like entry stops and perform micromanagement. And we also excluded the 5 best trades to be more conservative, not to have a big random factor. So here are the final results, and I'm telling you all this to understand the power of intuition. So see how dramatically the numbers changed. Like, this is the charts that I picked combined, with my micromanagement in a full bias-free environment that I had no clue about other details. So if I had, news, if I knew about the market, maybe it would be even better. But, uh, there's a huge difference in these results, right? So this proves that intuition roots from your studies and experiences that can make a huge difference in your trading. These results from break even went to profitable, and it's exactly the same among traders. You can have the same tactics, the same rules, the same scans, the same data set with someone else. But if you study deep the markets, you're gonna have a better intuition. And what does intuition? What intuition does? It leads to better stock selection out of the same data set, and good selection of stocks lead to better win rates and better asymmetry in returns. So as I said, like, it doesn't matter if you use the same methods and setups with others. The one who has studied better, he's going to make a better performance and stand out. That's the power of intuition. You can change dramatically, even in the same concepts, uh, your results from someone who has the same knowledge with you. Just study deep. Just open your eyes. All right. And let's get into key 5, which is the last key, in my opinion, to unlock the second layer. And it's applying different implementations on the same profound ideas. So this is something that is massively overlooked. And for me, it's so important that can create totally different results and performance. So to understand what implementation is, in simple terms, is how you execute a profound idea that you have and what assets you choose to execute it. So to fully understand this concept, I will just challenge you with another question. Like, let's say you wake up tomorrow, you have traveled back in time, and it's early February before the 2020 crash, right? You are 100% sure that the market will crash in a few days. What would you trade to profit from this crash? You know a crash is happening. What would you trade to profit from this crash? Would you short S&P? Would you short QQQ? Would you do something else? Like, think about it for a moment. Richard, you can tell me, some ideas if you have, or I will continue with.
Yeah, I think I would probably short the TQQQ or go long the SQQQ. That would probably be my preferred
Perfect.
method.
That's one implementation, right? Like there are a ton of different implementations, and I will tell you why this matters. So, exactly, like one trader might, have chosen to short, S&P. I know a crash is coming. I'm gonna short S&P, right? This trader, right, made around 35%. Another guy thought more about it and decided to short TQQQ, right? So this is a leveraged ETF. So this, implementation is better. So this guy was able to make, 70 around 70% in his investment, right? Someone else thought that, you know, uh, why why short uh, why short an ETF and not go long an ETF, right? Because uh, when I short, everything can go down max 100%, but on longs they can go up more. So instead of TQQQ, someone else chose to go long SPXS, right? So this guy made 130% on the same thing. Another guy said, well, uh, why don't I find a company that is in an industry that is favored by the crisis? So this guy has done, his research more. He has run simulations and in his head about probable scenarios, and he decided to go with Codex, right, which is an industry that is helped by the sentiment of the crisis. This stock went up 500%, right? So another guy um, said, crash is coming. A crash is coming. Volatility will increase. I should trade the volatility index ETF. So let's say this guy picked UVXY. This guy made 900% on his investment. So you see that uh, even if someone has profound ideas about things and he's smart and he has predictive abilities, if they don't execute them properly or pick the right assets, then these ideas mean nothing. The first guy made 35% by shorting S&P. The last guy made 900% on his investment by going long UVXY in the same profound ideas. Of course, there are other means, like you can do options, you can do all other things and different implementation, but I'm just talking about equities and ETFs because I do those, right? So again, you see that great performance lies in other aspects, not solely on strategies, right? And you see these things happen again and again, and not just on major events, but major events happen as well. So before 2022, right, someone might have had a profound idea that an invasion of Ukraine might happen and oil might gain some ground. So one guy decided to go long, you know, USO back in 2022, right? Which of course made a big move. It made a move of like 50%. But another guy, right, chose to go with INDO, and INDO made 1,600% or so, right? And even if we look at the smaller picture about things we encounter every day, someone a few months ago, bought this uh, cryptocurrency Bitcoin ETF, right? He made 70%, while someone else traded an STR and made around 200%, right? It's the same again and again. It's even if it's a big picture or a small picture, the same ideas lead to totally different performances among people. Now, are you always going to be able to find the most perfect assets? No, because no one does. But you can get closer. And being someone that doesn't see a setup and boom executes it right away, but someone who takes a step back, measures and weighs, their options, runs scenarios and simulations on their head, and finds extra things, then decides to act, you put yourself on a totally different category. And this is a hidden edge that a few people unlock. And it's a superpower of trading to have a great performance and unlocking the second layer. So you see, guys, like uh, where are the setups and strategies in all this talk that we're having all this time? Where are the setups and strategies? Nowhere. Because it's not the setups that will make you do wonders in the market. These small details, these small inefficiencies, this mixing and blending and experimenting with what you already have is going to make you do wonders in the market. As long as you are ready to change, and as long as you are ready to test your beliefs and perspective, combine these elements, use them more and more, and you will see how you will outperform people with the same knowledge as you. And now you can see why I made a great return in 2023. And I'm on my way to another great year. And I really, really think you can do it too, right? So, of course, guys, time is limited and I can't overly expand on all these things. That there are more, of course, but I hope you had some, aha moments so far. And since we're coming to an end, I'll wrap this up with a quote, right? So, Nikola Tesla once said, like, if you want to learn the secrets of the universe, think in terms of energy, frequency, and vibration. So I will leave you saying this, like, if you want to learn the secrets of the market, think in terms of dynamics, inner mechanisms, and momentum shifts. That's how you get closer to the truth. That's how you sneak peek into the collective, and that's how you will achieve greatness in the markets. All right. So thank you so much, guys, and thank you, Richard, for bearing with me. Honestly, yeah,
No, thank you very much, Marius. This was really excellent, um, and covered a lot. We got to cover a lot today. So thank you so much for your time and your expertise. I think I do want to ask one question, and if for everybody watching, if you enjoyed this, highly recommend watching or rewatching the first interview I did with Marius earlier this year because we got the chance to expand on a lot of these concepts there. So we'll have that link available for you, and highly recommend checking that out. Well worth your time. Um, and in that interview, Marius, you mentioned the books we write for ourselves are the most important books, meaning the books that we create by diving deep into the market, studying past setups, all of that. Um, could you expand on just some guidelines that you have found helpful for doing that research? Um, and also how that goes into helping build the intuition and I think really step 4 and step 5 that you mentioned in level 2 yeah, really
yeah,
applies and comes from those books that we write for ourselves.
yeah, guys. So it's not that hard. If you have the dedication and you can spend a few hours a day trust me, you can uncover a lot of things. So the most simple approach is just, there are many ways, but one simple is just, open your charting platform, go to DeepView, go to or TradingView, I don't know, whatever platform you have, and you know, create a scan or find a scan that can, make you see what stocks, performed well in the prior years, like in 2008, 2009, 2010 to 11, right? So you go into each and every one of these stocks right now. Like if I press this, it shows them, from better performance into, not a good performance when we go down. So that's how, you find the best performing names. Some, of course, are going to be delisted if you go back. So, but even if you study like 3 or 4 years, is more than enough, right? Just, pay attention to 2020, because this was a crazy year in all terms. So you shouldn't base all your findings just on 2020. But it's really simple. Find the stocks, put it on a watch list, right? Create a big watch list based on the year, and then go back and open the news, right? If you just Google a specific day, like if you watch a chart, right? I wanna, let's say, study what happened. This is not far back. Like I wanna study what happened in root on February, right? If I write the exact date of the and the sticker name, and press news on the Google, it might show me some relevant news, and you can use some sort of different services. So you start, you know, applying what happened there, the news, right? Then you start seeing more deep into the setups. Was the market doing this period? Was there any, major theme at this period that was evident? What sectors were they picking up, or what industries were they picking up at this period? What were the similar stocks of what I find did in the same period? Then you start, doing some multi-level connections, and then you look at the charts. You find where are the breakouts. When did the breakouts occur? Did it have a catalyst day? Right. So it's not that hard. It's not that hard, guys. Start by doing, I don't know, 10, 20 stocks the first day. You will do, it's a lot. Like do 4 or 5 stocks the first day, do 10 stocks the next day, then you're gonna do 15, then you're gonna do 20, and it gets easier and easier. And have all this, on a uh, make screenshots, make notes, and print some books. These are the books that you create. So this is one thing. If you feel that this is inefficient, or you need more time, then go and study trades of other traders. Like there are traders that post their trades for 10 years, and they are good traders. Go and study their trades. It's the same thing. And through these trades, you're gonna see also stocks that you know um, are not active right now. So it's the same thing. It's not, you will not find something extraordinary out of this, but subconsciously you will build your intuition. It's that gut feeling that, oh, I know this, oh, I've seen this. That helps you be more selective. That helps you have a better win rate. That helps you be in the assets that create most asymmetric returns. So it's not that hard. Study other traders and go back, create some scans, find all the stocks, then print them out. Right. So yeah, I don't know. It's if I can get, even deeper on this. It's really simple. Like
No, I
yeah.
think that's perfect. So, um, for everybody watching this, our challenge for you is to, over the next few weeks to start building those books for yourself. I think that's a good place to leave it. Marius, again, thank you so much for your time. I think this will have a really great impact on a lot of people watching. So hopefully you guys enjoyed. If you did, go ahead, leave a like down below. Thank Marius in the chat. We'd really appreciate it. And Marius, thank you again for your time. And yeah, it's great to have you as a part of the conference. So appreciate you being here.
It was great being here, and best of luck to the next presenter. I hope I did not fry your brain cells today, guys, because I certainly fried mine. So peace.
Nope. No, it was excellent. And we'll be right back with the next presenter. So take care. All right, welcome back, everybody. To kick off the second presentation today, we have someone who I'm very excited to hear from, Marsten Parker, who is a full-time systematic trader with over 20 years of experience and was featured in Jack Schreider's latest Market Wizards book, Unknown Market Wizards. So really looking forward to diving into this. And it's a little bit different of a style, diving more into systematic trading, which is something I'm not super, knowledgeable about, but I'm very excited to learn more about as well, and how it can help benefit my style as well. I'm sure there's a lot of carryover. So Marsten, thank you so much for being here. Really looking forward to this presentation, and great to have you as a part of the conference.
Thank you, Richard. I'm really honored that you asked me to be included, and happy to present on this topic. So as you can see, my topic is a survey of systematic trading strategies. And once I activate this, this is basically an outline of what I'll cover, a little bit about me, talk some about what is systematic trading compared to discretionary, get into how I test and trade my own systems, demonstrate briefly my real test software, and then I'm going to be going through 24 example strategies that I've screenshotted and talking about each of them, and then summarize, and that'll be that. So,
Awesome.
Yeah, I've been quote unquote trading for a living since 1998 and 100% systematic since 2000. As you mentioned, I'm featured in Unknown Market Wizards by Jack Schwager. I built my own backtesting software called RealTest, which has been publicly available since 2021. And these days, I am more focused on enhancing and supporting RealTest than on trading itself, but I do still trade. Prior to 1998, I had a 13-year career as a coder, working for several small software companies in the Boston area. And prior to that, I was trying to be a concert violinist by attending a conservatory in New York City. That's my life in a nutshell. So what is systematic trading? It's also known as algorithmic trading or algo trading. The key point is that all trade entries, exits, size changes, whatever, are determined by computer code. No human discretion at the individual trade level. The human's role is to design and deploy the trading system. A system can be a single strategy or a collection of strategies that run together. Multiple strategies can share a single equity pool, combined compounding. Now, this is what I consider are the advantages of discretionary trading. I know that your audience is primarily discretionary traders of growth stocks, and a good discretionary trader knows what is in play and can focus on those opportunities. A system might be able to guess in play for example, unusual volume, or you can code some things that indicate a stock is in play, but it won't be as accurate as the judgment of a human with experience. Similarly, situational awareness, which is sometimes talked about, it's more at the market level or the individual name level. When you're running a system, it doesn't know if there was new news about a stock. Probably. I mean, some people can incorporate news, but I don't do that. So having those kinds of awareness can also influence your position size decisions. I know that that some of the better, most successful discretionary traders have a great instinct of when to size larger and smaller on their individual trades, and whereas a mechanical system isn't going to be doing that. It might vary size based on volatility or something, but it's not using any kind of awareness to do that. That said, a discretionary trader could still be mostly rules-based, while using the advantages that are listed above. On the systematic side, this type of trading forces exact specification of your trading rules. So that kind of adds a level of discipline. That, I know that discretionary traders try to be somewhat disciplined about their rules. And when you have to actually code them, there's no cheating. When you have all your trading rules fully coded, this allows you to run backtests, which will let you know exactly what the past performance of your rules would have been. And as I say in parentheses, past performance does not ensure future performance. I think I left out a not, but neither does non-performance. I'd rather run something that would have worked recently than something that would not have worked recently. And for me, I think the key is it allows the actual daily trading process to require very little time and not be influenced by personal circumstances, emotional state, whatever. As long as you can make it to your computer and press the start button, you're okay. In terms of performance expectations, think of this as a long-term approach that, if done right, could allow you to slightly beat passive investing. It does not compare with, for example, Mark Minervini style growth stock trading, which I expect is what most of you are involved in, or various other discretionary approaches in earning potential, at least for those who can master them. As is stated in the book I just barely qualified, and mostly because of the length of my trading history. So it's definitely this approach has more modest expectations than the best possibility of discretionary trading for the few people who can achieve those. If trying to decide, consider how you want to spend your time each day for the next however many years, or do both. There's no rule that says you can't be doing some discretionary trading and some systematic trading at the same time. How I develop and test systems. So the number one requirement is having good data. I recommend Norgate data for the kind of testing and trading that I do, which is completely with daily bars. I have used intraday data in the past, and I may do so in the future, but for the past 7 or 8 years, I've been just running systems that can be tested and traded with daily bars. I put obsessive emphasis on realistic backtests, which hence the software name, which means a backtest that I will run in the future should always match whatever trades I made today. So it needs to be really deterministic. And the key is this last point, which is having a good software where you can work interactively and iteratively in your software. So you get into this flow state where you run a test, you look at the output, maybe look at some trades. It gives you another idea of something to try. You run the next test. You keep repeating that loop. And that's, you gradually build your knowledge of what kinds of things work, what kinds of things don't work, and go from there. How I actually trade. So Realtest software has the ability to generate an order list for the upcoming day based on whatever set of strategies you've defined in your script. And also, accounting for your current actual account balance and open positions. It actually, Realtest is able to backtest from rules or from a list of trades that it reads in. So you can actually also use it to backtest your own live trades and try different rules superimposed on them. But in terms of live trading, it plays back your live trades so far to establish exactly what your current positions are, and then it applies the strategy rules to establish what tomorrow's order should be. And I have this other program that I make available to Realtest users called Order Clerk that makes it easy to place the orders generated by Realtest if your broker is IB, and get the fills back and maintain the round trip trade history that's used to play it back and generate orders the next day. So that loop just keeps continuing. But yeah, trading itself takes less than 5 minutes a day for me. I could put a batch script around it, so it just always runs fully automatically, but I don't like 100% automation for some reason. I like to kind of look at things and press the button every day as a sanity check. So that's what I do. Some of the other users do automated and maybe only look once a week, or have batch scripts that send them an email if there's an error or something like that. That's kind of a personal choice. And then, yeah, the key, you're continually monitoring your performance, both to make sure your live trades are matching what the backtest said they should have been, and also just how the strategy logic is doing. Sometimes things stop working because of changes in market conditions or whatever, and that's always a tricky question of knowing when to take a strategy offline or tweak it versus leaving it alone because it's in a normal drawdown. There's this part is where my discretionary layer is. I don't have a meta system that decides when to turn systems on and off, as I believe, for example, Renaissance Medallion Fund uses, based on the book by Greg Zuckerberg. So real test software is my backtesting software. I first started coding it in the late 90s, soon after I started trading, as a way to, we were running, my trading partner and I at the time were running a semi-discretionary strategy. The entries were more discretionary and the exits were more mechanical. And I want to be able to test alternative exit rules. So yeah, that's when I first wrote the code that reads in a trade list and lets you apply different exit rules. It gradually evolved to allow full specification and formulas of entries and exits and sizing rules and everything else, so that you could test fully mechanical strategies. And back in 2017, I decided to, I thought about this many times before, but finally got down to it and really gutted and rewrote the software to make it more broadly usable, so that I could market it as a product. And which ended up taking me about 4 years. And then I made it available to the public at the start of 2021 and have been offering and supporting it ever since then. Now I'm going to show a quick demo of the software live before I go through the strategies. I didn't want to run all 24 examples live because I thought it would, it's hard for me to talk and do things at the same time. But so this is the real test software, and this is one script that I'm going to be including in the list that follows. But it's basically, and this is one of the example scripts that comes with real test. In fact, nearly all the ones I'm going to show are examples that come with the software. And this basically is showing the long short breakout strategy. This isn't exactly one I ever traded, but it represents the kind of strategy that I was trading, or the pair of strategies, long and short, basically from 1998 all the way to 2015 or so. And this is the entire script. So all the trading rules of how I traded during that period are expressed right here. So the import, we have a data file that we've imported. And so what I'm going to do now to just give you a flavor for how it looks is I'm going to load the data file. You can see in the status bar along the bottom, it kind of tells you what it's doing. And this is, this includes all stocks that have traded on US exchanges, including delisted stocks. For this particular example, I just went from 1998 to 2004. The results for this script I show later go all the way to the present. But now to give you a feeling of what just happened, so if we open the symbol selection, so this shows all the symbols we now have in memory. The ones with a dash and a year after them are delisted, like there's probably Enron, for example. Right. Now, if we look at, if I go into this debug panel, I want to, okay, so I've got it set to just show Apple. So this is what's in memory now for every one of those stocks. Basically, open, high, low, close, and volume, and that's it. Now I'm going to go back to my script and press apply. Now this section called data is kind of the key point of how Realtest works. It's sort of like adding columns to an Excel worksheet, but it adds them to and calculates them for every single symbol at once. So you end up with this huge array in memory of all the indicators and formulas that you need to define your strategy. So now when I say apply, it's calculating, what does it say? 130 million values, and that's finished. It does that with multiple threads, so it's fairly fast. Now, if we go back to data, you can see it's added those columns to Apple, like the average range, average close, average volume, volume surge. Let's see. All right, so on 10/16/03, Apple had a 2.8 times volume surge, so on. So that's what goes on first when you run a test. And now that that's in memory, the actual strategy definitions can refer to them. Like it refers to L entry, with long entry, and that's the long entry formula, and so on. So now we can run the test, and you can see in the status bar the stats so far as it goes along. I'm just going to go till end of 03 because that's the scope of this data file. All right, and now we see the results where it ran for about 1,500 market days and made about 3,800 trades. And you can see some of the stats: 56% wins, average win, average loss, length of win, and so on. All the formulas in this file can be customized here. I have all sorts of different ones commented out and so on, so people can show whatever stats they want, calculate it however they want. Now, if you double click on this, you get the equity graph and the other graphs. So this shows how the long side and the short side interacted, and shows why it's good to trade both sides, because when you had a big drawdown in the longs, you had a nice uptrend in the shorts. So the overall, which is the gray line, drawdown wasn't as bad. Go look at your drawdowns. This is shown here as well. The blue is the two strategies combined. Length of drawdowns, and this is your daily net account change. So it shows you the range. You can sort that, so you can see that most days are kind of in the plus or minus 1%. You had a couple outliers of +5, -6, somewhere in there. You can do the same for weekly, monthly, quarterly, yearly, which are like rolling. This rolling yearly thing shows how the strategy started to do less well after 02. And then, you can look at, this is an interesting one. For example, your net exposure. I always allowed with this system 100% of my account to go long and 100% of my account to go short at the same time if they wanted to, although it rarely did, because you tend to get more of one side or another. So but the overall exposure, if you add them together, might be close to 200%, but the per side exposure never exceeded 100. So basically never really use margin in this system. In other words, I never would pay any margin interest because I was never more than 100% long. So those are the kind of things you can graph, and then you can look at, for example, actually I was going to go to this one, the plot of the all the individual trades just plotted on a scatter plot, so you get a feeling of, this is in terms of account percent, and you can see that you can go to the list of trades, and I don't know, let's just go somewhere randomly in the middle, and then you can open a chart and start going through them and looking at them on a chart. And this is a good way to get ideas for how to tweak a system sometimes. Now let's see some of the, we're in the middle here, right? The biggest winners in this strategy are always, random luck, basically a buyout announcement, a positive earnings surprise, or a negative earnings surprise in the case of shorts. or whatever, you know, there's obviously no knowledge at the time of entry that thing would happen, but there it is. So that's a kind of a useful feature as well, to be able to look at your trade. So from a results row, you can drill down into other things. There's a whole lot of other stuff, but you know, that's it in a nutshell. I mean, let's see, if I were to run the orders function, give you an idea. Well, it's just silly because it's running through the whole thing. Typically, when you generate orders for live trading, you're probably just going back a year or two, but let's see what it would do. Oh, okay. No new orders for the start of 04. Very good. All right. Well, that's the software in a nutshell. I'm not going to spend a lot more time on it. It has a huge amount of features, but I'm going to go back to my PowerPoint. And so yeah, what follows are just 24 example strategies. It's trying to kind of build up from the simplest to the one I just showed is near the end, and some others, and show just the basic results and talk about each one. So first, I started with the most basic possible strategy, buying and holding SPY. And you can see on the left the entire script that would be required to test buying and holding SPY. The strategy has literally one line, entry setup 1. So it buys on day 1 and holds until the end of the test. But you know, it's good to look at the stats, because what will follow are a few other variations on trading SPY. I personally do not trade any single symbol strategies. They're all portfolio strategies, but I figured I should start with a few SPY examples just for starting at the beginning. You know, so the stats of this is with total return adjustment, meaning it includes dividends. So it's the entire period since inception. SPY has through Thursday, because I didn't include Friday's data in these, made 10% a year and has had 55% drawdown. So that's the nature of it. Okay, going on to the next one. So here's a well-known variation on trading SPY called the golden cross, where you're long when the 50-day average is above the 200-day average, and you're flat otherwise. And this compares that strategy to the actual buy and hold, which is in red. The Real Test makes it easy to include benchmarks. They're run and calculated and graphed, but they're not included in the stats. So they're just there for visual comparison. So you know, you make slightly less money overall, but the drawdowns are reduced. So risk adjusted return is probably better. Yeah, Sharp 0.62, Sharp 0.76. Okay. Now here I tested a few different moving average crossovers. I only graphed one of them, the one with the best results, but you can see from the parameters section, I tested 20, 50, 100, and 200. And that in this case, different from the golden cross, it's just close, the latest price crossing a moving average. So yeah, you can experiment with stuff like this and realize that with stock index ETFs like SPY, that short-term trend following, like 20-day or 50-day, really doesn't have very great results. Once you get up to 200 days, the results start to be okay, but still not as good as the golden cross. What works a little better, that, you know, classic trend followers tend to use donkey and channel instead of moving average a lot of the time, and which simply means you want close to cross the highest close. It's more like a breakout trade really than just a moving average cross. So I guess you might say it has more confirmation built in. And these, for each of these periods, the results are a little bit better than the corresponding if you focus on the ROR column, when I go back and forth, they're all a little higher with donkey and then with moving average for the same period for SPY. So, just kind of an interesting fact. Can play with stuff like that. Okay, and then finally, I just wanted to find, is there any strategy long only SPY that beats buy and hold? And I'm sure there are many others, but this is the first one I came up with, which is a very simple mean reversion concept, which is to buy SPY whenever RSI2 crosses below 30 and hold it until it crosses above 70. And that actually slightly beats the buy and hold return with like half the drawdown. So that's pretty good. If all you want to do is slightly beat the market with less volatility, you could just run this and be done. Now getting into some kind of slightly more advanced, but still fairly passive approaches to investing as opposed to trading. We have this Ray Dalio all-weather strategy that's basically just setting a fixed allocation among 5 ETFs, each of which represents kind of a different asset class. And you rebalance your portfolio once a month to maintain that constant allocation. And that gives you a much smoother equity curve than buy and hold SPY, but the rate of return is not that great. And nowadays with you can have 0 drawdown and 5% by putting your money in T-bills. So I don't see much point in getting 6% by running this. And who knows what it'll get in the future, of course. You can see that it's been negative since 22, as have actually many strategies, except for holding the 3 stocks in SPY that are providing all the returns. Now, moving a little more down the complexity ladder, there's a lot of these come from things where real test users have asked me, how do I implement this thing that I found online? A lot of the development over the past several years has been making sure real test has enough features to implement anything anybody finds in a book or online and wants to backtest. So this site called allocatesmartly.com has a whole bunch of stuff like this. And this one is called Bold Asset Allocation, and it's pretty well documented there. They tend to be a little complex and a little bit hard to implement, involving the different dividing the symbols into different groups and ranking each group and making some calculation based on the relative rankings. This data section that I showed earlier in the live demo, where it's kind of like adding columns to Excel, it has the things that start with a hashtag means cross-sectional. So whereas most data items are calculating a column, the hashtag ones are calculating a row. So that lets you do cross-sectional ranking, like relative strength and so on. In fact, this absolute momentum item, which is here, is something like IBD relative strength. I'll show that some more in a subsequent strategy. The next one along those lines is called Vigilant Asset Allocation. That's also from the same site and uses a different collection of ETFs and does things a little differently. And that one actually has stats that beat buy and hold in total return and substantially better in terms of drawdown. So that looks like a pretty interesting one. Although again, it's flat for the last several years. Here we have yet another one from that. Well, no, I guess this was from a different site, but it's by the same authors as the prior two, Keller and Koenig. This one is called Hybrid Asset Allocation. It's a kind of an updated version of the first one, I think. So the MAR ratio is gradually improving as we move forward in time in terms of where these things were published, which makes you wonder if they might be overfitted. But And then this one is especially interesting. This was probably one of the more complex ones to implement, but this one just trades SPY and TLT, basically, and it's just trying to calculate every month the optimal stock and bond holding ratio. And it does that by calculating the Sharpe ratio of each possible 10% interval, 100% stocks, no bonds, 90-10, 80-20, 70-30, et cetera. And using whichever one had the best recent Sharpe ratio for the month going forward. So it's kind of like a walk forward process embedded in a strategy. So that's a fairly complex way of approaching things, but you can test that kind of thing if you want, and it shows what the results of that were. All right. Now we move away from SPY strategies to, this is a fairly well-known concept, which is trading the VIX. Of course, you can't trade the VIX itself because it's just an index of put option on the S&P futures, but you can trade VIX ETNs. This particular one uses the VXX. In order to backtest VXX with Norgate data, there are two different symbols because VXX was delisted and then relisted. So that's accounted for in this particular implementation. But the basic idea of this strategy is to just use the VIX itself versus the 3-month VIX, which is VIX calculated on the futures 3 months ahead versus the current contract. And so it's basically using the VIX term structure. So if the current VIX is above the 3-month VIX, that means the VIX is so-called in backwardation. And that will typically happen when VIX is spiking and the market is tanking. You can see this most clearly if you look at 2020 on the chart, which is actually the highest VIX reading that we know of, at least since VIX futures traded, which was since 2004. So all this strategy does is it's short VXX most of the time, except when the futures term structure goes backward and then it flips to long. And in this implementation, it's putting 20% of the account in the positions, because you certainly would never want to trade this thing with 100% of an account, because you never know. I mean, VIX could, if there's some major catalyst that makes the market lose a lot of value overnight, VIX could hit levels it's never hit before. You don't want to be short VXX with 100% of your account ever or anywhere near there. But anyway, so this can produce a return similar to buying and holding S&P with less drawdown, but with only using 20% of your account. The exposure calculations include mark to market of open position, so it'll go over your initial position size. But so that's a strategy that can be used. Now, this is a very well-known strategy that is probably the closest to the spirit of what you guys are doing with growth investing, which is the NASDAQ rotational strategy. The example I include with real test uses, you can only see part of it here, but it's literally the formula that IBD uses to calculate relative strength. So once a month, you take all the current constituents of the NASDAQ 100 as of that month, and you rank them by relative strength factor. And you always want to be holding the top 5. If one of your holdings is no longer in the top 5, you sell it and you buy the other one that is. And that's it. Now, a key point in testing that this is the main reason I recommend Norgate data is you can see that the include list is NASDAQ 100 current and past, and that the can hold formula includes in NDX, which means the stock was in the NASDAQ 100 on that date in the past. Because if many people make the mistake of taking the current constituents of an index and building a backtest with them, that if you do that, you're looking ahead to who's going to be added to the index in the future, which would be awesome if we could do it, but we can't. So that's the main reason it's critical to have historical index constituency if you want to test and trade this kind of strategy. So this, for the same drawdown as holding SPY, you get like 3 times the return. So it's quite a popular strategy. The main question, I think, for an investor in this is, what portion of your account are you comfortable allocating to it, given that each position is, if you put your whole account in this, you're putting 20% of your account in each stock, which is, can get a little volatile when you're holding, Tesla, Nvidia, et cetera. But that's that strategy and can be played with. Now this starts to get into how real test can combine things. So this script, which is one of the examples, combines that NDX rotate that I just showed before, which is the blue line, with the VIX long short that I also showed before. This time it's only putting 10% of the account in the VIX, and it's putting 30% in each of these other 3 strategies. And then the other 2, I just thought of some simplistic things to toss in. Neither of them is anything to write home about. And one is a simple asset class rotational thing, which is SPY, gold, and PLT, or stocks, gold, or bonds, and basically rotating that entire strategy into that asset each month into whichever one has the highest 50-day return. That's that setup score. ROC C50 means select the one with the highest 50-day return. And the Dow weekly pullback is some kind of simple 5-week mean reversion concept on the Dow that, I just kind of tried a few things till I found something that was profitable and threw it in here. My goal in this script is to show how combined strategies, they don't all have to be great, and they can have fairly wobbly equity curves, but the combined equity curve comes out smoother. And the stats aren't bad. Here's another strategy combination concept. This one is trading the S&P 100 historical constituents. And it's 3 different trend following strategies that they're all similar, but just have slightly different parameters. The idea with this is, rather than optimizing a trend following strategy for one set of parameters, you pick 3 that are somewhat different and just combine them with each with 1/3 of your account. So they're all trading the same universe. So they're all pretty highly correlated, but still the overall stats will be a little bit smoother than either of them separately. So this shows how that kind of thing can be done. Now this is a very new concept in real tests that actually the users don't even have yet. I'm still working on this version, but it's this thing. I've been working with a new user who wanted to be able to test this kind of thing. And the idea is to be able to, for a given portfolio, find the least correlated set of stocks in that portfolio. So you pick one, maybe you pick the one that has the lowest average correlation to all the others. And then you pick the next one that has the lowest correlation to that. And then you pick the next one that has the lowest correlation to the 2 you've selected so far, and so on until you've built up to your portfolio. In this case, it's set to 10 positions. So what this does is it rebalances every week to hold the least correlated possible portfolio within S&P 100. And it's really just a demonstration of that capability of the software. I'm not sure yet what the best way to use it is, but this comes out with stats that seem pretty good, especially the drawdown looks fairly modest, which is what you would hope with trading uncorrelated assets. Here's another example. There are a few examples that come with real tests where I've taken a strategy from a book and implemented it. This is a book called Stocks on the Move by Andreas Flanau. And it's a little bit complicated to implement this strategy because first of all, it involves a complicated ranking factor, which he calls annualized slope and or adjusted slope. And then it uses dynamic position sizing, where you're periodically readjusting your positions based on volatility, which is something that modern hedge fund managers tend to do more. So that's the results that has produced. Okay, and this is a Nick Raj strategy. Nick is a user of Realtest and someone I've worked closely with on a bunch of stuff, and I'm very grateful for his support of my software, and I recommend his services, which are at thechartist.com.au, I think is the URL. Just Google Nick Raj, you'll find out all about him. This is one that he published in a book a long time ago, I don't know, 15 or 20 years ago, called Weekly Trend Trader. And it's a very simple weekly trend following strategy that his book uses the Australian market, but seems to work well on Russell 1000 constituents. That shows the stats over time of that strategy, which is also in Realtest. There's another one of his in Realtest as well, which is Bollinger Band breakout strategy. Now we get into one of the more interesting examples. I have an example mean reversion long short strategy pair, which was basically the first example I provided when I was first getting ready to release the software. And it kind of represents when I first added mean reversion to my own trading in 2014. The strategies were something like this example, and they worked pretty well for quite a while. Now, I put in this example in 2019, I think. And what was interesting about it, you can see that plunge in the blue line. That is when the short strategy shorted GME in January of 2021. And pretty much made the worst possible short trade. Like most mean reversion strategies, this one does not have stops. So, that shows that there's this hidden tail risk, as I like to call it in mean reversion, that you have to watch out for. Now, this particular example, I think, is a little bit contrived, but I wanted to show it because it's something people often want to test and is interesting. So the concept here is you take the basic strategy and define it as a benchmark, and then use the stats of that benchmark to turn the strategy that you're actually trading on and off based on their equity curve. Like if the equity curve goes below its moving average, you can turn off that strategy, and if it goes back above, you turn it on again. So the red and orange lines are the actual live strategy that would have been traded. And as you can see, the orange line conveniently turned off the short side. I mean, it took a little drawdown, but it missed the big one. Of course, there are other parameters where it wouldn't have been so lucky. So I don't think this is a panacea for avoiding the next meme stock squeeze if one happens again. He tried another one recently, but it didn't really work. So anyway, but this shows how, if you've been curious to test whether using your own equity curve is a good on-off switch, this example shows how to test it. There are a bunch of other examples based on this same pair of mean reversion strategies. Now this is another concept of a shorter term mean reversion strategy that I refer to as MOC, because it's a day trading strategy that can be traded on daily bars, in that there's only one exit rule, which is market on close, and the entry is done on limit orders. So the idea of this strategy is every morning you place a bunch of limit orders to buy this example is long only. So to buy, it's some price below. You're basically looking for stocks that have sold off, and then you're setting a limit order even below yesterday's low. So you're really trying to catch the falling knife on the ground, so to speak. And the risk is relatively low compared to multi-day mean reversion because you're always exiting that day at the close. So you have no gap risk. But it's a fairly low expectancy strategy with a high trade frequency. And like the example earlier with the S&P 100 trend following, this one takes 4 different flavors of the same strategy and combines them. And it does so. Realtest has the ability, which I call top-down setup selection, to basically have the strategies take turns, each selecting their next best setup, while making sure 2 of them don't trade the same symbol, so that you avoid single stock concentration risk and you stay more diverse. But so this script demonstrates that capability. And yeah, like many things, I was trading in my best 12 months ever, which was the middle of 2020 through the middle of 2021. I was trading long short MOC strategy pair and a long short multi-day mean reversion strategy pair, and my IPO strategy and another short-term trend following short strategy, all together, so 6. So I've used this type of strategy before. I'm not running them now. This is a strategy that where you can see where around where the pink line is. Somebody on the forum just made a post saying, "Can you show me an example of a strategy that has a 30% return and a 15% max drawdown, or a system?" So I came up with this, combining a long short multi-day mean reversion and a long short one-day mean reversion. And it didn't take me too much tweaking to get the stat that were requested at that time, which was like sometime in 2021. And whether because I don't think it was especially overfitted, but maybe a little. But the main thing that's happened is since 2022, the market has not been as supportive of short-term mean reversion as it had been for many years previously. That's reflected in that equity curve. So the 2 rows of results, the first one shows the test ending at the end of 2021, which shows how it met the return goal, or fairly close. And then the second one shows the overall stats continuing to the present, where it shows the recent deterioration. Still not bad stats, but there it is. Just for kicks, I threw in a classic futures trend following strategy. Realtest can test futures. It can mix stocks and futures in the same test, whatever you want to do. This basically trades, most of the futures on the CME. And it shows, as is well known, how that classic futures trend following type strategy, let's see, in this case, it's using 126-day or half year breakout and trailing with a 3 ATR stop and risking 0.5% of your account on each entry. So with that particular futures universe, that's the stats that would have produced. And it shows how these classic trend following strategies had almost like an 8-year period of basically flat results, and then started to kick up and had an especially good year at the start of period at the start of 2022. And the recent spike this year is cocoa. So that's that one. Okay, now this is the same strategy I showed in the live demo, but run all the way to the present. And you can see how the first period from the late 90s until early 2000s was really spectacular results. and then kind of got flatter and then got really flat. But then surprisingly, in 2022, after being flat for a long time, it started working. And I find it very curious. It's probably just random, but that similar pattern to futures trend following, which has absolutely nothing to do with this strategy. Why it happened to start working in 2022. I don't know. Now I would never trade this exact strategy now because it had a lot of weird things about it, including a very strange position sizing approach of trading the same number of shares on every position, regardless of price, as long as it was between 10 and 80. But that's what that test looks like. Now, moving on, the next couple I'm obfuscating the code because I may use them, but this is an adaptation of that same strategy that I've been working on, where I fixed the position sizing anomaly so that it uses volatility-based position sizing and do a few other tweaks. And I'm happier with, in this one, the short curve looks nice. The long curve looks kind of all over the place. This one, they're kind of better balanced. I like to, if I'm trading a long short system, I like to see the two curves cross each other frequently so that they're, and the results are kind of, the combined results are a bit smoother. So I may consider putting something back in this one. It's a little, it kind of requires using your whole account to get these results. I prefer to combine things that trade less frequently and use less of your account so you can combine more strategies. But I'm looking at this. This shows that prior system combined with my current long and short mean reversion system, just going back to 2014, how that combination theoretically would have done. And this is non-compound. I personally like to run all my back tests without compounding, just so that the positions are all the same size. And especially when you start getting into like 30+% rate of return, you don't get these stupid numbers that will never be achieved in real life in the millions. So these stats are starting to look pretty palatable to me. So I'm working on that at the moment. And then as a added bonus, since this seems to have come up on Twitter recently, I threw in my IPO strategy, which I'm no longer trading. I think it's probably permanently broken, or at least we'll see. I mean, if it seems that fewer and fewer companies are doing traditional IPOs, there's all these other ways that venture capitalists can get their exits now. It had that phenomenal run during my best period of mid 2020 through mid 2021, and then it's kind of chopped around after that, and it's just been declining since then. Now, that if you look at the stats, you probably wonder, well, why was I ever trading this? I mean, they used to be better before the last couple of years, but still, they weren't spectacular. But look over here, average exposure 15%. I can combine this with a bunch of other strategies, and it had a really nice additive effect. Because when you do combine compounding, if one strategy makes some money, the others can take larger positions the next day. And conversely, if a strategy takes a big loss, the others will reduce their positions the next day. So it's everybody sharing the same account. It's analogous to running a bunch of strategies, each in their own account, and then transferring cash every day to rebalance them. But you don't have to do that when you trade them in the same account. And the software can keep track of it all. All right. So in summary, as I get near the end here, so you could probably pick up from that. Systematic trading is not a path to quick wealth, but it can be a way to ensure long-term consistency in your trading process and maybe its outcome. I would say, unless you enjoy the activity of strategy research more than you enjoy hunting for specific trade opportunities, it's probably better to stay discretionary if you're kind of trying to decide. Just a kind of a random thought, remember to focus, if you are doing research, on discovering what doesn't work and why, not just looking for what does seem to work. Just kind of general advice. These are just some other resources. I would listen to a lot of podcasts. I really like podcasts. I'm aware of at least 3, probably some others that are specifically about systematic trading. So I put the links in here. The algorithmic advantage one is relatively new and is really good. I recommend it in particular. They recently interviewed the author of the Jim Simons book and had a really good conversation with him. I have also a page on my website that's listed here where I have some other resource links, like things like the Chartist and Rob Hanna's quantifiable edges and other offerings by people who use Realtest, some courses, consultants who might be available if someone wants consulting help and so on. And finally, the most important resource is your own attentive interaction with data and software to experiment with ideas about market price behavior. There you go. Finally, these are all the links for anyone who doesn't know how to use Google. And that's a wrap.
Marsten, thank you so much. It's so cool to learn about, almost this other path to trading. It's like, it's obviously there's the core principles that are shared, but it's very different than kind of what I usually do and what I'm sure a lot of people watching do as well. So it's really cool to hearing your process. I do have a fair number of questions here that I hope we can dive into. I see we've got a little bit of time, which is great.
Sure.
First things first, and I'm sure that the podcast that you mentioned there may be a part of this. How do you kind of come up with ideas for different strategies that you want to eventually test and use Realtest to take a look at how they perform?
I've come up with relatively few ideas in my life, unfortunately. The long short pair that I traded starting in the late 90s was not original. There was a guy named Gary B. Smith who was writing a column on thestreet.com called Technician's Take. And he was unusually open about what his trading strategy was in some of his columns. And that I happened to come across him right when I was looking for to make my own trading more systematic. And I started corresponding with him, and we ended up becoming trading partners for a couple of years. And it's basically that MHP Classic so-called trading strategy. I mean, he used to refer to it as GBS Classic in his own writings. That's where the word classic comes from, is the concept that I got from him. So over the next many years, the main thing I did was just tweak that. When the performance was really deteriorating in 2012, 2013, I had never been part of an online trading community. I mean, there weren't any such thing when I first started, but I looked around and I found Stockbee, which is, I know you've interviewed him, Pradeep. It's discretionary, but they were trading the same kind of setup, the same kind of breakouts derived from William O'Neill's work that I had been using. And so I thought, all right, let's join this community. And oddly enough, I came across the idea of mean reversion trading in that community, even though Pradeep doesn't use it at all. But some of the other members kind of pointed me in that direction. And so that was the next big thing. And that wasn't original either. It's really just derived from the work of Larry Connors. And then I got the idea of focusing on recent IPOs from someone else I met in Stockbee, who you've also interviewed, who goes by the name of Scott One AND, although his name is not Scott. And so he got me focused on IPOs, and I helped him with a few TC 2000 scripting things over the years too. He's a good guy. And so, there's really been relatively few things. I mean, all the ideas you can come up with are going to boil down to some flavor of either momentum or mean reversion. Those are kind of the only two factors really out there. So, you know, you can look at different trading universes or subsets of the universe. I mean, the IPO strategy was using the same concept kind of that I already had, which is breakouts, but on a subset of the universe. So that's another way you can look. But yeah, podcasts, magazines, books. But yeah, there's really kind of nothing new. I mean, I try to include all those example scripts in real test to give people a good starting point. You know, it's pretty much every systematic trading idea I know of is represented in those scripts somewhere or another.
Yeah.
And it gives you a lot of material to experiment with, find the combination that resonates with you. There are some, Nick Raj offers a mentorship program that's a lot of my users have taken and like, that really gets into the weeds of systematic trading and strategies. They have recently converted their entire educational offerings from Ami Broker to Realtest. So that's a possible resource for people interested in this.
Yeah, great. And when you're designing a system, whether it's something new or something that you've learned from somebody else, I wanted to ask you kind of what metrics do you kind of optimize for? Because obviously there's always trade-offs based on what you're doing. And I also saw, of course, your MAR ratio. If you could kind of talk about that and kind of the methodology behind that ratio, if that's one of the ones that you focus on, which
Yeah,
likely it is based on your
I
name.
mean, basically, some people who are involved in the systematic space get into really complex metrics, and I generally have not done that. To me, the most important metric is net profit. I mean, in the end, you want to know how much money the thing is going to theoretically make you.
Mhm.
The you know, but of course you have to be able to tolerate the drawdown as well. I mean, kind of my rule of thumb, what I'm looking for is a strategy or combination of strategies that I'm confident can return more than 20% without having a 20% drawdown. So I'm looking for a 1 or better MAR ratio, and
Mm.
which is hard to do actually. So that's kind of what I want, and then within that, you know, it's kind of a judgment call. I'm looking for what seems the simplest and most robust thing that can give me the kind of stats I'm looking for.
Mhm.
I don't do a lot of optimizing. I hardly ever use Realtest has a nice optimizer, but I hardly ever use it. I use it more to kind of do basic research of, you know, how a indicator affects results. So I can understand the dynamics of it. And then from that, I'll typically pick an obvious sounding round number value that seems right, and then don't change it after that.
Yeah, and that kind of gets into a little bit my next question, like how you kind of look to prevent overfitting when you're, analyzing a strategy and determining its effectiveness. And you mentioned the optimizer. That seems like it could lead to some overfitting if you just kind of, plug that in and use the best result, as you mentioned.
Yeah. Well, I mean, there is a whole level of things that help prevent it. I mean, the most likely way to overfit a strategy is to develop a strategy for a single symbol
Hmm.
and use a lot of parameters, and run a brute force optimization. So yeah, you can find, I could take SPY and throw a whole lot of parameters at it and find something that would have been spectacular, that's utterly meaningless about the future.
Right.
Um, so the first level of defense against over optimization is trading a portfolio with the same parameters. So the first thing I do is throw out the idea that individual stocks have individual personalities, which can drive discretionary traders crazy, because I know that they believe that they do. And they probably do. But my point is, it's impossible to capture that systematically. So I
Right.
just have to throw it out the window. Uh, so trading a portfolio and then trading long short. I would say if I had to identify one key to the success that I had, such as it is, it's that I wanted to be long and short from the beginning. I wasn't content to just be long only. And then combining strategies is yet another layer, because even if some of your individual portfolio level strategies are a little bit optimized, when you combine them, you can mitigate the risk of future the parameters you've selected not being the best ones in the future.
Right.
And to some extent, if you want, you can use walk forward process, but I don't do that so much. I think the fewer of the steps I just listed you apply, the more important walk forward is. If you're just optimizing a few parameters on a single symbol, you need to test that in a walk forward way to make sure that the parameters are stable over time.
Right. No, very interesting. And maybe if you wouldn't mind, maybe showing your real test again to answer this question, if you'd like to.
Yep.
I want to. You went through the different data visualizations that you can do when analyzing a strategy. I wanted to ask you if you have, some favorites in terms of those data visualizations, and how you kind of use each one to maybe interpret the results, or come up with key ways that you might be able to improve a strategy as you create it.
Yeah, let me see. What is the best way to show that? Let's let's see. How would I should have prepared for this question. how
No,
would
sorry to catch you out of the blue
in advance, but trying to think what's a good example for that. I mean, the first thing I would be doing is just running a bunch of tests, and let me see. I don't know. Okay, let's pull up one of the examples here. Let me just put these in their own folder. I don't know. Let's take NDX rotate. All right.
And this is the one that you mentioned might be the most similar to kind of growth.
Yeah. Okay, so let's see. We're going to run this test. All right. After it unloads the massive data file from before and loads that data file. Okay, there we go. As you can see, it doesn't take very long to run tests. Okay, so let's see. So you might look at these stats and say, okay, yikes, the max drawdown's too high. And then what to do next kind of depends. I mean, that would be the first thing. I mean, I would say, nice rate of return, pretty high drawdown.
Right.
And then go look at it. Oh yeah, and switch to this. This is run with compounding, so it's switching to log scale. It makes a lot more sense. You see so many equity curves like this. Like, what is the point? If you're compounding, you need log scale. Sorry, rant over. So, the first thing to do with drawdown is look at the drawdown graph. So like in this case, you can see, oh, right, the drawdown is recent. Before that, it wasn't nearly as bad. Now, keep in mind, I probably developed this example somewhere around here, but it really has no parameters. I mean, it literally just, this is a good way to design a strategy. Just start with the concept. I said, okay, you want growth stocks. Let's use IBD relative strength factor. Everybody uses that. I don't remember why I wanted price greater than 10, but that probably doesn't even make any difference. I think most NASDAQ 100 stocks are over 10 anyway. But so one thing you can do with this strategy, okay, well, let's see. And then like if I was just thinking about trading this as the only strategy, I would look at drawdown bars and I would realize, oh, look at that. Sometime, often in the past, it's been in a drawdown for more than a year. Am I okay with that? Am I going to, turn it off at the low, or can I be confident in it? And this is another argument for combining strategies is if you're just trading one, it's harder to maintain confidence in it. Something I often do when I have a bad day in a strategy is look at something like if I have a minus 5% day, I look at something like this, like, oh, that's happened before. It's not so unusual. You know, if you want these results, you have to live through that kind of day sometimes. You know, similar with week or month. These stats are more relevant for a shorter term strategy. This one tends to hold. I mean, the average holding period is what? Weeks and sometimes years. With the shorter term, especially the shorter term mean reversion strategies like the 1 day, I look at expectancy and make sure it's not too low. You know, if you have one rabbit hole some people get into is looser and looser parameters on 1 day mean reversion. So you get this massively high trade count with a tiny edge, a tiny expectancy, and you get a perfectly smooth equity curve. But then you realize, oh, wait a minute, that assumes when you look at the fills, so many of them are right on the low of the day. So that assumes all those limit orders are going to get filled on the exact low of the day, which is a flaw in that particular approach. So you've got to find a balance where the expectancy is not super low, but on the other hand, a high trade count helps with a smooth equity curve and making the results more statistically significant. So it's kind of a balancing act there. Those are some of the things I look at. With this particular strategy, one thing you can do, the simplest way to do that is just comment out the rest of the exit rule. So it's basically, at least in the backtest, exiting all the positions and re-entering them every month, which implements in live trading, of course, you wouldn't do that. You would just do small trades to adjust them, and you can test it that way too, but I'll just do it the simple way for now. So that actually gives, shaves a couple points off the return, but it helps a lot with the drawdown. What that basically would do, like for example, let's look at the trade list and sort by I'm looking for NVIDIA here. Okay, right. Actually should have sorted by data. Yeah, I mean, you're gradually see, this is every month it's adjusting. It's keeping NVIDIA at 20% of your portfolio every month.
Right.
Whereas if you looked at this one, where's the latest one? Right. Well, okay. Yeah, the fraction shows the entry percent, but the position itself is now way more than 20% of the portfolio. So you by just holding a winner, you have an increased risk in the event of a sudden drop.
Right.
Whether you're worried about that. I mean, the other thing to look at in drawdown, I mean, if you compare this one versus this one, they're not really that different. And this is something I do a lot too. I just flip back and forth between two equity curves. And I mean, at least at this scale, a lot of times in a momentum strategy like this, most of the drawdown is giving back gains as opposed to, entering a position and immediately taking a huge loss.
Right.
Yeah, you're just giving back gains. So if you're trading trend following or long-term momentum, you have to be okay with giving back gains. You can't have the big wins without being willing to give back some of your gains. So that's how I would approach that question in this particular strategy.
Yeah, that's helpful. Another one I had was kind of from your point of view in designing these different systems. Do you think kind of the buy side rules are more important, sell side rules are more important, or kind of the vehicle selection itself that you're running the strategy on? And for sure, there's definitely nuances, and they're all important, of course. But I'd love to hear your perspective on that.
Yeah, I mean, to me, they kind of all all go together.
Yeah.
I mean, the vehicle in a portfolio-based systematic trading, there's not a whole lot you can do with vehicle selection. I mean, basically, is it in whatever universe you're trading or not?
Right.
You know, you can rank by whatever you want to rank by. I mean, in this particular strategy, vehicle selection is ranked as whichever has the most momentum. You know, you can, some other strategy you might want to rank for low momentum, or you might, in meaner version, you're typically ranking for short-term extremeness of a short-term move, you know, which indicates it's the most likely to reverse
Right.
soon. You know, so vehicle selection and portfolio-based systematic trading is really more about the technical concept that your trading system is based on rather than anything else. You know, another mistake I see some people make is to like hand select a bunch of symbols that have done great recently and then backtest them in the past. Like, yeah, okay. Would you have selected them 5 years ago? No, you would have taken whatever was hot then. So that's not relevant. It's one of those things. It's really that's one of the key advantages I think of discretionary traders is you can have your situational awareness that lets you know what's in play, or basically you're trying to know what other people are doing, whether you're trading systematically or discretionarily. You need to know. You're trying to anticipate what other people are going to do because that's the only way you can make money. So it's kind of a more abstract and fuzzy concept in systematic to somehow encapsulate that in code.
Yeah.
You're limited in how much you can do. But in terms of the entry or the exit, it depends on the strategy type. You know, like if you take my 1-day MOC example, you know, the exit is just set, it's MOC. So that one is all about the entry. You know, if you're fine tuning that strategy, you're basically saying what setup criteria and limit price distance, which is sometimes known as the stretch, provides the best results, knowing that you're going to just exit at the close. When you get into multi-day strategies that might have like a target and a stop and a time stop, and then some setup rules, you know, you have more knobs to tweak, more chance for over optimization, but you know, they tend to go together somewhat. It's a good idea to use to incorporate ATR, like rather than measuring specific price points or specific percentage distance, do it as multiplier of ATR.
Yeah.
So then, you know, your more volatile stock, each stock will be given similar amount of room relative to how it has tended to move recently. I think it's important to keep look back lengths consistent with how you want to trade. You know, like if you're trading a strategy that holds 1 to 3 days, it doesn't really matter what the 200-day average is or the 50-day average necessarily. I mean, unless you found some edge where a lot of other people are making short-term bets right around that average or something, but
Right.
not too likely. You know, tying this question back into your prior one about where to get ideas, you know, the more you can learn about what other people are doing right now, the better, because you know, the only way you can take money out of the market is to take it from somebody else. So if you know kind of what other people are focused on, that it might point you in a good direction, idea wise.
Yeah, a lot of great nuances there. Thank you. I'd also wanted to ask you about, you know, you showed a few strategies that, you know, seemed to be compounding great or had really strong performance and then started to kind of deteriorate, you know, in recent times or something like that. Um, what kind of creates that phenomena and like how often do strategies lose their edge? How long does a typical strategy, you know, seem to work for? Again, there's probably, you know, a wide variety there, but I'd love to hear your thoughts on kind of different strategies that you try. You know, maybe you back test it, it works great, but you know, in reality or shortly thereafter, it stops working. How often you would, you know, just look elsewhere for a new strategy if you started to experience something like that?
Yeah, I mean, that is a tricky one. My main experience with that in early on in my long short breakout strategy, I went through many iterations of over optimizing them and then finding it didn't work as well. And having a drawdown, my basic pattern was wait for a 20% drawdown and then re-optimize and find a new version that wouldn't have had that drawdown, and continue. And and that process sort of worked well enough for a while. Not as well as that backtest I ran did better than I did in real life over that period, using basically the same system, but by just picking an average range kind of set of parameters and keeping them constant.
Right.
If I had known in advance that was a good thing to do, I would have done it. So the more parameters and the more knobs your system has, the higher chance that it'll stop working, because its past performance depends on what the knob settings were, unless it's really highly robust and there's a wide range of settings that all the results were good for. And it's good to look for that. And then if you have that, you can just kind of pick a median setting and leave it alone. But so that's one reason they'll fail. And I would say if a strategy has very few knobs like the NDX rotate, even when it's in a 50% drawdown, it's not necessarily a failure. I know some people, including Nick Raj, who I mentioned earlier, who trades this kind of strategy and had a horrendous drawdown in 2022 and 23, but just kept going, and it's had a tremendous rebound now as a result. And you have to have confidence in the idea underlying the strategy to do that. And in this particular one, there are basically no parameters, so it's easier to do that. The other reason I've stopped trading my IPO system, and because I think the underlying reason it used to work is no longer there, because the companies don't have to have IPOs anymore.
Right.
So sometimes it's something like that. In the case of my older long short strategy, I was aware over time that executions of other participants were getting faster and faster. When I first started in the 90s, like if a mutual fund, there weren't even ETFs yet, except for SPY. If a mutual fund wanted to get in and out of a trade, they would tell their trading desk and they would execute it over several days manually.
Right.
And so that kind of dynamic gradually speeded up, because of the evolution of execution technology. Computers got better, execution algos got better, brokers offered more algos. The whole concept of VWAP didn't exist in the 90s, and now everybody just tells their broker, get me VWAP on my position and blah blah blah.
Yeah.
So that led me to, the version I demonstrated actually does all its transactions at the next open, and which it turns out can work fine. But I found it would have been better at one point to anticipate them at the close by using live data, and did that. And then I started anticipating earlier in the day by using live intraday data and projecting what the closing volume would be. And so I made adaptations like that based on what I observed was happening. So sometimes it's observing a change in the market. I guess there's a sort of situational awareness at a meta level that applies to systematic as well.
And I'd be curious to hear your take on this. How important do you think it is for systematic traders to, kind of understand a lot of discretionary styles? Like you being in the stock beat community, you're exposed to a lot of ideas throughout that. And do you think, people should kind of trade discretionally before they kind of dive into becoming a systematic trader and adopting some of those strategies? Do you think that's a kind of benefit?
I would say so, at least for some amount of time, or at least spend some time watching the market. You have to take an interest in the market in general, and, check it daily, maybe, and even spend some time watching it intraday. And there's no better way to watch it than to try to trade. I think everybody should try to day trade at some point, preferably with a small amount of money. And I'm not a big fan of paper accounts, except for I use Paper Trader to make sure my automation software doesn't have bugs, but that's different from using it to actually try out strategy ideas and understand how they work, because the IB paper accounts do a very poor job of simulating limit order fills, for example. But still, I mean, you can start there. I mean, it's important to get a feeling for for how price moves, and it can give you ideas. Sometimes if I'm not sure why I didn't get the fill I thought I would get on a trade, I'll go look at time and sales and understand what's happening. You got to understand something about market microstructure, even if you're not a high frequency trader, I think. So yeah, kind of the more information you can gather from the more directions, the better you're likely to do, probably.
Yeah, great. And
the only thing, I mean, I would add, some discretionary traders have tried to systematize what they do, and it often doesn't work because, well, first of all, because my personal belief is that situational awareness is the number one factor for discretionary trading success, more than whatever the setup pattern they're using. It's more about when to use a setup than what the setup is. Because if you backtest a setup, you're backtesting it on every possible instance. Whereas when you do the usual discretionary learning exercise of going through a lot of charts looking for your setup, and basically when people do that, they're looking for instances where it was a winner, and they're overlooking the cases where it was a loser, because those are harder to spot. They just look like noise on a chart.
Right.
But when you use a back test, you find a lot of those losers that you wouldn't have necessarily spotted. So discretionary chart-based setup concepts, especially if they're a little vague or involve a little visual judgment, that's a nice looking setup. That's not a nice looking setup. Yeah, can you codify that? It's very hard to do. So on the systematic side, you end up coming up with really simple rules that approximate it. I mean, I did that in the breakout strategy. I mean, Gary Smith had this really specific way, like he wanted to break out to a new high after 20 days of congestion that had a certain look to it. And I made a number of efforts to encode exactly what that look was as an algo. And it's, the more detailed I got it, first of all, you end up getting hardly any trades because you get too specific. And then as you experiment with tweaking the parameters of that, you find it actually doesn't make any difference. Objectively, the way a chart looks doesn't really make a difference. So you try to find a simple thing that just expresses the concept. So for example, in that one, I came up with, it was below the 9-day average and it broke, and the 4-day average breaking above the 9-day average ended up kind of encapsulating. It found a lot of the charts that he was finding visually. So you look for a proxy like that that's close enough.
Cool. Yeah, that's super cool. And just to kind of close things out, you kind of touched on it a little bit there, but if someone wanted to get more involved with systematic trading, what would be kind of your suggested path for getting started? What tools might they use? What resources should they take a look at? You of course had that slide up prior, but yeah, I'd love to kind of hear if you're first getting interested in systematic trading, where do you kind of start?
Well, that's kind of an easy
big
pitch to
question.
hit.
Yeah.
I would recommend going to my website and downloading the real test free trial and playing with it and joining the forum and see if it resonates with you. Or I mean, there are different online sort of free backtesting tools you can play around with. I think TradingView has single symbol backtesting, but not portfolio backtesting last time I checked. But as I said in one of my slides, it's good to just to get in the water a little bit and see if it feels right to you. See if you enjoy the process of sitting there trying new ideas and running tests. So a lot of people get very addicted to this back test, retest. I think I have some spouses that aren't too happy with me, but yeah, just trying it, getting in and playing around with, basically playing around with code and data. I mean, another way more and more people are doing these days is using Python, because there's so much open source software available, and nowadays you can just ask ChatGPT to write Python code for you, and it does a decent job. And that's another approach. But it's helpful to be able to quickly see the results and drill down into the results and see the trades, open a trade on a chart and see where the entry and exit were. It gives you a much better feel for what's actually happening, or whether your rules are doing what you intended them to.
Right.
So yeah, that's my suggestion. Dive in and try it.
Perfect. Well, Marsten, thank you so much for your time today. I really enjoyed this, especially the Q&A. I love the nuances you shared there. So thank you very much for being a part of this. To everybody watching, I hope you're enjoying. Make sure to thank Marsten in the chat. Leave a like down below if you enjoyed as well. Subscribe to the channel. And Marsten, thanks again, and we'll be right back with the next presenter. Cheers.
Thank you so much, Richard. It's been a pleasure.
Awesome. All right, welcome back, everybody. It's my honor to introduce our next speaker, Dr. Brett Steenbarger, a professor of psychiatry, author, experienced trader, and performance coach and psychologist for professional traders in hedge fund and proprietary trading settings. Dr. Steenbarger is an expert in trading psychology, and today he'll be presenting on the fascinating concept of turning personal strengths into trading strengths. So Brett, thank you so much for your time, for being here. Please, everybody in the chat, give him a warm welcome. Leave a like down below in the video. And Brett, thank you again for being a part of this, and looking forward to your presentation.
Oh, thank you very much, Richard. I really appreciate the opportunity to be part of this event and part of the community. We have a different topic today, one that doesn't typically get discussed. And that is the application of what is called positive psychology to the trading world. And so you can see from the title slide, positive trading psychology, turning personal strengths into trading strengths. Now, before we launch into the body of the talk, let me kind of set the framework. I'm a psychologist. I've worked with traders for years and years and years. And when I come into an office, let's say the hedge fund, and someone meets with me in the office, and I say to them, what brings you here today? What's going on? Inevitably, what they will bring up is a problem. Some problem with their trading. Maybe it's a personal problem that's interfering with their trading, but their focus is on a problem and solving the problem. In positive psychology, we take a different focus. We're looking at change not by solving problems, but by maximizing strengths, by maximizing positive aspects of who we are. And we'll get into the difference between those two, but it turns out it's really, really important. If you're a trader and you have problems, you can solve your problems and then you're relatively problem-free. That by itself is not going to make you a master trader. It'll make you a trader with fewer problems. What's going to really distinguish you is if you can leverage your strengths into the trading arena. Okay, so you see my name, Brett Steenbarger, and there's the blog URL, traderfeed.blogspot.com. And there are many, many articles on TraderFeed. I've been conducting that since, I think, 2006. And so if you just Google any topic in trading psychology and put TraderFeed next to it, so discipline, TraderFeed, you'll see articles on the topic that you might be interested in. So let's launch. The positive paradigm. What makes positive psychology different from the traditional version? One immediate difference is what's known as the solution focus. Solution focus means that we don't look just at problems. In fact, we become very interested in what's going on when there are exceptions to our problem patterns. So you might come in and say to me, oh, my spouse and I are having arguments and fights, and it's really disruptive, and it's getting in the way of my trading, and I don't know what to do. I don't want to leave my marriage, but it can't continue this way. And as a solution-focused, positive psychologist, I might ask the question, well, tell me about times when you and your spouse are getting along really well. Tell me about times when you felt very close, when you've really been in love. What has your spouse been doing during those times? What have you been doing during those times? So we start investigating the relationship at its best and reverse engineer, what are people doing when this thing's working? So the slogan in solution-focused psychotherapy is do more of what works rather than problems. So the application to trading is pretty apparent. Someone comes in and wants help with their trading, and instead of delving into why they're going on tilt or why they're missing trades, tell me about times where you're trading really well. You caught that trade really, really well, and you exited really, really well. How did you do that? What were you thinking? What were you doing? And gradually, as we look at one success after another success after another success, we come up with an idea of our best practices, who we are at our best as a trader. And we build on that. So it's a different approach to trading psychology. It's one where we are cultivating our strengths. It's one where we are setting visions, not just setting goals. In traditional psychology, we might have goals of, sizing things properly, not going on tilt, et cetera, et cetera. But what is your vision for how you are developing yourself and this business that is your trading? One thing I emphasized recently on the TraderFeed blog is that trading is your business. You are an entrepreneur. Your trading is this is your startup. So what's your business plan? What's your future going to be? How will you know you're successful? Any entrepreneur needs not only some goals, but a vision to get better and better and better at what they do and to inspire their efforts. And finally, from a positive psychology vantage point, we want to think about how we are leading our life. Our life, I wrote about this some years ago in a Forbes article. Our life consists of many different components, many different activities. We have relationships, we have personal activities, we might have trading, we might have a career outside of trading, we have a family that we raise. We have lots of different facets to our life. So from that vantage point, our life is an organization. We have all these different pieces that we have to put together into a whole. And What's our role in the organization that is our life? We're the leader. We are a leader of our life. We're not just leading our life, carrying it on. We are leading an organization. So how do we lead our lives? What kind of leaders are we? How organized are we? How motivated and motivating are we? Many times when we look at how people are carrying out their lives, it's sort of on autopilot. They don't necessarily have goals each day, each week. They're not waking up and saying, what's going to make today a really successful day? What's this week going to be about? How am I going to grow this week? That's the kind of question that you would ask if you're the entrepreneur of your life. So let's take a look at strengths. And what I've put down here is a short version of what's called the VIA, Values in Action, Strengths Assessment. And this is a questionnaire that defines 6 types of strengths, 6 broad areas of strengths. The first is wisdom, courage, humanity, justice, temperance, and transcendence. And then there are a number of individual strengths within each of those categories. So for instance, with wisdom, creativity is an aspect of wisdom. Temperance, self-regulation, discipline is part of temperance. Transcendence, spirituality is part of that. So the question becomes, what are our strengths? And for people attending the presentation, I would encourage you to scan this list and identify your top 3 strengths. Not only the categories on the left, but the individual items next to them. What are your top 3? And then what are your next 3? That second layer of strengths is known in the research literature as latent strengths. Areas where we're developed, but they're not our major areas of development. So for example, creativity, spirituality, and love of learning are probably my top 3 strengths. A latent strength would be teamwork, kindness or love, the humanity category, probably gratitude. But notice how my latent strengths are much more interpersonal. Teamwork, leadership, kindness, as opposed to creativity, love of learning, which are more cognitive strengths. And so as you look at your chief or your top strengths and your secondary or latent strengths, you'll see some differences, and that's going to end up being important to your development as a trader. So what's some research in psychology about strengths? There's a ton of research going on now in positive psychology. A recent review of the literature found that there are over 1,000 research articles published each year on the topic of positive psychology. So it's an immense area of growth. One finding is that overutilizing our strengths can create weakness. In other words, we can become so attached to a particular strength that we have that we make too much use of it and we become imbalanced. So leadership might be a strength of mine, but I get so caught up in being a leader and in wanting to lead people that perhaps I stop doing a good job of listening to people and following them. So we want to use our strengths actively, but in a balanced way, not overutilizing one. What the research literature tells us is that our growth often comes from making use of our latent strengths. When we are confronted with a situation that we have difficulty dealing with, many times that's a challenge to cultivate that second group of three that you identified. So recall that I had mentioned for my strengths, things like creativity and love of learning, and a latent strength might be something like teamwork. So if I'm running into a problem, figuring out what to do in markets, the answer might not be to do more research, do more research, do more research, which would be my chief strengths. It might be to engage others and learn from them, learn with them, and broaden myself out that way. So we grow by building on those secondary strengths. The research also tells us that performance is enhanced when we benefit from the strengths of others. And in fact, there's very interesting research on teamwork and what makes teams effective. In the hedge funds where I work, much of the work is conducted within teams. And so it's not just helping individuals with their trading, it's helping teams generate better ideas, manage those ideas better, and so forth. And so the research suggests to us that if we have teams that consist of people with different strengths, the team is likely to be a stronger team. People aren't just clones of the portfolio manager. They have different skills. Maybe one team member is very good at quantitative analysis. Another one is an expert in a particular region of the world, maybe emerging markets, LATAM. So you have different people doing different things, focused on different things. The way I put it when I talk to the teams is, everyone on a good team, everyone has to be better than everyone else in some area. So now you have a team, not just of a leader and a bunch of followers, you have experts in different areas who inform each other and help each other. An exercise I like to do with people to help them identify their strengths, I call the sine wave exercise. You draw sine waves on a piece of paper. The peaks of these sine waves are the peak experiences of your life. What have been the most positive and the most meaningful experiences that you've had in your life? And then the troughs, the down parts of the cycle, those are the worst experience of your life. The most painful, the most difficult, the most challenging. So you're really looking over time, wave after wave, the most positive experiences of your life, the most negative experiences of your life. And then once you finish that, you look across the peaks and you look across the troughs to identify the themes. And many, many, many times, you will notice what your strengths are, who you really are, what really drives you, what really motivates you. It's interesting, when I recently did the sine wave exercise, almost all the peaks and troughs were about relationships, personal relationships. So even though in my head, I identify my strengths as generating ideas and doing research and being creative, in fact, what the sine wave exercise was telling me was that my ability to attach to other people was really the main driver of my life's fulfillment. Now, one of the chief researchers in the area of positive psychology is Richard. I'm sorry, it's Martin. You're Richard. It's Martin Seligman, and he describes psychological well-being as 5 factors, PERMA, plus another factor. P stands for positive emotional experience, being happy. Engagement is the E, being really involved in life's activities, not being isolated, not being passive. Relationships is the R, being close to others in ways that are enhancing for us. Meaning is the M, doing things that are meaningful to us, that have a purpose of value to them. It's not enough to have positive emotion, to have fun doing what we're doing. We have to be doing things that speak to us, that are meaningful to us. And A, accomplishments. It turns out that an important aspect of our overall well-being is feeling like we've gotten somewhere, like we've done something worthwhile. The plus is our physical health and well-being. There's lots and lots of research that the state of our body affects our overall emotional state. And so if we are trying to maximize our positive psychology, we also want to maximize our physical health and well-being. So an example of that, a very simple example of that is I make it a routine to go to the gym 3 times a day. And in my home in the basement is a gym that I use on the other days. And that's part of energizing myself. That's part of staying in shape. Other aspects involve, you can see from my watch, tracking the quality of my sleep. So the quantity and the quality of the sleep. Eating in healthy ways, so that I have as much energy as possible. Without that physical energy, we could be doing positive things in markets, we could be doing positive things in our lives, and yet we don't have the same level of positive experience. Okay, so let's take a look at positive psychology and trading. So what I'm going to suggest is that our ideal trading process is an expression of our strengths. That we can learn chart patterns, or we can learn trading techniques from a guru, from some class we take, whatever. But it's how we trade and the degree to which we make use of our strengths that will determine our success. So for example, in my trading, I trade the stock index futures, and I look at high frequency data about the buying and selling in those futures contracts. So one of the things I look at would be every transaction that's occurring in the ES contract. And is that transaction occurring at the market's bid price, or is that transaction occurring at the market's offer price? In other words, are sellers dominating, are buyers dominating? And I'm looking at every single transaction and aggregating that over time, and I can see shifts in the lifting of offers, the hitting of bids. I see sentiment shifts moment to moment to moment to moment to moment. That is making use of the exact same strength that I have as a psychologist. Because as a psychologist, what am I doing? I'm listening to people, and I'm catching the flow of what they're saying and the tone of what they're saying, and I'm figuring out what they're going through. And at some point, I can identify a big issue, and then we get into it. I'm listening to the market in exactly the same way. That's a strength that I have. That's a way of processing information that I have. For someone else, they may have a very different way of processing information, a very different set of strengths. Perhaps they're much more analytical. Perhaps they make use of quantitative methods to decide when to enter and when to exit. So you want to take a look at your trading process, and can you link that to who you are at your best, to your strengths? perma trading, I put down. Our states determine what we process. The research here from Dr. Barbara Fredrickson is called Broaden and Build, that when we are in positive emotional states, when we are in positive physical states, when we're maximizing our strengths, we literally can process more information and we process it more broadly. We see more things. When we are in a negative emotional state and physical state, it's like tunnel vision. We see like a quarterback that only sees a part of the football field. And so our states determine what we process. And being in an ideal set of states, by maximizing our strengths, we're able to see markets much better and much more broadly. The importance of cognitive strengths. A lot of times when people talk about this issue of strengths, they think about emotional strengths. But in fact, cognitive strengths are extremely important. Our creativity, our ability to see things that other people don't see, to focus on things that they don't focus on. Our ability to maintain concentration over time. Our intuitive ability to catch the feel of what's going on in markets. Our ability to multitask. I've worked with traders. Last year, Richard, we did a program with Mike Bellafiore at SMB. And I remember first walking onto the trading floor at SMB, and there were these traders who had 8 or more screens open at a time, these huge screens, and they're following different stocks and figuring out which one is breaking out, which one's moving, which one's not. That's an unusual cognitive strength. It gives me a headache just thinking about it. But they had that ability to concentrate, but yet in a broad way, that multitasking ability. Interpersonal strengths. Consistently, I find that the best traders that I work with have the best networks. They have people they talk to, compare notes with, they learn with, they rely on others to share ideas. They share ideas with them. And that network helps them not only broaden out what they do and see things that they might have missed, but it also helps them read the sentiment of the market. If there are several people who I admire and respect, and all of them are focusing on a particular market that's ready to break out, and it's an unusual focus that they haven't had before, I'm going to take that idea really seriously. What are the odds that all these different really successful traders are going to be wrong at the same time? So we can read the sentiment of the people we talk to. We can gain ideas from them. It really expands the generation of our ideas. And finally, I wrote down positive trading reviews. So often when people write journals, when they review their trading, they focus on their problems. They write down everything they did to mess up. And so their journal ends up being kind of an emotional venting. But also in your journal, you want to focus on what did you do well today? What did you do well this week? What can you learn from that success? Those positive trading reviews will teach you about who you are when you're successful, so that in the solution-focused way, you can do more of what works. Okay, this next slide is an important one, because what it is indicating is that how we trade impacts our psychology. There are people who say that we can solve our trading problems by doing X, Y, or Z with our psychology. We can learn to be more disciplined, or we can learn to concentrate better, or et cetera, et cetera, et cetera. But they're trying to use psychology to improve trading, when in fact, many times, trading better helps our psychology. And so you want to look at every facet of your trading process and ask yourself, how is this part of my trading making use of my strengths? Because if we're making use of our strengths and making use of our strengths and making use of our strengths, we're going to feel good. We're going to feel fulfilled. Making use of our strengths is intrinsically rewarding. It's intrinsically motivating. That's what the research tells us. So when we generate ideas, when we figure out what are we going to trade, what's moving, what's happening, that discovery process, how does that make use of our strengths? When we have an idea and translate that idea into an actual trade with good risk reward, how do we obtain the market feel that tells us this level's holding, we can buy here? Sizing positions. All of us have a different level of tolerance for risk. How do we size positions so that they are meaningful, but so that they fit with our risk personality? Updating risk reward. As our position is evolving, as the market is moving, risk reward does not stay constant. And so we want the flexibility to update our positions in real time. One question I will ask people if they are profitable on a trade, and they still have the trade on, is, would you put the position on right here, right now, if you were flat? And sometimes they'll look at me like I'm crazy and they'll say, hell no, it's already moved, 20%. But you need to have that flexibility to figure out how to manage the positions once they're on. And diversification. Diversification is so important to trading. And obviously, someone who is an active day trader, the people I worked with in Chicago averaged a holding time of 6 minutes per trade. If you're an active day trader, diversification is going to mean something very different than it would for a hedge fund portfolio manager. The short-term trader diversifies by trading more than one stock or more than one futures contract, but also by trading long, trading short, trading different time frames. And so they manage, through having many trades, having a diversity of trades, which is different than the portfolio manager who will have many positions on at one time. They might have a position on in stocks. They might have a position on in rates. One rates position might be directional. Another might be based on relative value. They have a position on in the commodity market. And all of those are relatively uncorrelated. So they're balancing their risks and rewards. But what that means is that they have to be diversified psychologically. They can't be locked into any one thing. That's a strength. And you want to figure out, how do I do that best? How am I best at diversifying? How am I best at sizing positions? How am I best at generating ideas? So that your trading is shaping your psychology. Doing what you do well is helping you have more energy, more focus, more motivation. So a conclusion. I'm concluding here with a question. Is your trading making you a better I don't hear that question asked very often. If we truly are focused in a positive psychology way, building our strengths, then trading should make us better as people. It's building on our strengths. It's exercising our strengths, which is very different from trading from the ego and becoming so absorbed in how much money we make and whether we're doing better than other people that we become more narrow as human beings. I have here on the slide a quote from the novelist philosopher Ayn Rand. Years and years and years and years and years ago, Richard, probably before you were born, I studied with a group around Ms. Rand, was on living life heroically, that each of us has the potential to be the hero or heroine in our own lives. And she said to love money is to know and love the fact that money is the creation of the best power within you and your passkey to trade your effort for the effort of the best among men. What she meant by that is that when we're making money the right way, we're tapping into the best power within you and the best powers of other people. That, to me, is trading making us better as people. Thank you very much.
Yeah, thank you. This is excellent. My favorite presentations always make me think, and this one definitely did. So Brett, thank you very much for your time and for putting this together. We'll kind of start the Q&A here. And first things first, like I said, this one made me think, and I've got a lot of questions here that I want to get to. But first, I want to ask you about exercises that traders that are watching right now can do to help them find their strengths and trading strengths as well, a little bit more specifically. You mentioned the process of finding your chief strengths and then your latent strengths. But when traders are kind of looking back on their trades, doing post-analysis, do you have any kind of recommendations or exercises that they can do or frameworks they can use to try to find what they're best at with regards to trading so they can go ahead and kind of focus on those?
Yeah, great question. And so this is the positive application of a trading journal.
Mm-hmm.
So just like if you were analyzing a losing trade and pinpointing what you did wrong and how you would correct that, here you are studying your winning trades, your best trades, and you're pinpointing, you're identifying, what did I do well here? I entered at this point. How did I know to enter at this point? What was I looking at? What told me that this was a real pivotal moment in the market? I sized this up, and it really worked out. Why did I size it up? How did I choose that size? What worked for me?
Right.
So you are using your own trading to identify what you did well. Now, if you do that day after day after day after day, week after week, certain common themes are going to emerge. Certain common things that you do well will appear again and again and again. And that's what I was referring to earlier as best practices. So once you generate those best practices, I'll tell you one of mine in just a sec. Once you generate those best practices, then you can create a checklist based on those and ask yourself, am I doing this? Am I doing that? It becomes a guideline to make sure that you're tapping into your strengths. So example of mine that I've talked about before is in my own market. If I trade the opening minutes of the contract, I get smoked. Like, I am no effing good at trading those opening few minutes. What I do well is sit back and let the buying and selling sort out, see how much volume is there, how active are the institutions, are they active on the buy side, the sell side, is it relatively balanced, is volume higher than normal, lower than normal, how are the different parts of the market moving? So I'm sorting out what's happening before I act. That is one of my best practices. Ironically, as I talked about before, that's also a best practice as a psychologist. Can you imagine if I start meeting with someone and I start talking in the first minute or two, and what the F? It's like, let's listen to the other person and figure out what's going on in their life. Then you'll know what to say. Yeah. So that would be an example of how we can figure out what we should be doing.
Yeah, excellent. And by the way, I'm going to add the question that you suggested to my trading journal, my daily journal. What did you do well today? Because, right now I have, rate yourself on a scale of 1 to 10. How did you trade today? What could you improve on? But a lot of that, like you've kind of pointed out, is trying to focus on the mistakes, the things we didn't do so well. But adding that question in, what did you do well today? I think that's a great way to apply kind of what you talked about today.
I like that, Richard. And you could say, for instance, today I was 7 out of 10. Okay.
Yeah.
All right. You could ask the question, all right, what would I need to do tomorrow to be 8 out of 10?
Right.
What would I need to do differently? So now, again, you're positively focused, and that becomes a goal. That becomes a focus for the next trading session.
Yeah, absolutely. And also a trend I've noticed in terms of setting myself up for success during the day is, as you mentioned, and I just want to highlight this because you did as well, is the physical health part of things, sleeping well, eating well, all of that. Over the past few years, I made the transition from the East Coast to the West Coast, and that completely changed my sleep schedule and my routines and all of that. And I had to figure that all out because it was having a big impact on how ready I felt the next day to trade, my energy levels, how much I felt like I could focus, even eating breakfast versus not eating breakfast early in the morning. You're rushing to get everything ready because the market opens at 6:30 a.m. All that really comes into play, and I saw it reflected in my daily journal, and like that was an area that I needed to improve on and focus on. So I think that physical health part is huge, as you mentioned.
Absolutely. Absolutely. And I would add, not only the physical aspect of our development, but the spiritual aspect as well.
Hmm.
I have a free blog book on my Trader Feed blog site called Radical Renewal. And it's about the spirituality of trading, how we trade from the soul, not from the ego. Developing ourselves in the spiritual way, doing things that are meaningful for us in a big life sense, for me, has every bit as much of an energizing impact as the physical exercise.
Yeah, 100%. And another thing I wanted to touch on that I really liked that you mentioned was kind of the positive feedback loop where you trade well, you'll feel better, you trade better, you feel even better. Could you kind of touch on that and maybe how traders can try to keep that going, get that kind of positive feedback loop going, and also if they kind of slip up and maybe they have a day that turns into a week where they're not trading so well, they can kind of turn that ship around and write that so they kind of get the benefit of that confidence boost and hopefully positive impacts on their trading again.
Yeah, good question. I mentioned Mike at SMB. One book that he wrote is One Good Trade.
Yeah.
And that's really what you want the focus to be. If you've gone into a patch where you're not making money, it does help to stand back and figure out, okay, has the market changed? Is something going on that I'm not taking into account? It's very common, for instance, that people will trade well, trade well, trade well. And then some facets of the market will really change. The volatility of the market will really change.
Yeah.
Correlations among sectors will really change. And suddenly what worked before doesn't work. It's not that they're doing anything terrible. It's that they haven't made that adaptation. So you want to step back and look at markets. Have things changed? I didn't suddenly become an idiot overnight. But then the focus is on one good trade.
Yeah.
Let's just take the next trade and do it well. I've been keeping my journal. I have my checklist. I know what I do when I trade well. Let's really put on one good trade. Let's wait for a really good opportunity and get our confidence back, get our rhythm back. Back in my basketball playing days, which was a little while ago, one of the things the coach would do is if a player was in a slump, he would call for a play where the teammates would double screen down and free up the player in a slump for an easy jump shot.
Mm-hmm.
Screen off the defenders. You're open for a layup. You're open for an easy jump shot. Just get the ball in the hoop once or twice. And suddenly the rhythm comes back, the confidence comes back. That's what you're doing with one good trade.
Yeah, I love that. And it's amazing how you could be going through a slump with trading and then you do make that one good trade. And it's like you finally remind yourself, you're able to remind yourself that, hey, I've been doing this for a bit. I know my stuff. I know what to do, but it just takes that one trade to kind of get the ball moving again. So I love that.
I'll mention one other thing.
Please.
I'll mention one other thing, Richard, that I've mentioned in other talks, and that is, we talked about diversification in trading, life diversification.
Mm-hmm.
If trading is my whole life, and I go into a slump trading, which I think everyone does at times, then I'm going to feel pretty bad. That's my whole life. If I'm invested in many facets of my life, in my personal relationships, other work that I do, community activity, then trading might not go well, and that sucks, but it's not my whole life. You can take it much more in stride.
Yeah.
And the way I have sometimes put it to the people I work with is it really, really helps if you have one or more things in your life that are more important to you than trading and P&L. So I have a wife of 40 years. I have 5 kids. I have 6 grandkids. And, I have an active life, teaching and working with people. If my trades don't work out, I got to learn from it and I don't like it, but it can't be devastating.
It's not the end all be all.
Not at all. Not at all. And sometimes, people get into trading and it's their end all and be all, and this is how they're going to be successful. And I'm so passionate about trading. And like, dude, get a life. Trading's important, and if you're taking it as a career, it's very important. But it's one part of what hopefully is a diversified life.
For sure. And one other thing that you mentioned that I thought was very interesting is when you're working with a lot of these hedge funds and prop trading firms, they're operating as a team and kind of bringing everything together. A lot of folks watching this, I believe a lot of our audience are kind of individual retail traders, where maybe they don't have access to that type of community or something like that. Do you have any kind of advice for people to kind of seek that out, get involved in a group where they can bounce ideas off each other, support one another, teach one another, and kind of how important is that to become a better trader and just kind of build in a little bit resilience if they do get into a slump, they've got somebody to turn to help them kind of work through it, who's kind of been there before.
Yeah, I'm glad you're bringing that up. And I think, by the way, and not to put any pressure on you, Richard, but that would be a wonderful function for your community.
Yep.
is to help people form teams within the bigger team, the bigger community, help people connect who have similar trading styles, trading interests, trading markets, et cetera, et cetera, et cetera. You know, if you and I are both part of a team and you're writing down and studying your best practices, and I'm doing the same, and maybe there's a third person we're working with doing the same, and we share each other's best practices, wow. If I just learn one new best practice from you and one new best practice from the other teammate, that's a meaningful process improvement. So I would say that for the individual retail trader, it's especially important to find a virtual network. And one of the great values of an online trading community is the ability to connect with people who might diversify you. They're different from you, but they have real experience, real value to offer.
Yeah, for sure. Um, yeah, I think that's excellent. And one other thing I wanted to ask you is where do you think along a trader's journey, say they're very new to this, they're just getting started, um, where do you think they should kind of double down and focus on building their trading system versus building their trading psychology system? Obviously, you can build in to your routines, like we talked about, keeping a journal where you check in with yourself. What did I do well today? That type of thing. But at what point should you kind of turn your focus from the mechanics of trading, reading price action, developing your strategy versus developing yourself and, unlocking that next layer? Or do you feel like it should be kind of more of an integration where you're kind of taking it all together? I'd love to hear your thoughts on that.
Yeah, it definitely should be an integration. And that's why I meant with the slide that developing our trading is ideally a way of developing ourselves. And so, there may be individual issues in our life that intrude upon our trading. And yes, talking to a psychologist or a coach could help that. Or talking to a coach could help us focus on which parts of our trading we most need to improve. That's great. But to really develop ourselves, we want to develop our trading. So, for example, in my own trading, a big step forward was when I stopped using time bars. Open, high, low, close, 1 minute bar, 5 minute bar, whatever. And instead looked at volume-based bars. Open, high, low, close for every, let's say, 5,000 contracts traded. And then I started doing it for different volume periods to see how they were related. And I was able to get perspectives that were not possible by using time on the x-axis. And I developed a much better feel for the market as a result of using the volume-based bars. So that was a good example of improving my trading, and that improved my feel for the market. That improved my trading psychology.
Yeah, fascinating. No, that's really cool. Yeah, because personally in my own trading, I've used kind of those standard bars, but that's an interesting thing to potentially look into and see how that might help. Um, to dive a little bit deeper into improving your trading psychology, I love to kind of throw it back to you in terms of excellent resources that you would recommend. Certainly, maybe go back to the slide where you showed the URL with your blog. That's an excellent resource. But for people just kind of getting started with this, where would you kind of point them towards? Your books as well? Where can people learn more about trading psychology and just try to improve on this aspect of trading as well?
Yeah. So here's the blog. And as I mentioned, there are articles on so many different topics within trading psychology, and it's all free. So that's a good place to start. Just whatever topic you have, you can Google that topic with Trader Feed and start getting some perspectives. There are a number of good trading psychology books out there that I think can be very helpful. My thought about a book is that if you can just take away one idea that makes a positive difference in your trading, and you spend, I don't know, $30, $40 for the book, wow, that's a pretty good investment.
Yeah.
So I'm a big fan of trading psychology books. And in my recent blog post, because I'm writing a new book right now, I'm actually reading the major trading psychology books that have been written for the last few decades. And it's a huge project. If you could look to my left, you would see stacks and books. But I've been posting the names of some of the authors that I've been reading and some of the ideas. So you'll see that in my recent blog posts, and you'll see those authors, and you could check out their books.
Yeah, fantastic. What is your new book coming out?
We don't have a date yet because I'm relatively early in the research process. But the book is about positive trading psychology. So
Perfect.
it really will elaborate some of the things we're talking about today and apply them specifically to trading practice.
Excellent. Well, we'll look forward to that. Brett, thank you again for your time, for putting this together. I really enjoyed it. I learned something. So I definitely, to use your turn of phrase with taking one idea from a book, I definitely got way more than one idea from this presentation. So thank you very much. To everybody watching, hope you enjoyed as well. Leave a like down below, and also leave in the chat kind of your favorite takeaway from Dr. Steenbarger's presentation. We'd love to hear it. And with that, Dr. Steenbarger, again, thank you for your time, and we'll be right back with the next presenter. Cheers. Okay, welcome back everybody, and it's time to digest everything that you just watched in the excellent presentations to start the front half of today. And it's also time to digest some food, get some refreshments, get some drinks, go to the bathroom, take just a mental break, walk outside. I'll probably be doing that as well, and come back refreshed and ready for the next presentation, which starts at 2 p.m. With Pradeep Bonde. You don't want to miss that one, so make sure to be back. In this just more intermediate time, I will be playing kind of a clip from one of our podcasts, just to continue the education if you would like to watch, but feel free to step away and just make sure that you're back by 2 p.m. for the second half of today's speaker list. So definitely go ahead and do that. Just to reconfirm a few things, if you want the slides from today's presentations, go ahead and sign up for the free VIP that's available on the TraderLion website. That gives you access to many different resources. Just scan that QR code right there. It'll bring you right to that. You can basically get the slides, access to special giveaways, including signed copies of Mark Minervini's books, as well as free bonus resources such as model books, classes, as well as the ultimate trading guide. So definitely go ahead and check that out. There's many different reasons to go ahead and register, and 100% it's free. So definitely go ahead and do that. There's no reason not to if you want to make the most out of this learning experience. Also, if you've enjoyed the presentation so far today, our ask to you is to go ahead and pay it forward and show your appreciation by doing a small donation to an excellent cause, St. Jude Children's Research Hospital. Even $1 is great. Again, $5 and above is amazing. Tag me on Twitter, share that you donated. I'll thank you personally. So thank you so much for doing that in advance. And to donate is just located right below the chat. You can just click that donate button right there, and it's super easy, just a few steps. You can go ahead and pay it forward to a great cause. So with that, enjoy the clip from one of our recent podcasts, and I'll look forward to seeing you guys at 2 p.m. Eastern time with Pradeep Bonde. So see you guys then, and I'll be right back. Take care.
As soon as it triggers my buy point and goes into my direction, in my mind, my buy price is the stop loss. This proved that, okay, there is a light at the end of the tunnel, right? So there is future for my trading career. I did this performance only in the last 6 months of the year. I want to do a proper trade management rather than selling based on my emotions. It should have a strong demand, and it should go sideways at the top of the bars at the price, right? And then the volume should subside in that bars, and if it reclaims highs. The change that I could see within myself is when I was losing small. I was a not profitable trader, and at the end of 2023, I'm the top performer.
Hey everyone, welcome back to the TraderLion podcast, brought to you by the Ultimate Trading Guide. You can pick up your copy down below. I'm your host, Richard Moglen. Joining us today is a very, very special guest. We have Govardhan Gadjala, top performer in the U.S. Investing Championship of 2023. Not sure if he's the champion just yet, but he's had an incredible performance of 805%. A breathtaking number for just 1 year. Govardhan, really special to have you here, especially considering you're one of the very few day traders that I've gotten a chance to interview. I'm really excited to dive into your process, your strategy, your setups, and I know you prepared a little presentation for us talking through some trades. So yeah, thank you so much for your time, and really looking forward to this.
Thank you. Thanks a lot, Richard. Actually, this is my first ever interview in trading. So I'm super excited, at the same time nervous, but hopefully it all goes good.
No, I think it will. I think it will.
Yeah,
And
sure.
yeah, and I always like to start with people's background. So I'm sure a lot of people are curious, how did you get into the markets? When did you first get interested in it? And I know you're also a software engineer, so I'd love to hear how that kind of interplays with everything.
Yeah. So before that, I would like to say thanks to TraderLion channel, you and your team, Ray, everyone, because I have seen almost all the videos. I learned a lot from them. And the conferences, yearly conferences, they are a huge plus in learning. So first of all, thanks for that. And coming to my background, so I born in India, came to USA on student visa, did masters here, and then started as a software, started my career in software development. Then family and all. So I'm kind of a guy who wants to do more than 9 to 5 job. So I have that kind of mindset since the beginning. Mm-hmm. And since childhood, I was passionate about filmmaking and all. So I drifted towards filmmaking, and then I made a few short films, and then made a full-length feature film, and then I released it in 2017. That's an Indian film, and it didn't do well. It bombed at the box office. So all my dreams were shattered, and then I was laying low in 2018 and all. And then a good friend of mine called me, and then he introduced me to trading. So he said, he explained that he was explaining the trading and the strategy, and I didn't know anything about trading by that time, right? So in my mind was trading is gambling, and few people make it. It's all luck based and all those things. So he explained me clearly that it's not luck based purely, and there are strategies. And he was into canceling. Mm-hmm. He was doing the canceling strategy, and he did a video webinar over the weekend, and he explained me all the things that he was doing, and I got a little interested in that. And then so the plan was me, him, and a couple of other friends wants to gather as a group and do some research on the companies, and wants to do some topics, and then based on that we will have our portfolio build up. And we were looking at IBD, the canceling strategy, and all those things, right? So I got introduced. This was towards end of 2019, beginning of 2020. I got IBD subscription. I got subscribed to the Swing Trader report. That is a product that they have. And I invested in their alerts, the picks. Like for example, I think Adobe was one pick. EDU was there. So I just wanted to do a test trial of the strategies, and back and forth in my mind, I just want to see, like, is this really a strategy there, or it's all gambling? So I put my 401k money into that, and then they worked out. Actually, I made like 25% in a week or something like that. So I thought, okay, this is cool. So maybe this works. And then COVID hit. all the software, everything got remote. I mean, I was at home all the time, and I had time. Now I wanted to actually, instead of following the alerts, I wanted to learn myself the strategies and all. Right. So I was looking around on Twitter, and I wanted to learn from the best. And that's how I found Mark Minervini. So I followed Mark on Twitter for a while, and got inspired by his tweets and all his past achievements. So I thought, okay, why not? And then I enrolled into Mark Minervini Private Access in August 2020. So that was the life changing moment for me. I mean, the career changing path for me. Because if I don't have MPA in my career, I think my learning curve, everything would have been different. It would have been a long duration. Maybe I would have gone in a different way. But I learned a lot from MPA. The Q&A sessions, just listening to Mark speak every week. Right. Mm-hmm. I used to just, as he says, I used to just shut up and listen. Right. Just take notes. I would do that. And the trading videos that they have on the platform, I used to go through them over and over and again, like how to manage the position size, risk management. They have so many videos. So I used to go all of that. But still, but strategy wise, I was taking some buy alerts and then doing some trades, but I was not getting the friction there. So as a beginner, right? So, and I was more inclined towards my ideas than whatever was shown in the platform, right? So I was doing my own research in the behind the scenes, and I wanted to see, like, okay, this my idea is correct, and also I'm doing my own thing, and I was not being profitable. And everybody on Twitter, like, they are claiming 2022 is everybody skyrocketing portfolios. I was getting FOMO, so all kinds of beginner problems was there.
And at this point, were you swing trading, position trading, or okay?
It's all swing trading. So 2021 mid to 2020, 2020 mid to 2021 mid, I was swing trading. I was with MPA, and I was doing the swing trading, and I was profitable. Was doing like 10, 20%, 30% in some trades, and then in other trades I was giving back everything. And then some trades, they were 20% or 15%, and then if I wait more, I would see everything come back to zero. So I had that. So I didn't get a full feel of the strategy, I mean, while I was doing the swinging. So, and I was following all others on Twitter, like whoever is genuinely sharing their ideas and wanted to help other traders, right? I was following all of them, and I get to see this day trading trades, charts, and how people are doing like 1x 2x kind of returns in a day. So I was just pulling up those charts and seeing, like, okay, so this strategy, day trading, has potential in it, and looks like this is a shorter period, right? And I have full control over it. And so those kind of things, I just wanted to give it a try, because when the duration is more, right, like swing trading, right, I felt that I didn't have control. All of a sudden there will be some news, and then whatever the plus or the profits I had in the next day, I wouldn't have those profits, or it would be zero. So that's what I felt with longer duration trades. So I inclined towards short duration day trading after that. And okay, I thought, like, okay, I'll start with very basic, very less size. And that's how I started day trading, like 2021 July. And then after that, the rest is the history. Like, I was not profitable. I was break even, actually, for the first 1.5 years until I joined USIC. I was not at all profitable. When I enrolled into 2023 USIC, I was a not profitable trader. And at the end of 2023, I'm the top performer. And that feeling itself is like surreal to me. It's unbelievable. But yeah, I would like to carry forward this and continue on this consistency.
And when did you transition all your account towards day trading? Was it when you joined the USSC, or that was a gradual shift, from 2021 to this year?
So it was one account actually. It's when I started swing trading, I had a 50K portfolio, my personal account in that. So I was doing everything in that, my swing
Gotcha.
trading and everything. And then when I started day trading, I was using the same account and started day trading. But the first 1 year of my day trading, from mid 2021 to mid 2022, I had this concept from Bryce, Tim Sykes' student, Bryce Dewey. So he explained in a video saying that have a $20 risk for everything, and then that's how, and then like small size risk,
Start
and
small.
start small and try your strategies and see how it works. It's not like paper trading, but you're losing something, but losing small, right? So I kind of took that, and I played with that for 1 year. I didn't want to make profits or anything like that. I just want to be consistent. And then slowly I started big. After that, I went big size, but I was not profitable. I had these boom and bust cycles. I made like plus 70%, plus 100% in 2022. But slowly, I gradually gave it back. So,
Yes.
but yeah, I was not profitable when I enrolled into 2023.
What do you think was the key shift that changed your performance from not profitable to then being able to perform in this last half of 2023? Was there a risk management shift, a tweak in your entries or sell rules? What kind of switched to allow you to, actually compound versus, make a lot, but also give it back?
Yeah. So the switch, there are a couple of things that I did. So for example, I stopped revenge trading. I mean, like, not completely. I used to have continuous huge number of losses. And I used to, the only thing that I do good is cut my losses quickly.
Mm-hmm.
And everything else I struggle. Even in so 2022 beginning and 2023 beginning, right? I hit good runs, I hit good trades, and then eventually, gradually, I slowly bleed out by, like, as you said, like, bleed how to death by 1,000 cuts, right? I was so slow. I became profitable when I trade less, when I started trading less. My first I'll show you the stats of my 2023, but I did 750, around that, 750 trades. So like out of 250 working trading days, right? I did like 3 per day.
Mm-hmm.
But the interesting thing is I made only 150 trades in the last 6 months.
So a lot less.
Yeah, a lot less. 600 were for the first 6 months. And then only 150 and then that's where I became profitable. And then Lance Brainstein, as he explained in videos, right? I went big when there was a opportunity, like a clear setup, easy trade. I know this is gonna work good. I went all in those setups. So
yeah,
patiently waiting for those setups and doing nothing until I see them, kind of.
And where did you kind of learn the day trading setups that you ended up, focusing on? Was it, taking the swing trade, position trade setups and just changing the time frame, or did you study some other process, other setups that are very repeatable? Studying the price and volume characteristics that contribute to a good A+ day trade setup, which could be different looking than a swing trade or a position trade.
Yeah, so in that 1 year of MBA, I was observing Mark, how he reads the charts, right, on the VCP characteristics. So I got some idea of chart reading there, and I was doing my own back testing after like all the trades that I am taking, right. So even when I jumped into 5 minutes, initially I didn't had a perfect idea of the setups. and that's why I started small, but even I started screenshotting all the trades that I'm taking and all the actions that I'm missing, all those missing trades.
Yeah.
Like I'm actually eventually gathering all the information. I don't know what is going to be a setup for me, right? So then, and eventually after 1 year, I had a good amount of playbook charts, and I consolidated them to like a pullback setups or like a strong strong with organic pullback. I had given my own names, which I will show you in a second. And so gradually I had like developed 5 to 6 setups, and that's how I developed the playbook. And now I think that was the huge step actually to become consistently profitable. Earlier, now if I look back, right, I think it was all I was not disciplined, not patient. But what to be patient for? If I don't know what the setup is, perfect setup is, I mean, I'm so that patience and all, I'm linking everything to emotional, psychological thing. But it was, so coming to technical, I'm a 100% technical trader. So having a deep dive into a setup is key. And that's first, as Stock B Pradeep says, right? First, you need to have a strong edge. Then only it should link with the psychology, and then that's when you become profitable. So that I think that I did the same mistake. Like I was all depending on the psychology, and charting was the secondary to me, but it should be the other way. First, have the strong technical analysis, strong edge, and combined with the strong psychology, that made me consistently profitable.
Yeah. So you've mentioned kind of two things so far. Trading less helped a lot, as well as focusing on the edge, focusing on the chart more. Were there any kind of key mistakes that you were making when you were unprofitable that you realized you were making over time that you kind of stopped doing? Anything that might be common for a lot of newer traders out there, maybe.
Yeah, mainly over trading and revenge trading. So I would say like I did so much of over trading. I didn't know. I mean, I was thinking that everything that was moving will be a winner or something like that, and then I was break even at the end of the year just because I was cutting losses quickly. If it didn't work, I was just cutting it right there. So that's why I was safe. I didn't blow any accounts or anything like that, but that saved me. But over trading and the revenge trading, especially, right? From my childhood, I was a very good student in academics, right? I topped in the academics, and whenever I prepared, right, I top in the exam. But so I carry that ego or identity with me. And then when it came to trading, I do the same hard work here. So I'm doing for years, for months and years, right? And then when I take the next trade, it turns out to be loser, right? And then that identity, that my mind tells me that okay, you are a loser. I mean, you are not this kind of a person. I see you as a winner. Why did you ended up as a negative, right? And then now I starts to get green on that day, right? So now I'll have a monkey mind which is playing with me. Now I wanted to revenge trade, right? The next setup I see which is not properly formed, or like it kinds of provides a setup but it's not there. I just take it and take the loss. So yeah, all that when I stopped doing or reduce the intensity of that, I'm becoming profitable. So slowly I think I'm quite not there, but I need to, I reduce the intensity and I need to do it more and more. So meditation, journaling, I do that heavily. I do meditate every day, and then I journal every day. I write on my journal book notes, like physically with pen, right? So that like I have these kind of books, journaling books. I completed like 3 of them so far in 3 years, and I try to write it down so that it etches in my mind, like write repeatedly, write, and then eventually I'll get it. So I try to form a habit. So because the physical or transformation or anything like that, right, it's easy to at least form a habit, but psychologically, even though I prepare to be very disciplined or a patient person in the morning when I visualize, meditate, prepare for the trading day. But when it comes to the action execution, one impulse trade takes me away, like, and then puts me into the bad spot, and I would ruin that day, and it hurts me a lot, and I did that so many times, and I there were times I used to cry in this room, sitting in this room, my room, and I was like literally crying myself. Like, I am a 43-year-old guy, and I didn't even cry when my close family members passed away, and now here sitting there and crying because of the mistakes that I did, even though I prepared fully of not doing them. That's how hard it is, and it goes. So that's why everybody says that trading is hard, and until it hits you hard.
Yeah, I mean, once there's money on the line, the emotions can come up for sure. But it seems like your work and the stuff you put in is paying off. And I'd love to dive deeper into your strategy. I know you prepared a presentation kind of walking through, so feel free to share that. And yeah, let's dive right in. All right, so here we are now taking a look at your chart layout. Yeah, do you want to kind of run through your routines, your process? I know a lot of people probably have questions about your ideal setup, you know, your scans that you use. So yeah, let's go right for it.
Sure. I use the Charles Schwab account and Thinkorswim trading platform, right? Mainly I'll use the 5-minute and 15-minute charts to find my setups. And regarding the scans, right? So Thinkorswim already has these out of the box pre-market movers and percentage gainers for the day. These are the default scanners, but I created my own scanner, like small cap volatility scanner, where I have given my own fields, or like the condition saying that any stock which is above 50 cents and max $100, and the volume should be 1 million, right? And then at least 20 up by 25%, show me all these stocks, and then that's how I get the performance for the day. And also I use this Zendo live scanner. This is their YouTube. I will go to YouTube and have this live scanner on, and it keeps on showing. It keeps it shows me the top momentum performance for the day, all these things. So I have this open on my tab, and so yeah, with this combined, I think I so far, like in my 2 years of experience, I covered all the top movers here within that range. So that's how I have it. And then once I get the scanners right, I'll have a grid layout kind of watch list, like for example these ones, and I'll have like 3 monitors and a laptop screen with me. So I'll have like a top priority monitor 1, monitor 2, monitor 3, and then whatever is very active and close to my setups, I'll have in top priority monitor. I'll watch that closely, and then others one accordingly. I'll have other monitors set up. If something is coming towards forming a setup, I'll move the charts around, and that's how I watch them closely.
And are there any kind of liquidity guidelines that you look for? We obviously saw the volume condition, but do you prefer more liquid stocks, or does it not really matter too much? It's just kind of what comes through the scan.
No, I prefer more liquid stocks. I for sure volume is a must to me, and you will see in my charts as well. I don't take the trades which has less volume, even though the price movement is big. I don't take lesser volume stocks.
Yeah. Are there any other characteristics that you typically look for, like average daily range, or you know, anything momentum based, or just looking for those gaps in the pre-market movers?
Yeah, so this is basically my chart. I'll have a 9 EMA and 21 EMA. I have this price and then this volume. That's all my chart has, nothing else. I don't have VWAP or ADRs or anything like that. So I'm strictly price and volume based trader.
Perfect. Yeah, and on a given day, how many stocks are you kind of focused on throughout the day? Do you just kind of get your list in pre-market and you're just focused on a select few, or throughout the day as more and more names come up, you'll kind of trade them in and out as they come?
Yeah, I trade. For sure, I set it up pre-market. As and when I wake up, I see what's moving in the pre-market. I have I'll watch them closely. But yeah, as day progresses too, there will be many stocks which will be adding to the list. So that YouTube scanner will show me like what's new and what's moving. I'll add them around like 12 to 15 are stocks, and out of them maybe like 4 active stocks will be moving per on an average, right? So I yeah, the most of them will be like either they moved up and then they fade away, or they don't have the proper action. That's why I don't pay attention to those stocks. So yeah, mostly like 4 to 5 active stocks will be there.
And talking a little bit about stock selection, do you take into account what's actually driving the move? The news event, the theme, whatever. Does that factor into your process at all, or it's really just all about the technical price and volume action?
So what I feel is, I'm a 100% technical trader. I know people will look at the news and they analyze they predict the move as well. For example, Lance, he will look at the news and then based on that, he will jump into the chart right away. And also even coming to swing trading, right? We do fundamental analysis and then based on that, we react to the price action. And then, so everything actually, eventually everything funnels into the price, right? So all these fundamentals are news, catalyst, everything, it shows in the price. So I'll be there at the price watching. So what I believe is, let it be all. So everything, since everything comes here, why can't I wait here and see how it reacts, right? And then it has some news X. I don't care. So I don't look at the news at all. So and I think I saved some time there, but maybe I'm losing some edge. But so far it's good, working good, because whenever I try to read the news, I get biased with the price action. It happened to me. For example, a biotech stock, since it's a intraday charts, right? A biotech stock have this their drug got FDA approved. It's a very good news, right? And I tend to jump it right into it, even though there was no setup, and I took loss many of the times. I don't know how to interpret the news actually. So I think I don't have any edge there. That's why I stay calm and just wait at the price chart setup.
Yeah. So, perfect. So say you're going through your scans, what does an A+ setup look like? And maybe run through a few examples as well. What are you looking for when a stock comes through your scan that you decide, all right, this looks exactly how I want it. This is what my setup looks like. This is where I'm going to buy. What exactly are you looking for on the intraday charts?
So this is a ICCT stock. I don't know why it moved and all those things. So I don't ask me those. I mean, then as I said, right, I don't care. I don't look at the news and all. But on this day, it spiked up. It gapped up, and then it faded out. But slowly, it spiked up again. It was halting up all the way up, and then fading out, and even afterwards on the day, it started to spike up. So since these low float stocks, right, whenever it does that, it has this short squeeze kind of features to it, and then they squeeze it. So and I have the playbooks for these short squeezes, and also I liked this action here, all here, and I was watching from this pre-market this day. So it started to go up and then down, like getting dumped, and then and after that it started to at the market open, the volume was coming up, as you can see in the 5-minute bar, like it's like 500K, and then halted up, and then it was 1 million, 2 million, almost 2 million in the 5-minute bar. So there is volume picking up, as you can see, right? And then and then it's going sideways. So I like this action. So there is strong demand, and then even this bar, it started, it took this high of this bar, but closed here, but with big volume. I see this as like a very positive sign, very positive action, right? And then it came down, but with low volume, as you can see, like this bar, it gave back some price, but with low volume, which is good, and then close good, and then so it's going sideways. Actually, it's at the top of this price action, and it's going sideways. And I have playbooks of this kind of chart action, of the price action, and I was liking this when this is happening. So, and even this bar is very positive. I took the previous highs and came down. Some selling pressure is still there, but and the volume increased in this bar, right? And then it's closed good, and then it took this bar, took even the highs of that, even this good. Yeah, until now, I'm only interested if it takes these highs. Until
that's your pivot.
Yeah, that's my pivot. I have this buy point set up here for time being, right? So, and then this action is good here, and then I was watching here, and I took, I think, this highs. So when it took this highs, and as you can see, right, it went from that to like 146%. That is the move in like 40 minutes, but I didn't take the full move. When it went this far, like I took only the meat of the move, but I should have. That is one of the mistakes that I do constantly. I don't wait properly when it's going up. I should have. I'll cut when I sometimes see my PNL, and if I like the profits that I'm getting, and if I'm in a drawdown, right, I just take the profits out, and then I'll be out of the trade. And then coming to that, right, like I have these slides, and actually I wanted to show the audience my actual executions, right, in stuff. So I'll show you the actual executions of my trades instead of showing the charts. So as you can see, like this is the ICT chart. Previous day, it was a next day multi-day run. And I took the entry here at 3.2. And as it went up, I peeled off some position into this strength. And then when it started going up, I peeled up like one third off, and then I came out all the way here. I should have got, I should have waited more, but I was liking what I was getting. So I just wanted to take the profits. So this is how I manage the position. This was my entry, 3.2. And my stop loss would be here, the low of this bar. Okay.
And
so
what position sizing were you looking at with this?
So this one, I was in drawdowns when I made this trade. So I follow Mark Minervine's progressive exposure principles. So when I'm in drawdowns, I kind of trade less, like take until I get to profits or close to equity highs. I trade slowly, and then once I get to a highs, I'll try to go big. So here I took a medium size, like I would say, like, but since the setup was too good, the volume was too good, I went with medium size. Otherwise, I would have gone with less size. So yeah, I took good profits on this one.
And what's kind of a medium sized position for you, like as a percentage of your account for this trade?
Like, I don't know, 10-20%. Actually, 20%. I mean, so when I was swing trading, I used to look at 7%, 8% that way. But when I came to day trading, right, I don't look at downside much. I mean, because if this trade didn't work and it's hesitating, I would cut even before even it hits my stop loss. I'll come out quickly. So I came up with my own rules of risk management, saying that because I want to be aggressive at the same time, I want to be very risk averse. I don't want to risk too much. Even if I choke this trade, if I miss this trade by micromanaging this, I'm okay with that. I just want to like have a good setup. As soon as I enter, it should go in my direction, and I should as soon as it goes in my direction, actually, I don't put any stop loss in the chart in the software. I have it as an emotional stop loss. I will, because I will be watching the chart action.
Mm-hmm.
As soon as it buys it triggers my buy point and goes into my direction, in my mind, my buy price is the stop loss.
Mm-hmm.
So I did that so many times. Whenever I went in huge, there are trades I went in all in, and with this action, as soon as it goes up, I in my mind, like, okay, this is my break-even point. Even if I choke this trade, that's fine, but I don't want to like risk anything. And and as you can see, it never looked back, so it goes up. And this happened. This is a constant behavior in like small caps world, where now when it is going high, it goes high to exponentially. So, and I learned this from Mark Minervin as well. So whenever he did the 2021 championships and all, right, like he went in with margin, and he reads the price action precisely, and then goes with margin, and then he will move. The sooner the faster he will move it to the break-even point to make it risk-free. So yeah, I kind of follow the same.
Yeah, and did you use margin at all this year, or not so much, just cash?
So small caps, the broker, they won't provide the margin, but I go all in. Whatever the cash value that I have, account value, I invest it fully. In some trades. That's how, like, I take, as I was saying, right, Lance Brandstein's that suggestions, like, go all in. I mean, like go big when there is a easy trade. So that changes the performance. So I strongly believe that I would like to continue on that this year too.
And taking a step back, I don't know if you've crunched the numbers, but do you have a sense of your average win rate, your average gain, your average loss? It'd be great to hear that, because I'm sure people are curious.
Okay, sure.
Sorry if I'm skipping ahead in your
That's fine, totally fine. I have it. So these are, I use the TraderSync app to import my trades into, and this is my journaling software. So where I have the stats. My win rate, so this is for full year, like Jan to December. My win rate is only 31%. Loss rate is 68. I hope you were able to see, right?
Yeah, I can see it.
And then my average percentage on losers is minus 4.06, and average percentage on winners is 8.55. And total trades that I took is 745. Okay, so this is for the full year. And then the next slide, I have it for the last 6 months. The difference that I want to show the audience when I became profitable, right? Still, my win rate is only 28%.
It actually went down. That's interesting.
Yeah, but very close. I mean, not. And then, as you can see, my total close trades is 165. Like out of 745, only 165 in the last 6 months, right? And then this went higher, as you can see, like it's minus 4, and then it's 13, and whereas here it's only 8.55. It's when I win, I'm winning big here.
It's kind of, it went from kind of 2 to 1 to 4 to 1 almost.
Yeah. And since we are in the stats, I want to show the audience this. This is my mistake. This is my problem. Like, there are 745. This is per year. There are many losers. There are 511 losers, which are fine, but you can see there are 17 consecutive losses. And as I said, like, I don't lose big on any single trade because I cut losses quickly. The only one thing that saved me so far is that one thing, cutting losses quickly. But this is my problem. I bleed to death. So consecutive 17 losses. And as you can see here, right, in June, like loss, everything. I mean, all the trades that I am taking is losses. So I don't know why I do this, but I should stop doing this. I mean, like, I should take a break or take only perfect setups, right, until it happens. But I know why this happens, because I'm in a drawdown. I want to badly get back to break even or my equity size. And this is in June. What happened in May was I had a 200% performance in April, May. And I want to increase that. And once I started with a loss and some losses, basically, and since I wanted to perform more, I was not accepting these losses. And because of that, I was doing bad to myself. I was losing more. And this is the problem. So I do revenge force trading a lot. And the funny part about my last year's performance is I was break even until the mid of the year. So actually, until here, my performance is zero. Actually, I did this performance only in the last 6 months of the year. So because I started slow, I was doing good. These 2 months got me into greed. These months gave me hope of maybe I can win the championship, or maybe I can be the top 3 or top 5, right? And I wanted to. Now my ego is getting satisfied. I wanted to, continue that. It feels good, and there will be obviously some losses which I need to take, but which I don't accept that, right? Because this feels good, and losing doesn't feel good, right? So I kept on this revenge trading and all. I losing more and more, and finally I gave 50% of it. So 200%, 50%, and then even in the first half of July, I gave like some more, and like by mid-July, I was back to where I was in the beginning of my year. And then slowly I picked up myself and did some more meditation, some more journaling, some more workouts, deep dives, everything. And then this month gave me some confidence. And see, the change that I could see within myself is when I was losing small. So and I was trading less, as you can see in the stats, right? Like only 150, 160 trades after this. So when I was losing it, I was telling myself, it's okay. Just take it easy, trade less, accept. And then this was a big boost for me. And then slowly, even I was losing here, but I could see the clear change within myself, saying that, okay, losing is fine, trade slow and trade less, but still I ended up positive. So that's how this was achievable.
Yeah, I love this breakdown. This is super helpful. So diving deeper into the June, and because I think that's a really interesting month, and looking back at the series of trades that you made, and you might have made the shift already, because it seems like you have. Have you thought about implementing a rule where if you have 5 losing trades in a row, 3 losing trades in a row, whatever the number is, you like take a break for 2 days, try to reset to prevent that revenge trading, or making sure you're being more patient? Is that something? It seems like you're kind of doing that unconsciously now, even if you don't have a specific rule.
Yes. So yeah, I was putting some hard rules for myself. Yeah, as you said, taking a break, and not number of losers wise, but if I, for example, if I'm in a minus 10% drawdown, minus 15% drawdown, so I would say to myself, okay, take it easy. Next 5 trades should be only minus 5%. Together, it should be minus 5% drawdown, like progressive exposure, as Mark says, right? So
Right.
reduce the size, try to read the price good, and then get some wins, and then build the confidence, and then slowly get it big, right? So that's what I'm following nowadays. Like in the last 6 months, I'm getting good at that, but long way to go. I need to keep working on that.
Yeah. Anything else, looking back at your data from the year that you think is significant or just, over the course of this process has been interesting for you and might be interesting for everybody watching?
As I said, right, since we didn't go through other slides, the apart from this, the winners were made a big impact, made a huge difference on me. Like, so for example, this is one price action. Like, as you can see, see, this is the setup that I built it. So if the audience wants to know, like, how did I know that I need to buy it here, right? So I am explaining that, okay, there is a strong demand, it goes sideways organically, there is a good pullback, and then volume, it has the look of going up, right? And there is some still selling is there, that's why it's going sideways. But as and when the selling all dried up and the demand shows up, it goes up, right? The price goes up. And since I kind of I had this playbook, right? uh, as you can see, like I have this playbook, and it will have the same action.
Hmm.
I have like all these slides, and I go through them very frequently, like once in a week or like once in a month. uh, and then that's how I know, like, if you look at these price actions, right, it's not no different of what we are seeing there. So that's how I know it's going to be like it has that look. So as you can see, the volume dries up, the price goes sideways and then picks up. So that's what made me take this trade. And then in the small caps, right, when the price when the action is this strong, so it went from like almost like 150%, and then next day it keeps continuing. It tries to fade out, but as you can see, this action, there is short squeeze, and I like this kind of actions. So I just wait here, and then towards the market close on the next day, it spikes up.
Mhm.
And it went from like $12 to like what, $42, I think. Yeah, it went from here to here within like 250% within 1 hour with 45 minutes. And yeah, I took that trade as well. So sorry,
And you often look for kind of multiple rounds of trades in a single name that's acting well, or
yeah,
you do? Okay. So
yeah.
you
So
wait.
so here, right, I don't need to what I was trying to say, like, I don't need to predict the move here, right? It's already giving me information. I just collect the data, right? So it gave me enough clues here. So this is gapped big, and it's trying to squeeze up. It's trying to squeeze up here. And then with this slow float and this much volume, it's compared to yesterday, right? This is all positive signs. So I have enough clues to take this trade. That's what I like, reacting instead of predicting, right? So I just react to the price and then take the trade. So likewise, even the next day, so the same stock next day, I didn't find any of my price action the whole day, right? I'm just waiting there. I just wanted to have a solid great risk reward entries and to see. And yeah, here slowly I started getting FOMO. I thought, I know that this is going to get squeezed up because I saw this action in earlier some trades like TOP and all in the past year. This has that look. So I started getting into the position early, but since it was not still there, I just cut it out fast. I don't want to wait. And then again, I took the at the very end, closing towards the range open of the day. Sorry, I entered there, and slowly I just peel it off, and then I scaled in here, peel it off on the way up. So yeah, this is one of the trades.
Can I ask a question, actually?
Yeah, sure.
Yeah. So, could you describe kind of your process for selling? Are you always looking to sell into strength as it's pushing up, or do you have anticipated targets, or is there another kind of system that you use to take profits and exit the trades?
I I always try to sell in the strength. I peel off actually. I'll sell like 1/3 half. So similar to this, like wait, let me get this is not for example this trade, right? So I entered here, and then there is another position here. So on an average, my stop loss is somewhere here, which is a break-even point, and then into like half and half here, I try to sell, or like sometimes 1/3, 1/3, 1/3, 1/3. My selling is not optimal for now, because I want to wait more. When I look back, right, I see the stats. If I had held the positions more, for example, yeah, this life trade, LIFW trade, I sold everything here, somewhere here, actually, yeah, somewhere here, and I missed all this move. That's yeah, this year. So I entered here, as you can see, 4.7 with I went all in this trade, and this because of the same action. I can explain you in the chart. I went all in, and I sold everything here because I looked at my PNL here. It's already 6 figures, and I mean it's like a consecutive 6-figure trade for me, and I was liking what I was seeing. I just took everything out and ran away. But I missed this move because of that. So this year I want to be consistent with my selling. I want to wait more. I actually, even in buying, I want to wait more. Have a proper perfect size, and when in trade, just wait more. Based on just want to react to the price action. Like if it is this strong, it has a chances of going big again. So I have this back tested. I have the stats showing up. So this year I'm gonna actually, instead of selling, I want to scale in here, right? Something like that. So I wanted to, like, if I'm going all in, then there's no way to scale in, but at least peel like 1/3 off if it is that strong, and then add that 1/3 back in here,
Right.
so that I have some gains, even if it reverses, right? And then yeah, I want to do a proper trade management rather than selling based on my emotions or PNL.
Based on feel, yeah. I mean, here it's holding that 9 EMA the whole way. It hasn't broken it yet. Okay, perfect.
Yeah, and I would show the chart. The daily of this one is here. This is the day that we're looking. This is the daily, and it has a history of prior run. It has this history of squeezes, and then even here, right? You try to go up, gets faded out, and then it takes all this higher again on the daily, and then higher again, tries to fade out, and then it takes this higher out. This is all features of short squeezing and then it completely fades out, and then it shows the strength again, and then squeezes all the way up. So this daily, when the daily and the intraday have the congruence of the confluence of this setups, then the move is going to be exponential, or the move is going to be certain, almost certain. Yeah, there is nothing certain in trading, but the probability of the move working will be always high. And that's what I saw. So on this day, the volume picking up. So I'm not interested here and here, right? So because there is no setup here, but this volume is greater than all the volumes here, right? And it has continuously increasing volume. And that too in millions. Like this is 1 million, this is 500K, this is like 1.7 million, and this also took the highs of this one and closed low, but it closed at the top of this half bar with low volume, which is good, right? And then this went sideways, 1.4. Now I'm interested if this takes this high, not even this high. I just want to make sure, since there is not much difference between this 4.59 high and then 4.65, I just wanted to, in this kind of scenarios, I want to be more careful and have this this high as my buy point. And then when it takes that, it doesn't even look back. As you can see, it went and halted up, and then it opened here, halted up, halted up, halted up.
Yeah, I want to ask, how do you deal with halts? I mean, that seems like the big question mark when you're day trading these type of names, especially when you have that type of position size in a trade. Yeah, talk me through your process of psychologically as well as trade wise, how you handle when a stock you're in halts.
Yeah, initially I had this same concerns or fears when I stock halts up. I didn't see this in my first year of swing trading, right? And then coming to this day trading, small caps, momentum trading, halting is a common scenario, right? And then I was scared. Whenever there was halts in the beginning, right? I was scared, like saying that, oh, how it's going to open and what am I going to do? As soon as the halt resumes, I used to get out of my position. Even though it's trying to go up, I just get out and then miss all the move. Now, after this experience, actually halting up, I feel good. I feel that it has higher chance of going up because in small caps, right, and low floats, when it halts up, it continues the momentum, and most of the times it doesn't. It's all based on like where I enter. But in this scenario, halting down and coming to my buy point is a very rare scenario. If it is this strong, it halts up this way. So even this, when it opened here, right, it would go sideways or slowly it would come back and it would hit my buy point. But yeah, so in this case, right, as soon as this is out of my buy point, my stop loss is here at the break-even point, because I went in huge, I went in big, right? I don't want to give risk anything on this trade. And yeah, I was watching here. Maybe if this opened and it came down and hit my buy point, I'm okay. But luckily it went up. But yeah, as you said, like halts do scares the traders. But once I get the experience, you get the experience, and it should be okay. It's a common feature in scenario.
All right, welcome back, everybody. It's my pleasure to introduce our next guest, Pradeep Bonde, the founder of StockBee. He is known for his focus on process, codifying the momentum burst and episodic pivot setups. And it's a real pleasure to have him as a part of the conference and for sharing his thoughts and ideas on swing trading. Pradeep, thank you so much for your time, and looking forward to this.
Oh, thanks. Thanks for having me.
Of course. Let's go ahead and dive right in. I'm sure you've got a lot to cover. I'm very much looking forward to it. And at the very end, we'll do a Q&A on the concepts. And let's dive right in.
Okay, so let's start by going into my slides. I'll just share the screen. So essentially, there are two types of setups which I trade. And that's the crux of everything which I do. One is catalyst based. Anything which is catalyst based, or where there's a clearly identifiable catalyst, and based on that catalyst, the stock is likely to make a big move. Now that is basically one type of a trading which I do, which is for finding trades which will move my account in larger increments of 20%, 30%, 40, 50, sometimes if I'm lucky, 100% in one trade. But there is another method which I trade, and which is momentum burst. And in momentum burst, what I'm essentially looking for is these trades which are smaller duration, or they are not shorter duration trade. And they don't move your account in big increment. They move your account in 1%, 2%, 3, 4, 5%, if you're lucky, increments. But you can find hundreds of these trades in a year. So this is broadly the two ideas behind my trading. And so let's look at the catalyst-based kind of a trading, which is what I do. And most of the people who know about my trading or stock be, they heard about episodic pivot. So episodic pivots is one of the kind of setups which is based on a catalyst. So the only reason I'm going to get into a stock is because there's a catalyst. And if that catalyst is going to make the stock move, then I want to be in that stock. But these kind of trades based on catalyst, episodic pivot, which are going to move your account in big increments, they are basically rare. They don't happen as often as you would like them to happen. Plus, the market has changed as a result of market change. A lot of time when there is a catalyst, the stocks tends to gap up a lot, and the first day move tends to be very big. And after that, most of the time, they don't do much, or they just go sideways, and then they will have a reaction afterward. So to profit from that kind of a phenomena which is happening in the market, I also have a setup which is just a subset of the episodic pivot, which is stocks in play, which is essentially a trade which is just a day trade kind of a thing, because on the day of the earnings or day of the catalyst, stock will sometime make 30, 40, 50% move, and then nothing happens. So I know that. So I play them at just one day thing, which is a stocks in play. Now, because stocks are reacting very violently to catalyst because more people are trading episodic pivot, most of the time what you see is the risk is higher getting onto an EP on the day of an EP. So I created this setup, which is more a delayed reaction EP. And in a delayed reaction EP, what I look for is I look for a stock which had a catalyst, but I don't necessarily enter on the day of the catalyst, because that day you might get shaken out, or it's not necessarily the best entry which I get, or it is gapping up too much. So I wait for it to set up nicely. And then when I get a low risk entry is when I enter that particular trade. And so that's a delayed reaction EP. And especially delayed reaction EPs work very well on the short side, because on the short side, whenever there's a negative catalyst, the stock gaps down, and then it tends to like a gap reverse during the day. And for 3-4 days, there is this tendency in the market, all bad news has been priced in, the stock goes up. But after 3-4 days, it starts going down. So I do the delayed reaction. Similarly, delayed reaction, I do it also on stocks on the bullish side. Now, these are all setups which are really a variation of the original idea of EP, which I've been trading. But in recent years, when I look at the EP, I see that there are not enough EPs. There is not enough money, because if a stock gaps of 40, 50% on the day of the earning itself, then incrementally it makes only 20% move. So there's not much of a money in this. So I created a setup idea, which is like become my main setup idea now, which is like, and which happens more frequently. It has much more profit potential than the original EP, and that is the 9 million EP, which is essentially to look for a trade in a stock which suddenly has a volume surge, and the volume surge is more than 9 million basically. So it's basically a high volume breakout, basically very high volume, extremely high volume breakout, which is not something which is a norm for that stock. So that's become my mainstay in terms of what I do. If you're doing the classical EP, you'll be lucky if you can find 5 to 10 trades in a year. But when you do 9 million EP, you can find 100 trades, you can find 200 trades, because it increases the universe to a large extent. So this is sugar babies. Obviously, like the word might sound very strange to people, but when I did this 9 million EPs, what I found is that there are certain stocks on which there is a continuous number of 9 million EPs which keep happening. And those stocks, when they make moves, whenever there's a 9 million EP, they make these big moves. They make just a swing moves of 40, 50% in a couple of days. So I found a way of isolating stocks based on this 9 million EP, how many times it happens in a year. And I trade those stocks as a core list of stocks, which we call it sugar babies, because this is something which you can like go and find 40, 50% swing in just 3 to 5 days on these kind of stocks. So those are the other variations of EP. So essentially, to summarize this, like, and I started originally with an idea of episodic pivot some 22 years ago, and that was my main idea. Today, the original classical EP is a very small part of what I do. Most of my money is now comes from 9 million EP or sugar babies, which is more mainstay kind of a method, which is more based on the same idea of moving your account in larger increments, but using a different way of identifying stocks which are going to make a big move. Now, whenever you look at episodic pivot, when I started trading episodic pivot in the beginning, I was only trading episodic pivot, which are based on a real catalyst. So I was looking for real earnings. I was looking for real sales or looking for a real something which is like, say, recent example, CRDO. If you go and look at CRDO, what you're going to find is there is a reason why the stock went up, right? And basically, if you see CRDO here, right here, this is what like was this earnings and sales. Let me pull this in here. And if you see, so it had 275% earnings growth, 89% sales growth, and this is what it projected. So there, I know why CRDO was likely to go up on this day, and there is a real catalyst, right? But there are so many stocks which make moves, and they have no real catalyst. It is just a story, right? Good example of that is a stock which I bought yesterday, ACHR, right? Now this stock, it's a story that they are going to have planes which will fly vertically, take off. There is no real business, right? And if you look at their earnings or sales, it's just hot air, right? And this is like what in Wall Street terms is called fugazi, right? And there is just like there is 0% sale. There is no sales, but these stocks can double, triple. They can make bigger move than CRDO. They can make bigger moves than stocks which have earnings. From time to time, the stocks make these big moves, right? And it makes 100%, 200% moves. So the realization that stories make bigger moves than the real catalyst is really the turning point also. So nowadays, I trade a lot of story stocks as EPs. Anything which is a story is likely to fly better than a stock which has a real catalyst. So I focus more on these stories, which can be just like, you just have to keep your logical brain aside to trade these kind of story stocks. So that's the other twist, which is like new twist to EP. So stories EPs is become like a very important. The only difference is on a real catalyst kind of an EP, if I have a conviction, I'm willing to put a lot more capital. I'm willing to go 50, 60, 70, 80, 100% of my account on. But on a story stocks, I can't bring myself to put all my account on a story stock. But even if you put 20, 25%, those story stocks can go up 300, 400%, or at times even crazy. So stories is another twist to the original idea of episodic pivot. So let's look at some of the examples of this EP kind of a trade. The recent example is like in a CRDO, is just what I just now talked about, where there is a real clear catalyst, and based on the catalyst, the stock is going up, right? Before I go ahead, like, and if you have any questions, you can ask, because I covered a lot of things in this first few minutes. So if you have any questions, you can go ahead.
Yeah, just for people who maybe aren't familiar with an episodic pivot, could you kind of give a brief definition and maybe use one of the examples to kind of walk through what exactly you mean by an episodic pivot?
So episodic pivots is a terminology which is more used in television or in movie industry. Basically, the story takes a twist, right? There is some catalyst which comes in, and as a result of the catalyst, the market completely reevaluates its view about this stock. Supermicro was going nowhere, 6 months going nowhere, and then it guides higher, and it guides significantly higher. And the story took a turn. That's the episodic pivot. As a result of this, the stock went up 154% in less than a month. Now, that's the kind of thing which is a catalyst which changes the story, or it changes the market view about the stock. And because of that particular episode, the stock goes in a different direction, basically. And I can show you similarly on a short side, like an SMCI is an example of long side, but Mobileye, right? Mobileye came and like guided significantly down. When it significantly guided down, After that, it went down like 20-30%, right? Basically. Or here is a good example of a episodic pivot, right? Door opens in a flight, right? Means that's like the story took a total turn and the stock went down after that. So that's what episodic pivot is. It's some surprising news which the market has not anticipated, and that surprise leads to a stock making a big move.
Yeah, perfect. I think that's good for now. If you want to run through examples, I'll probably have some more questions to jump in there.
Okay. So CRDO is a recent example of this thing. And as I showed you just now, CRDO, if you look at it on the day of earnings, even before the market opened, this was very clear that it had significant from negative sales growth, 275%, 89%. And I pay a lot more attention to sales growth rather than earnings, because earnings in today's market conditions are not necessary for a stock to make move. But what you want to see is sales growth. Sales growth is what drives stocks move. So sales growth was phenomenal. Not only that, it was projecting for next 4 quarters this kind of sales growth and this kind of profitability. So this is a good example. And as a result, you can see that the stock made a big move, right? And this is an example of a EP where there was a real identifiable catalyst. And as a result, on the day of the earning itself, it went up 27%. And since then, it has gone up around 40%, right? So that's one. The other one, recent one, which is ASPN, right, here on this particular day. So if you see in this particular case also of ASPN, you're going to see that there was a real catalyst, right? So you can see that 92%, 107%. So there's a sudden jump in sales, and it is guiding higher for next 2 quarters, at least 110, 57% profit is also. So the Aspen, as a result of this particular thing, had this gap, and on the gap, and this is what happens to a lot of EPs nowadays. On the day of this catalyst, the stock made 56% move. So a lot of the catalyst gets priced in just day one. And if you see, since then, the stock hasn't really done much. Yes, it is up 30%, but most of the catalyst got exhausted on the first day itself, basically. It's up 57%, and it ended up giving up some of the gains in last 2 days. So that's another example, recent example of this thing, EP. Obviously, SMCI was something which was a big catalyst. SMCI had 2 things. It had the earnings, or it guided significantly higher, and then after a couple of days, there was earnings. But it also had a story element to it. And the story, you have to understand what kind of stories are working in the market. Currently, anything related to AI is a story which works very well. So it had both components. It had a real catalyst, plus it had AI, which is a story kind of a thing. And as a result of this, the stock made such a phenomenal move. There is this thing, app. If you look at APP, Applovian, right, and earnings. And since earnings, it has made around 40% kind of a move on the earnings day itself. It made around 24% move. Even when you go look at app also, you will see that there's a real catalyst. It's basically has back-to-back quarters of 36, 48%, 44. Any growth, sales growth, about 39% to me. If it is happening back-to-back 2 quarters in a row, the stock is likely to make a move, because that kind of a sales growth is rewarded by the market. If you study the big winners, which go on to make big moves, they will typically have sales growth of 39% plus quarter after quarter after quarter. So when I see something like this and a 4-digit earnings growth, and if the stock hasn't rallied, then I am excited. And the stock did make a move after that. Again, there was earnings here. So there is it guided higher. Actually, it guided higher. And then the actual earnings was here, basically. So that's one which was there. Then you had basically, when you have a very neglected stock and which suddenly come out with earnings, here in this case of Powell Industries, for a long period of time, it was not doing anything. This price wasn't doing much. And then it had a catalyst. And the catalyst was basically, again, earnings and sales, right? Here you see 53%, and it guided 49% for next quarter. So 999, 53% sudden jump in sales. So sudden jump in sales, and as you can see, the stock made a big move, 56%. So that was another one. There are two types of episodic pivot when you're looking at real catalyst, right? One kind of a thing is where you have a growth kind of a company, like CRDO is an example of a growth kind of a company. It has some product which is relevant to the AI industry. So that is why it is in a growth kind of a category, or ASPN also is in a growth kind of a category, or SMCI is a classical growth kind of a thing. But there is also another type of an EP which works very well and which is a turnaround. So in a turnaround kind of a situation, when a stock for multiple quarters or multiple years in a row is not making good profit, it has trouble with its business, its sales are going down, and then suddenly it comes out with sales and earnings growth, which surprises the market, then this is a turnaround. And you will see that turnaround EPs often make bigger moves than EPs on stocks, which are real earnings and real sales. And the reason being that when a stock has this kind of 2 or 3 years of negative sales growth, it gets beaten down to a very low price level. It is like a really beaten down. The market has a very negative opinion on it. The market doesn't really care about this stock. Analysts drop their coverage. And when it manages to turn around, that can be a big move. And Abercrombie and Fitch, ANF, is a good example of this kind of a turnaround. See here, this is where first I noticed this stock, and multiple times I traded this stock, and the stock from this first EP has continued to go up, and it has made around 522% move. And if you see the reason, it's very apparent. It was a classic turnaround kind of a situation. See, for multiple years, sales were growing down. Then a management change happened. New management came in, and they started this particular sales growth started. And when the sales growth started, you see that the stock just took off 467%, 16%. This is where this is where they also had a first to $6.28. So as a result of this particular thing, this stock has. So this is an example of a turnaround kind of a situation. Recent stock which has a similar kind of a catalyst was GPS, but hasn't done much. So I'm keeping an eye on this because I wrote down this is a turnaround EP. Because if you see again the numbers behind the scene on Gap, and again there is a new management in Gap. Yeah, it's 903, but it's not really guiding higher. It's not same as Abercrombie and Fitch. So that's not something which may make the same kind of a move, but there is a potential for a turnaround kind of a situation. So that's the second kind of an EP.
Just
Then
jumping
you
in
have,
with the question, would ELF also be in kind of that same vein, a turnaround?
ELF is more a growth. It's a new company.
Okay.
It's a new growth, right? And it's created this category. See, since this particular day, I've been monitoring ELF like multiple times. I have got out of this trade, and ELF is more a sales growth kind of a story, as against a turnaround. Because if you see ELF, it's been growing sales at 49, 78, 76, 76, 85, 71% for 6-7 quarters in a row. So that's like a growth kind of a stock, basically. So anything which is growth, any stock which has 39% sales growth, I consider that as an EP if it is meaningful. Like the sales growth on 1 million becoming 2 million is not meaningful, but if it is 10 million and it grows by 39 million or 100 million and grows by 39%, that's something which is going to make the stock fly, basically. So ELF is a growth stock. Turnaround stocks, basically, if you want to look at an example from past, this is a good example of looking from past. Avis Rent-A-Car, and if you go and see during this time period, its earnings shot up a lot during 2020 after being lower. So that's a classic example of a turnaround kind of a thing. Or if you look at this, right? So you see from a loss of $6.20, it had a jump of profit of 58, which is like a huge jump. And as a result, you'll see the stock from being trading at around $8, it went all the way to $250 or $300, I think, to $400, right? So that's a turnaround kind of a situation. So those are the kind of situation, two types of situation I look for, which is one is a growth. And in a growth kind of a situation, I will look for sales growth of 39% plus. And if it is 2 quarters in a row, that's good. And the other one is turnaround. And when it comes to storage, anything I will buy because it is a story. Now here, again, some categories are not going to have that kind of a sales growth. Sweet green is an example where there was an EP here where it surprised the market. And then this is a delayed reaction. I actually bought it on this day instead of buying it on the first day, basically. So that's like a basically Powell move. Western Digital, again, if you look at Western Digital Corporation, you'll see it's very apparent when you look at the numbers stand out when you have these kind of numbers, right? And it's very clear. This is also a turnaround kind of a situation also, because negative sales growth, negative profitability, and suddenly it surprises the market. And as a result, here, like, and you see, I write down this if I find something like this so that I can remember, and it made a move after that. So there are like in a bunch of these examples. There can be real catalyst. In the case of HIMSS, there's a real catalyst, which is they're going to come out with Ozempic, which is $200, Ozempic, right? And that's a real catalyst. So as a result, the stock is up 60-70% from this. Obviously, you have Insmed, which is a recent stock which made a move on a catalyst. And you can see that it has a real earnings, real sales, right? And basically, so it's just had a turnaround kind of a little bit of a thing, and a biotechnology kind of a thing. So that was a real catalyst. In a biotechnology, you can have a real catalyst. Now that's basically the kind of thing where you can actually see the numbers stand out, the numbers speak to you, and then you can with conviction say, okay, this is likely to go up 30-40%. Okay, can I put 50, 60, 70, 80% of my account with the risk management? Yes, and then make money, right? Unfortunately, the last example which I'm going to show, and which is what people want to find every day, but this kind of a thing is going to happen only once in a lifetime. It happens very rarely, right? It's a unicorn. You can't base your strategy based on unicorn. Root had like a really phenomenal number suddenly, but in a year, you're going to only find 1 or 2 examples like that. So it's not really like, see here, 56, 173, 284, and that's what started this move. But that kind of a thing doesn't happen all the time. That's the problem, right? If it happened every day, we'll all be billionaires, but that doesn't happen. So as a result of this, I like to go into the story stocks, right? So that is as far as real catalyst is concerned. So 2 types of catalyst I look for. One, there is a sudden growth in a stock, or the market discovers that particular stocks as a growth stock, or a turnaround. Typically, turnaround make longer lasting moves than growth stocks, because most of the time, growth stocks can make a move for 1 quarter or 2 quarters and they can flame out. While in a turnaround, if it's a real turnaround, that turnaround can last for quarters, months, years. In Abercrombie Fitch ANF example, that turnaround is a genuine turnaround. So the stock continues to keep going up. So that's as far as the real catalyst EPs are. Okay.
And
Any questions here?
Yeah. So you mentioned a few kind of criteria that you've looked for when you went through those different names. Neglect was a big one. Would you mind kind of summarizing some key things that you look for that maybe, you know, if it's apparent in episodic pivot, it brings it from a B- setup to an A+ setup for you?
Okay, I'm going to keep this slide as it is. I'm just going to add content on this so that it is easy. So in order to find a stock which meets my EP criteria, I have this checklist. Criteria, Magna 53 plus cap 10 by 10. So each of these letters stands for some criteria checklist. So Magna 53, so MA stands for massive acceleration. I want to see a massive acceleration, triple digit, something which is growing at like 10%, suddenly growing at 100, 200, 300%. Or so massive acceleration either in sales or in profit, or analysts were expecting 10 cents and the company come out with 50 cents, right? So that's a massive beat on analyst expectation. The next thing is gap up. If this news is a surprise to the market, the stock should gap up, right? And a lot of time people think that this earnings is good, but the stock doesn't react. The stock just sits there, or it actually like, and it doesn't in a pre-market doesn't react. So that's not what I'm looking for. So the gap up is important. The next thing is neglect. So I look for a stock which is neglected in terms of 2 months, 6 months, 1 year, 2 year, 3 year. The bigger the neglect, better it is basically, right? And neglect is not only in terms of a price action, neglect in terms of number of mutual funds owning the stock. You will see that some of the stocks, they will have less than 100 mutual funds owning them when they are discovered by the market. So that's a neglect, right? Or there is no analyst covering that particular stock, or there is no news flow on that stock. When you go to some news site like The Fly or Briefing, you don't see for months, there is no news. So that's a neglected stock. And then suddenly the market discovers and it goes up like crazy. Root is a classic example of what happened like that, right? A stands for acceleration in sales. So if there is a massive profit the company has made, company can make massive profit by just reducing cost, getting rid of employees, right? That's not really going to fly because it's just one-time cost cutting which is there. So I want to see if there is a massive acceleration in profit. I want to see if there is an acceleration in sales. So A stands for that acceleration in sales. The 53 part, the 5 stands for short interest. So the stock should have a short interest of 5 days or more. So if it has a short interest of 5 days or more, that acts as a fuel. And because the market is considering it as a negative story, or there is like the market the market has a negative opinion on it. Okay, so that's one. Now, if it is a stock which is well known by it is something which is like a stock which is covered by analyst and all, I look for whether the analyst, the 3 is 3+ analyst raising their price target. Because if there is a substantially new news which comes in the market, the analysts go and increase their price target. This is what happened on the day on which SMCI came out with this news saying, look, and they're going to beat by significant 10 or 12 analysts raise their price target for SMCI. So 3+ analysts, if they raise the price target, then it tells me that this is something where the analysts think this is significant, right? Because analysts raise their price target if there is a new information for them to raise price target. So that's 53. Now, this is out of this is the Magna part is must have. That's the must have part. 53 is optional. And then if you want to find something which is going to make more explosive move, then these cap 10 by 10 criteria are very important. And the cap 10 by 10 is the capitalization below 10 billion. The stocks which are capitalization below 10 billion are the one which are capable of making big moves, right? And when you look at CRDO, right? CRDO's capitalization is like basically 4.3 billion. So this kind of a stock can double, triple, right? Or like a Root. When you see Root, right? After making such a big move, its capitalization is 620 million. So if you look at when this catalyst came in on a Root, the day the catalyst came in on a Root, the day before that, its capitalization was just like basically less than 126 million. So if a stock has 126 million, can it double, triple? Yes. If a stock has like 100 billion as a capitalization, like say when I look at Moo, even if it has a catalyst, I do not believe Moo is going to double or triple. It is going to make 10 or 20% move. So that's capitalization. And then the 10 stands for IPO of less than 10 years. Most of the big moves in a stock happens in the first 10 years of their IPO. There are rare examples like NVIDIA or something which will move later in their life. But most of the time, like when you look at a stock which has Z-scale, right? And Z-scale has made a big move after its IPO. It's made this big move. just like in less than 4 or 5 years or 7 years ago. That's why in the first 5 years, it made those big moves. So that's my criteria for selecting a stock. So that's the criteria. And if the stock meets that criteria, then I consider it as a real catalyst.
Great. And do you have certain routines that you do every day and every week to keep track of new EPs that are coming to market, whether that's, looking at news, screening, pre-market? What do you kind of do to make sure that you're on top of any potential opportunity?
So in order to find this EP, all the work here to do it in pre-market or in post-market. So for that, we have a process which we follow, which we call it NTRT, MTRT, which is night time is right time, morning time is right time. So it's a checklist where every stock which had like an EP kind of a characteristic, if a stock had 39% sales growth, right? I want to know. I go through like I have certain sites, like I use the sites like the briefing.com, right? So briefing, now today is a holiday, so you don't see the thing, but like, so if I go on a regular day, you're going to see it will show earnings, right? So I go through this to look for anything which is growing earnings or sales. Then I look for like things. So briefings is one of the sites which I use. Then in briefings also, you'll see that they have this. This is my number one source of information for most of the earnings related thing. So they have this kind of a market summary, or they have these stickers where they tell you what is happening for the day, which stocks are up based on earnings, sales. So I will go through everything in the morning. By the time before the market opens, by 8 o'clock, 8:30, I would have looked at every stock. Like say Asan is an example of a stock which was up. There was a catalyst here. So I look at this site to find information. Then I have some other sources like the Fly, and then I have my own software which looks at how many analysts have raised their price target. So that's another thing which I look for. And as a result of this process, any stock which is meeting my criteria, I will know about it before the market opens. So if it meets my criteria of Magna 53 cap 10 by 10, I'm going to buy it at open, basically. Right. So this is a process. It is a process, and the checklist is there for this particular process. There is a checklist. And if a stock meets, and then I'm going to go and look at it. And it's the same process also I use for finding stories. So here is a stock which I bought yesterday, and it doesn't meet my criteria of like Magna 53 cap 10 and 10, but I know this is a story, right? There are going to be planes which are going to fly vertically. People will be able to go from one place to another in 10 minutes. You'll have a helicopter landing in your backyard. Science fiction, right? Sounds very interesting. And the stock is up like 17% based on that story. And a couple of times the stock has made 50, 100%. So I know this stock. I know there is other stock like this. So, or here is another one. This company from time to time makes these big moves. It's a story, right? And they have a solid state high density battery, which in our lifetime, sometime in our lifetime might come in. But from time to time, they come out with press release saying they got an order, something happened, and the stock makes 40, 50%. So that's the story. Again, those story kind of a thing, I find through my process of NTRT, MTRT. So that's the process for finding these stocks.
Yeah, great. And once a name is on your radar and you're either you're looking to enter it, what's kind of your process for doing so? I know you like to enter right at the open. How do you manage risk, right off the open? What's your process for actually entering the names once you've identified them as EPs?
So when I look at the catalyst and when I look at the strength of the catalyst, if I think that this stock is going to make a 50, 100%, 200% move, then in that case, means like I would willing to take a 10% stop on that kind of a situation, because I know this is a life-changing kind of a situation. It's going to make like in multiples of my risk. Otherwise, typically I enter at open, right, with a 2.5% stop. And sometimes I get stopped out and the stock makes a move. And if I believe in the catalyst, then I'll get back into it. So it really boils down to, if I have a genuine catalyst and if I believe in that catalyst, I'm going to go into that stock at the open, or I just wait for a few minutes to see how the market reacts, because a lot of time there are shakeouts, and then I will enter. Sometimes And good example of that is, again, yesterday itself, I looked at this stock, SRPT, right? I looked at the catalyst, I looked at everything, but based on my past experience of SRPT, I had studied this stock previously, I had seen its earning. I had this thing that it didn't react positively to earnings. So I had this thing saying, okay, this catalyst is good, but I'm not sure whether the stock is really going to react positively. So I decided that I'm going to wait for a delayed reaction EP on this particular stock, right? So I am going to wait for a delayed reaction. So I didn't enter this particular stock. Even if I had entered, I would have got stopped out probably because the stock went up and it faded, right? So then I'll wait for a delayed reaction. So I decide based on the strength of the catalyst, there are situations which are must buy. SMCI, when I saw the catalyst, I knew this is to be must buy, I just bought it. But SRPT, when I looked at the catalyst, I wasn't convinced that this is going to fly immediately. I thought like, and I'm better off waiting because it was gapping up too much also. So I said, okay, let me see, right? So 2 or 3 variations, tactical variations. Either I buy it as an OPG order, which is opening price guarantee, or I wait few minutes and buy it, or I decide to do it as a delayed reaction EP.
And could you walk through maybe a delayed reaction EP that you bought and kind of why you waited for that point to enter the name?
Sometimes like, and it just is like, so here, like, this is hymns, right? Anyway, I was traveling on this day, but like the catalyst was genuine catalyst, right? So I said, okay, this catalyst is good. Really, this is like, so I waited. And then when it had a breakout is when I bought it because that was the first positive day after that particular thing, right? And now sometimes what happens is this BA, when I heard the news of door opening in flight, I have some background. I worked for a cargo airline many years ago. So I said like, no way, this stock is going to go down, right? I shorted big position and I got stopped out on the first day, but I said like, this is a genuine catalyst, right? So I waited. And on this day, I shorted again with size. So it's like, once I study a catalyst and once I'm convinced about the catalyst, I just want to be in that particular stock to profit from it basically. And if you delay the entry, it doesn't work. Mobile, when I looked at what they are guiding down that day, I said like this stock is going to go down. But I know there are people, because it was gapping down 40%, there will be a short-term trade. So I waited and then I shorted it on this particular day. So delayed reaction EP is more and more what I'm doing. Also, when I started doing this, I was trading a 6-digit account. Now I trade significantly more capital. So it's not the same thing I can do, go on 100 million capitalization stock and put all my accounts. So I had to wait for delayed reaction or try and get a better entry. And I tend to trade more established stocks on EPs also nowadays as against these very small stocks. So that also drives the decision to get into delayed reaction.
And what's your process for scaling out and selling a position once you're in it? Does it depend on the catalyst? Does it depend on which variation on the EP setup that you're using?
Yeah. So before I take the trade, right, and I calculate in my mind based on my experience and the catalyst, strength of catalyst and all, how much the stock is likely to make a move, right? So when I looked at Aspen that day and looked at the catalyst, I said this stock is likely to make 40 to 50% move based on the catalyst, right? Now, unfortunately, the stock gaps up 27%. So what is the additional 20 to 30% additional I thought is possible, right? Basically. So I bought it, I had a profit and I put my stop to protect the profit. I got shaken out on this particular thing. I didn't re-enter. But incrementally, it didn't really make big move after that. Like, so I am like happy. But my calculation was this is going to make a big move. SMCI, I thought like based on that particular thing, it's going to make 70 to 80% move. I didn't think it will make that kind of a big move of 200% kind of a thing. But I was happy getting 80 to 90%. So always look at what is likely to be the profit on this particular trade. On the GPS, I think it was likely to make another 10 or 20%, 20% kind of a thing. It's not going to make double or triple, right? And so accordingly, I will decide my profit target, and I will decide where to get out. I will give it a room to run. If I'm genuinely convinced that this is going to go up 60, 70%, I'm not in a hurry to get out on that particular stock. But once it reaches that kind of a target, I don't want to overstay the party. In this CRDO case, I thought it will make a 40% kind of a move. And it made that move and started reversing. So I got out for a profit, basically. Right. So I always, before doing this, before getting into anything, I always have a profit in mind. And if that is what it does, and if it doesn't do that, and if it just hesitates after the entry, I will kill the trade, because I have seen the one which work, they just go like bullet. If they keep coming back, they don't work.
And what in your experience, and this might have changed over the years for sure, but what in your experience in a good market are kind of the success rates of episodic pivots or different variations that you trade?
So the classic EP, in a very good market, if the market really has like an 12 to 14 months of bear market and everything is beaten down and it comes, you are going to get 10 to 12 EPs, and then you can like, because everything which like, if you enter right, you can get like 70, 80% win rate. But like, you are lucky if you can get 3 to 4 ideas in a market like today, the genuine EPs, right? So I'm no more like in a really, means I will always buy EP if it shows up. But what really my focus nowadays is delayed reaction EP and 9 million EP. So where my risk is very low, because in a delayed reaction, I'm sitting there waiting for a good buy point to come in. And if the good buy points come in, then, so here, Deckers, I was waiting for a good buy point, and then I waited and entered it, didn't really make a big move. I'm waiting for this stock to set up again, because I think the earnings is good. Here, the earnings was good for the kind of stock it is. Like, it's not going to be phenomenal, right? And so delayed reaction, I waited and made. Sometimes, I thought like, this thing is going to make a move, GPS. I had a big position. Second day, it started rolling over. I got out, and I'm now waiting. So 9 million EP is where most of my focus is nowadays, and delayed reaction EP.
Okay. And 9 million EP is when 9 million shares are traded on that day?
Yeah. Suddenly, means like it is not trading that kind of a volume, and suddenly it trades that kind of a volume, right? And so it can be like most of the time this will be some sort of a story stock, right? And it's here is a classic example of like a trade which I did during the COVID-19 time on EP 9 million kind of a thing, and I didn't even understand why it was making that kind of a move, but like it was making that kind of a move. And the only reason I got into this particular stock was it showed up on that day in a EP 9 millions thing, right? And it just said like, look, hey, we are going to have like a space flight. We are going to colonize Mars and all, right? But like 9 million kind of like not here, like it's where is that 18 or 90 million it traded one day when Trump decided to announce here, right? You see like on this particular day, it traded a lot of volume, right? And basically, so as a result, the stock went up like for a couple of days. Again, same kind of a catalyst. Jeff Bezos goes into space and it trades like 50, 60 million shares. So it just went up, right? So, or recently, if you see GME, right? And here, it showed up in 9 million breakout. It showed up in 9 million breakout here, right? It's a story stock, right? And there is nothing there but just story. So if it shows up in 9 million, I'm going to buy. And there are certain stocks which tend to make a lot of 9 million EP in a year. Mara is an example. This is what I call the sugar baby kind of a thing. This stock, if you look at it, right, I calculate how many 9 million EPs the stock makes in 2 years, 1 year, 6 months kind of a thing. So if you see, Mara has made 98 9 million plus breakouts of 4% plus in last 2 years. For whatever reason, this stock, when it makes a move like that, it swings of just 3 to 5 days are like 40, 50%. So every time Mara has that kind of a setup and it is making that kind of a move, I mean, I just buy if there's a 9 million breakout and if it is at the start of a swing. Each of these swings are like big, huge swings. So those are the stocks where like Carvana, it's a story stock, right? Doesn't have like any reason why it goes up, but it just has 9 million. It makes 36% in few days. So these are the stocks, Coin, Affirm. So they make big moves. So that is what I do on 9 million EP. That's my main focus nowadays for finding like bigger moves, obviously. So these are like basically some of the things on the EP, which is basically a line extension or like saying, look, you had a Coke, now you have orange Coke, you have a green Coke, you have a vanilla Coke. So it's just the same idea of episodic pivot, but expanded to get a lot more setups. 9 million EP gives you anywhere between 100 to 300 trades in a year. Classical EP gives you only 2 to 3 trades. So that's why I like it. So that's as far as this is concerned. And you can see some 9 million EPs like Iron, which is a recent example, right? So here 9 million EP and it makes a move of 54% in less than a week. 9 million EP and it makes a move of 48%. I don't even know what it does. I don't care, but it shows up in 9 million, I'll buy. I do know what it does, but I'm just saying, right? Yeah. So same way CLSK or like the DropKing, which I bought couple of days ago, even though there is a genuine interest, like, yeah, it's a 9 million EP, it's going to make a move, right? So because it has multiple times made those kind of moves based on that kind of thing. So that is as far as EP is concerned, which is trying to move your account in a larger increments. These trades can move your account in 10%, 15, 20% increments in one trade, sometimes 50, 100%, right? Depending on how much you're risking on those ideas. But there is another thing which I trade, and I trade these singles. What I call this is like home run strategy, and this I call it as a single strategy, which is a momentum burst. In the case of momentum burst, I'm buying a breakout, or I'm anticipating a stock which is likely to break out and buying. These are typically trades of 3 to 5 days, 8 to 20% in terms of profit on a trade, or $10 to $300 on a swing. Now again, here again, when I started trading these things, I used to trade any and every stock. Nowadays, my focus is more on high price stock. So for breakouts, I focus exclusively on high price stocks most of the time. I don't really care about 8 to 20%. I care about if I'm risking $10, can I get 30, 40, 50, $100? So that's what I focus on. And the other thing is, if you want to trade these breakouts or anticipation setup, the best returns I've seen are either on biotechs and technology stocks. So if you just reduce your focus to just biotech and technology stocks, then you can make a lot of money. And if you have to trade this kind of a method, these kind of methods work very well when the market is going up or the market is favoring them. So you need a situational awareness filter. You can't be just trading them every day, because there are time periods when you're going to get chopped to death. Every single breakout you buy is going to fail. And there are times every single breakout you buy is going to work. So you have to figure out when your breakouts are going to work and not going to work. So every day morning, I create situational awareness. I answer one question: are breakout likely to work? If breakouts are likely to work, then I go aggressive. If they're not likely to work, I sit out. Okay. So and these are some of the examples. These are very simple trades, basically, like I'm just looking for some sort of a range expansion. So this is a stock which I bought on this particular day, right? Because it was up like an $11. And this is a stock which I traded like in the last 5 years or 6 years. I must have traded these stocks for every swing I trade, because it's a very nice, smooth moving stocks on both long and short side. So I risked $10 on this particular stock, and this is what it did in 4 or 5 days. It made $73 on that particular thing, right? There's a stock which is a sister stock of this, because I saw O'Reilly and I was in O'Reilly. I was keeping an eye on this one, AutoZone, and I saw AutoZone breaking out. So this day I bought it when it was up around $30, and I put $30 as a stop, and just 3-4 days, it's up around $160, $150, right? So those kind of trades in high price stocks are very common. Chipotle Mexican Grill, which is one of my favorite stock. I am very sad that it is splitting because that party is over. My money making idea in Chipotle Mexican Grill was every time it had a breakout to buy and just keep buying a small, because many time it breaks out and the breakout day is just like 0.5% or 1%. It is breaking out with 2% and it makes a move of 11%, right? So high price stocks is my thing for these kind of stocks. Daker, right? Anything which is priced above $100, especially nowadays $300, I'm always going to look for some sort of a like breakout. So here it's up like with 1% in 4 days, you raise $10, you made $45. So high price stocks is what I have moved my momentum bust trading to, because I find high price stocks have more smoother moves. They are more like the retail traders don't want to get into high price stocks. So I can do a smaller size, but it still makes good money. Or I'll go into biotech or technology. Again, in this particular situation, if you want to make money using breakouts, the most important criteria which I found is capitalization. Capitalization below billion, if you focus on, there are a lot of breakouts, especially if you're doing the smaller price or biotech technology. And the other thing is 3 sectors make the big, 3 sectors is where best follow through happens: biotechnology, technology, and consumer discretionary. So that's what, and then I anticipate some of these breakouts. I anticipate. So if I anticipate, then I get into this. But this high price stocks is like really my bread and butter in terms of this kind of moves. All day I can trade moves like this, 2.54%. I put a stop at half of the day's range and it goes up 31% into 3 or 4 days. So that's, and I trade them both long and short, but more on the long side than short side. That in a sense is the totality of what I do. I do anticipate some of these things. So if a stock is setting up nicely, I would be like looking at, so these are the stocks which I'm monitoring for, say now, Simera, Neogen, which are setting up. I would be in them. This already had a breakout, but like Dick Sporting Good. Now this is the kind of high price stock which I like to trade basically. So with that, over to you in terms of whatever questions you want to ask.
Yeah, for momentum bursts, could you also go through your 2 Lynch criteria, which
Okay.
is
Yeah, good question. Let me like do this. Okay, so let's say for selecting a stock, I'm going to use a 2 Lynch criteria, right? And basically in the case of like breakout, right? And if there is a breakout, let's like let's go to an example of this. It's a good example, which is like Chipotle Mexican Grill, which I traded some multiple times, but this particular example I'm going to take you to because that is a good example of that kind of thinking, right? And so here, like, and if you see, the stock had this first leg move and then it had this breakout. So this is what we call that 2 Lynch. So for 2 Lynch, what I look for is the stock should not be up 2 days in a row, right? It should be linear. I like to trade stocks which are very smooth, which are linear trends. I don't like to trade stocks which are all the time jumping all over the place, right? And you have some stocks which just like Chipotle Mexican Grill moves very linearly whenever it moves. AutoZone moves very linearly. So I like those kind of stocks. I don't like stocks which jump all over the place. Then negative or narrow day prior to breakout day. So the day before the breakout should be either a negative day or a very narrow range day. So we want to buy at the start of a swing move, right? So that's the thing. And close the consolidation quality. The consolidation which happens before the breakout should be orderly. There should be low volume. It should have like a volatility contraction in the direction of the breakout. And the last criteria is whenever I'm buying, if I'm buying it at 10 o'clock, 11 o'clock, or at 2 o'clock, the stock should be closing near high. So that's the 2 Lynch criteria. Now there are variation of these criteria also. If you have a stock which has like basically gone sideways for, I like consolidation. This consolidation, I like the consolidation to be less than 10 days. because I've seen if the consolidation is less than 10 days, then the breakouts tend to work well. If the consolidation becomes longer than 10 days, especially if it becomes a 1 month, 2 months kind of a consolidation, then even though it looks very attractive, the stock has a breakout and it fails. So I have a criteria for buying those kind of breakouts where we have tool inch plus CV, which is, it should have a high volume surge. So it should have a 1.52 times the 50-day moving average volume, and it should have a catalyst. I have seen if you buy a consolidation breakout without a catalyst, it tends to fail. So I look for CV, which is a catalyst plus volume for these kind of a thing. So that's the thing on momentum burst. Yep.
Yeah, excellent. I think that's super helpful. One thing I wanted to ask you, and this is more of like advice for people watching this when they're studying these setups for themselves, they're studying big movers to try to find and build setups. I know you every week you take a look at the stocks ahead, the big moves that week. Could you kind of talk about that process and your thinking behind that?
Yeah. So in fact, I do it daily. So
Daily.
every day I look at stocks. These are stocks which have gone up 20% plus in last 5 days. Right. So every day in the morning when I come to my office, I look at these stocks which have made 20% plus move and see, okay, why has this stock made the move? What was the, see, this is NNE, right? And what is the thing which happens at the beginning of the move? What really starts moves up 20% plus, right? Because that's my, I want to capture like moves up 8 to 20%. So I have to study the moves up 8 to 20%. It's like, if I want to become a millionaire, I will study millionaire in my town and find out why they are millionaire. Same way. So you see that typically they have 4% breakouts, right? Then I look at their capitalization. You'll see that their capitalization, and if you do this study over a large period of time, you'll see that most of the stocks which will make 20% move in a short period of time, they'll have capitalization below 10 billion. Most of them, in fact, will have a capitalization below 1 billion. So that's another thing. So I always look at these stocks. Same way, I look at stocks which are down 20% for the week, and I study them also because you want to see on the short side what works, right? And basically, so that's another thing which I look for. And the 9 million EP, I trade it on the short side also. So this was a 9 million EP on the short side also, just for example. And I also look at a stock which are up $20 plus, right? These stocks are up $20 plus because I trade high price stocks in last 5 days. So I focus on Netflix. I actually had a position I sold because it hit my stop, but I bought Netflix on this particular day and it made a move, small move. So I trade these high price stocks. So I look at anything which is up 20% plus, then I look at what really drives them, what happens at the beginning of the move. And I'm very happy that I found this O'Reilly. I found, I also traded SMCI from this last week. So that's a very good week when I find trades I made showing up in this particular list, right? And basically, so that's a good idea. Then I also study on the weekend. I study stocks which are up 50% plus in last 2 months. So these are stocks which are up 50% plus in last 2 months. So I go and do a deep dive on them. I look at what catalyst was there, or how did the move start? What is the capitalization? Again, you'll see that capitalization below 10 billion. If I had to give one advice to anybody who's starting out, focus on stocks which are capitalization below 10 billion, right? And second advice, if I had to give you, is news, because almost every one of these stocks which I made a 50% move had a catalyst. So news moves stocks. Chart pattern doesn't really matter. If there is a news, Chewy had a news. Because of that, it made. Each of these stocks had a news, and because of that, they made a move. 50% move, if you want to find in short period of time, focus on news, not chart patterns. Means chart patterns are important, but like why did this stock make a move? Because there is a catalyst, and then try and find out what catalyst makes stock go up. Why? There is a catalyst here, right? So catalyst is very important. Capitalization is very important. Those are the two things which I think are the essence of understanding news. Pay attention to news.
Excellent. And I want to ask you to expand a little bit more on situational awareness and how you develop it, just because I think it's so important and you emphasize it so much. So could you talk a little bit about what the concept is, maybe touch on the market monitor that you keep, and just in general how you track, how aggressive you're going to be, what type of setups you're going to focus on. All of that would be great.
Okay, so I'm just going to erase this particular page so that it's easy and it doesn't become all mixed up. But like, let's go a new page and then look at situational awareness. So situational awareness is an overall filter on all my trading. Basically, it's an overall filter which is going to determine whether I'm going to buy breakouts or not going to buy breakouts, whether I'm going to be like getting very aggressively on margin, or whether I'm going to be like putting in a lot of trades, or whether I'm going to go in and first 10 minutes, 15 minutes, I'm going to put a trade or not. So this is a filter which basically allows me to calibrate how aggressively I want to trade, basically. So it's an aggressiveness filter, basically. I call it an aggressiveness filter for that reason. So in order to do that, I'm just trying to answer every day in the morning one question, and which is, are breakouts likely to work? Right? And if breakouts are likely to work, then I want to buy breakouts. If breakouts are not likely to work, I might see a lot of breakouts in my scan, but I'm not going to do a breakout. So in order to do this, I have multiple sources of information which allows me to develop situational awareness. One of the tools which I use is what is called as a market monitor, which basically monitors market breadth at a very simple level. Like this is a tool which I developed many years ago, 20 years ago, or more than 20 years ago, which every day looks at whether there's a buying coming or selling coming, what is the buying pressure, selling pressure in the market on different time frames, right? So when you see here in the last 1, 2, 3, 4, 5, 6, 7 days, there was more selling than buying. You also see that there are a number of stocks, 25% in a quarter. There are more stocks down than up. There are 104 stocks which are down, or 126 on this day, then up 25% in a month. So there is a selling coming into the market, right? So as a result, there are only select stocks which are working, and there are a lot of stocks which are breaking down. So this essentially, when all 4 columns are green, when all 4 columns, these 1, 2, 3, and 4 columns are green, it's good time to buy breakouts. If any one of these columns is red, you're going to get a choppy market condition. To simplify, like we can go into more details of this, but it's going to be a long time. So I'm just simplifying it for people, right? Whenever these 4 columns are green, your breakouts are likely to work. So that's one of the things, right, I look at. The other thing I look at is this 20% study, which I talked about. So this, what I found is this 20% study is like a oscillator. So if the 20% study has low numbers, if the numbers are like below 20, if the numbers are 10, 14, 15, then you see a lot of buying comes into the market, and for next 5, 6 days, breakout work very well. If these numbers go above 100, then you see that the market tends to get hit with selling. So this is another thing which I look at it. The other thing which I do is like, we didn't really get time to talk about anticipation, but like I have an anticipation method which I have discovered, which is more like rather than me discovering, the members have discovered, and I use it nowadays. So I monitor these stocks which are up 15% plus in last 10 days to look for a second leg on them. So these are stocks which are up 15%. So I go through all these stocks. And when I go through these stocks, I see that this stock, instead of setting up nicely as a continuation setup, has failed, right? So that gives you an idea. When you start looking at this, or you see like the breakouts are not really having 3 to 5 days moves. Many of them are just like not really going and following through. So here, like there was a first leg established, but it failed. So that gives me a hesitation, or it tells me, look, a breakout's not really working. So combination of this is going to determine this. In addition to this, whenever I look at this 15% study, or whenever I'm looking at any one of these things, I'm always looking at what theme is working, what kind of stocks are working, what sector is dominating this, because this is stocks which are made 15% move in last 10 days, anytime during last 10 days, right? So I know what sectors are working. I know, like, if you look at the semiconductors was working, AI related was working, biotechnology. So then I know what to focus on. So that allows me to focus on certain things, right? So as a result of this, there are times when I'm very aggressive and there are times where I sit on hand, right? And then all that it does is it allows you to not get, see, if you get chopped, it's very frustrating. And as a result of getting chopped, you start changing your methods. A lot of time when people start getting chopped, they start dropping their holding time period. Soon they become day traders and soon they become scalpers. And then they cannot get back to doing swing. They cannot get back to holding 3 to 5 days. So I try to avoid that. And I try and trade more aggressively when situation is in my favor and chopped when it is not in favor. Plus, where I am in my life situations and conditions, today I don't need to trade every day to make money, right? And I mean, if I don't trade anymore ever in my life, I'm fine. So I am very selective. I'm trying to like avoid all times of like under all conditions. What I'm trying to avoid is getting chopped or getting into a negative this thing. So that's why I have a philosophy which I operate with nowadays, and which is find a situational awareness where you can find free money, right? Where your breakouts are working, things are working. That's where you go aggressive. Rest of the time, just like close the shop, don't get tempted, and sit on hand or like do something else.
And would you say this is one of the common problems or mistakes that traders make, is they're trying to always be the same level of aggressiveness despite whatever the market condition is?
Yeah, they are over trading, or they are like trading in market conditions where the breakouts are not likely to work, and they get chopped and they get chopped, and then as a result of that, they lost confidence. And I see it all the times, right? This works both ways, right? You can get chopped, but there are times when I see my 20% plus study is going very like to 100 and all, and that time people are overconfident because 5, 6, 7 days in a row, breakouts have worked like charm. So they are like thinking, oh, I'm a genius. I have moved my account 20% in last 10 days. I'm going to buy an island. On island, I'm going to have a bikini-clad woman waxing my ear and polishing my Ferrari. And then the coconut falls on their head. And so as a result, this lack of situational awareness is what in the beginning years or for a lot of trader creates the
swings.
swings in their equity curve or their mood, right? And if your mood is swinging, your equity curve swings. Right. So that's the means. These are all, see, in retrospect, sitting here, I can talk about these things because I survived and I developed these things, right? And but for a beginner, he doesn't even understand this is his problem. So even if you tell him that this is his problem, it's very difficult for them to even accept that this is the problem they have.
Right.
So, right.
For traders who are watching this, who may be very early in their learning and with regards to trading, do you have any advice for them in terms of developing a system, becoming more process focused, particular setup that they should focus on
for beginner
first?
trader, my number one advice would be to find something which is structural in nature. Right, which is something which is like the Newton's law is structural, right? If I throw this bottle, it's going to come down, right? And it's not going to go up. Find something which is structural in the market. Momentum is structural in the market, right? Means people have done PhDs on this, or PEATs, which is post-earning announcement drift, which is basically the idea behind EP is like based on that, right? Or whenever there's a volatility compression resolves with a range expansion. That's a very fundamental structural nature of the market. So if you or news moves stocks is a fundamental thing, right? And that's like every week you look at the stock which made a big move, it will be based on news. So this is so fundamental or structural to the nature of market. If you base your trading based on that, you will increase your profitability potential or your probability of becoming successful. Second is, I talk to a lot of traders. As you know, I run a site, and I also talk to people outside the site. And a lot of time I talk to people. Every week I talk to people. And I will tell you, 80% of the new traders don't have a setup. And they don't know that they don't have a setup. So first find a setup. And for that, I would advise the easiest way to find a setup is to just copy shamelessly. Copy shamelessly some setup which has worked for someone. That's the easiest way, because you don't want to reinvent the wheel, just like do it, and over a period of time, then you can develop your own style. I copied shamelessly the Mark Butcher method, and then I developed my own things based on that, right? All actors, when they start acting, they're copying some famous actor, right? That's why. And then later they develop their own style. Or the Chinese copy US ideas and just pass on to us and sell to us, right? So same way, copy shamelessly. And the other thing is basically do a deep dive. Do a deep dive. Go and if you're going to be trading breakouts, study 5,000, 6,000, 10,000, 20,000 breakouts before you put $1 on a breakout. If you want to trade your EP, study 100, 200, 300, 500, 8,000 EPs before putting one money into it, right? And then that will give you the real expertise in trading is not going 5 feet deep, is not going 50 feet deep. If you can go 500 feet deep, if you can go 1,000 feet deep, you can go 5,000 feet deep, then you start understanding, right? I study 20% plus every day. I've been studying it for so many years, right? And I discovered a pattern on the short side, which I didn't see it. In retrospect, when I see it, I how did I miss that, right? So there is always something which you're going to find when you go deeper into things. And I don't know of any trader who's been successful, he may not use the term dive, but the methodology which they used was something similar to deep dive, where they studied past winners, they dived deep into it, and that is the success, which is there. That is why they're successful, right?
And is that how you notice and develop the different variations on your setups and how they're changing over time, or?
Yes. So this 9 million EP and delayed reaction EP, I developed by studying the 50% plus moves in 40 days. Because when I looked at them, I saw there were high volume spikes, or when I studied these big winners in a short period of time, the only thing common with them was news and high volume spike. So I said, okay, what is the magnitude of that spike? Is it 5 million? Is it 6 million? I noticed that it's around 10 million. So I gave it a room to run of 9 million, and I decided to focus on that. So everything which I do comes from my deep dive and continuous learning from the market, basically. Yeah, it's the same thing. I see every day people telling each other that stocks which hold up the best are the one which go on to make a move. If you do a 50% study, you will debunk that in 5 minutes, because the stock which go on to make the biggest move, they don't come from the stocks which are holding up well. They come from the stocks which are beaten down the most. Right. Now, that's what it creates an edge, because otherwise, if you're taking a second-hand edge and just saying the same thing others are saying, then you're not going to believe that. But when you look at the stocks which make 50% move, they all have one thing in common. They have news, and they are coming from a weakness. They're not coming from strength, right? They're not coming from strength, most of them. They come from some place where they were beaten down, and then they suddenly make a 40-50% move. And this is a very common pattern which you're going to see. GME, nobody was paying attention to it. It comes from nowhere, right? So the more the stock is neglected, the more likely it is going to make a 50% move. Now that's an edge which you can develop by doing a deep dive, which you are never going to do by just reading books on trading.
Fantastic. I think that's all the questions I had for you, Pradeep. But first of
mhm.
all, I want to thank you for taking the time to walk us through both of your setups very in depth. I really appreciate it. I think what you presented was very dense. So for everybody watching, I'd recommend watching multiple times, because you're going to get something out of each time that you watch this. But Pradeep, thank you so much. Is there any kind of final message that you want to leave everybody with today?
Yeah, I think if you want to become a profitable trader, have self-leadership, because this is a game of self-leadership. You have to be really motivated to do this. This is not for everybody. Unless you have self-leadership, you'll not make it in this business.
Great. Well, we'll leave it at that. Thank you again, Pradeep, for your time and for putting this together. To everybody watching, make sure you leave a like down below, subscribe if you're new to the channel, and we'll be right back. Take care. All right, welcome back, everybody. I'm very excited to introduce our next guest, John Burns, who is a senior consultant and performance coach at the Rethink Group. We will be discussing all things trading psychology, mindset, and developing that into an edge. John, thank you so much for being here, joining us once again. I really enjoyed our kind of panel discussion with the Rethink Group last year, and really looking forward to diving deeper today with you.
Yeah, thanks for having me again. I'm excited about doing this with you.
Perfect. To give a little bit context for everybody watching, would you be able to kind of dive into your background, your journey, and maybe, some of the work and types of things you do over at the Rethink Group? I think that would be great.
Yeah, absolutely. So let's see, I started on the trading floor at the Chicago Board of Trade in 1989, I believe, as a runner, kind of between my freshman and sophomore years of college. And then after I graduated, well, let me just put it this way. For the first day in the trading pit, I was running an order in the first day on the trading floor. I was in the soybean pit. The bell rang. Pandemonium ensued. I got goosebumps. And I'm like, this is what I want to do. So my college career was spent trying to learn as much as I could about trading. And I think I read every pamphlet, educational document that the Board of Trade and the Merck and the NYMEX and the other exchanges, whichever they were at the time, as my education. So I worked on the floor each summer after that, started with a prop trading group right after I graduated college, trading options. It was about a year and a half, and then I started trading options, traded feeder cattle options at the Chicago Mercantile Exchange for about 17 years or so. Lots of different markets, mad cow, just total pandemonium. Just loved every second of being a market maker on the trading floor. Mm-hmm. And as the market started to transition to more computerized trading, as the advantage kind of shifted, the information flow advantage shifted from on the trading floor to off the trading floor, it became obvious that I needed to transition as well. Mm-hmm. Part of that process was I developed different types of trading strategies. I traded mechanical and discretionary systems, trading all sorts of futures contracts kind of around the world 24/7. That was a tough transition for me as well. But when we went from trading 9:05 to 1:15, 1:30 to trading 23 hours a day. So that was part of my transition as well. And toward the end of my trading career, professional trading career, at least trading other people's money, I was to trade my own money. I was introduced to Denise Scholl, the Rethink Group. It was a different name at the time, but she was my trading coach off and on for about 5 years, I think. As the second iteration came around, as I was really trying to transition and trying to understand what I was trying to do off the trading floor, she said, you'd be good at this coaching thing if you wanted to do it. So I said, man, I'd love to, because one of the main things I learned is that on the trading floor, the more I traded, the better I did. Off the trading floor, the more I traded, the worse I did. So having something in there that forced me away from my screen, meaning talking to a client, actually helped me trade better. So as part of that process of being a coach, I started taking classes in modern psychoanalysis. Working with Denise is kind of in a supervisory fashion, kind of a mentorship almost. And, I've been taking classes. That was 2016 or so, I think, when it started happening. And I've been working through a master's of modern psychoanalysis. I've gotten more into neuropsychoanalysis, which is Mark Solm's kind of affective psychology. And, part of that process, I also started working with clients. So I work with all sorts of different clients, mainly in finance, but I also have a COO of a company, wealth managers, a fair amount of retail traders, PMs at some of the biggest hedge fund and asset managers in the world. And I've also worked with professional athletes, NASCAR pit crews, and Major League Baseball players. So that's kind of maybe a longer version than people wanted to hear, but that's kind of where I am.
No, I think that's fantastic. And one thing I wanted to kind of touch on today is kind of what it looks like when a client first comes to you and decides to work with you. What does kind of the first meeting with them look like? What exercises are you maybe giving them, and what assignments are you giving them to help identify what areas you want to work on them with. So kind of led me into the first few meetings and talk a little bit about that. It's like, because I think that'd be helpful for everybody out there who wants to learn more about trading psychology, wants to kind of work on that aspect of their game. As we'll dive into, understanding your emotions, reading your emotions, and being aware of that is an edge, as we'll get into, I'm sure. So yeah, kind of talk me through the first few meetings and what kind of those look like with new clients.
Absolutely. Generally, the first meeting is kind of a get to know you type of a meeting. Are we going to be good together as coach and client? And if that's a yes, typically that meeting's 30 minutes. My meetings generally, my appointments are 55 minutes or so. And in that first appointment, I like to get somebody's background. So I'll ask them to tell me whatever you want to tell me about growing up. Did you have brothers and sisters? How were your parents? Did both of them work? What did they do? Were you good at sports? Were you good at music? Were you into theater? And then how did you get to where you are now? And that process gives me a lot of information. One, how much can people really describe about their past? Two, what are the important things in their minds? And three, how open are they to things from the past influencing the present? That's one of the tenets that we use of, experiences in our past, I believe, get embedded in our psyche. And Mark Solms talks about it as we make a prediction automatic because it's the best we can do at the time. So when we're young, we don't have all the faculties that we have when we get older. But, if we think that the prediction is if we just don't say anything when our parents start to get upset, or coach or whomever, that things will work out best, then we take that with us over time. So some of that is understanding, any clues that a client could give me in the description of those types of situations. And also how they look back and see their past. Did they think it was really good? Did they think it was really bad? Was it just okay? The relationships that they had within their family or coaches or teachers or whatever is also good information. So then I take that, and also in that first session, we decide, what are we really working on? Is it just this one trade that I can't do, or I always get in too early, I always get out too early? And those two things combined take us from the first appointment to the second. Now, typically after that first appointment, I take what they say they want to work on and say, okay, that getting in too early, look back on 10 trades. Getting in too early, what does it mean? Why did it happen? Was it really too early or was it wrong? Really dive into that. And two, collect any random thoughts that happen. I love the random thought because I believe it's our unconscious giving us just a little whisper, a little clue. And what I mean by collect it is when that thing happens and you're brushing your teeth and you think about a trade or you think about an experience from the past, just remember it, grab it, think about it. Okay, I wonder why that happened. And that's all we really need to do, because I think our unconscious is kind of like a dream. Dreams are our unconscious, I believe, speaking to us. So if when we wake up, we write that dream down, it stays with us. If, on the other hand, we just say, I'll think about it later, it's gone. I believe that's how the unconscious works with these random thoughts as well. And I believe collecting them over time gives us a pattern we can work with. So that's kind of the first appointment into the second appointment that I try to do. Was that?
Yeah,
give you
that's
information? Yep.
that's super cool. And a realization I made maybe over the last year and a half or so is that from my parents, especially like financially risk taking wise, I've kind of learned to be a little bit more on the conservative end, and that's led to sometimes me not letting trades work and go through natural fluctuations, and so that's something I kind of been gathering, and working towards and building rules around all of that. So yeah, very interesting, how the past can influence our trading. Even things that seem unrelated can have a huge impact. So
Absolutely.
yeah. Um, are there any other really helpful exercises that you found doing with your clients that can help unpack kind of, things that they have going on, or how things from the past are influencing their trading?
Mm. Well, I'd just like to say that that's an excellent example that you just gave, Richard, is this idea of just understanding those things.
Hmm.
And I believe just the realization of, I generally take less risk, I especially get nervous in that, I like to call it the kind of the shoulder moment of the trade, where it's kind of working, but not really working. And all the
Hmm.
anxiety starts to come up. And, in the past, I would find myself watching every tick. When it would go my way, yay. When it go against me, oh no. And that grind of those intense emotions happening 1,000 times in 2 hours, for me, I found with my clients, is just too much.
Hmm.
Usually we want that feeling to go away, so we get out. And when we get out, the feeling goes away, meaning that intensity of yes, no, and it goes away, but then the trade starts to work usually. And sitting through that, um, understanding, like you said, you have this thing that is pattern that happens time and time again. And just being able to recognize and say, there's that pattern again. What have I done in the past? Watched every tick. Okay, maybe I should get up from the screen because I have a risk stop in place, or whatever. You manage your risk properly, where that's the assumption.
Yeah.
And so getting up and walking away and saying, those are these feelings, but they're just feelings. And they're probably, like you pointed out, probably not about the market. They're about something from the past. And so, again, these are the things that I dive into with my clients. And, I think we all have patterns like this. We all have patterns. And one of the jobs that I do is I like to tell my clients, talk to me in the way you think about the markets. I have a guy who's a global macro trader in Brazil. And he talks about, Colombia rates versus rates in Peru. I have no idea about that stuff, right? I just don't follow it. That's okay. But as he talks about it over time, I start to understand the pattern in his thinking, and I can ask good questions to say, well, what about this? What about that? And help him clarify his understanding. Now, that's not necessarily a thing about the past, but it's more about patterns of how I hear things and listen for. I listen for patterns of thoughts and behavior, and then ask questions about that to try to clarify thought. Because I've also found that in the best moments, there's conflict, right? That trade that we take and we're like, I'm going to buy a G4 after this, or whatever a plane is. Those are the trades that don't work. The trades that are like, man, I'm going to take a quarter of my size because I'm really afraid that this isn't going to work. Those are the trades that work. Over time, working with Denise and on my own, I've learned that for me, some of these patterns are when I would have a trade on in that shoulder moment where things were murky, and I would say, well, that's why I have to stop. Over time, I realized once that combination happened, I got stopped out. So over time, when I had that moment happen, that's why I have a stop, I would get out of the trade. Over time, it saved me a lot of money. It's hard to do, feels a little like guessing. But again, that only happens if we have a structure that is repeatable over time. You talked about edges, and I have this theory of stackable edges.
Hmm.
And the first edge is our trading setup, system style, whatever. And it's a structure. It's a pretty firm structure initially. And Van Tharp used to say his super traders couldn't graduate the program until they traded their system, 98% act within the rules. I believe that that's step one. That's edge one. After we have that, and that's repeatable, has a positive expectancy, then we can add other edges. I believe physical fitness is an edge, right?
Mm-hmm.
Because it helps us bleed stress, also gives us a resilience to take stress. And this game, stress is just part of the price of playing. If you don't want stress, do something else, and that's fine. Then this other edge that I'm talking about that we do with our clients is the emotional edge or the intuitive edge. And we develop that over time. But that only works if you have a system that is repeatable. I found this phenomena where retail traders who are early on in their journey, they find intuitive trades all the time. But when I work with guys who have been around for a long time, they're a little more dubious about the intuitive edge, right? The one person that shouldn't be is taking it. The one person that probably has it is a little bit more dubious. And I find that it's an interesting interaction with both.
Yeah, and I want to dive into intuition a little bit because I think
Yep.
it's really fascinating. But I have one question first. Sorry about this,
Yeah.
but you mentioned it's really important to have that structure to kind of work on developing that edge. What kind of for you? What are the recommended things to start building that structure? Is it journaling your trades? Taking notes. Talking to yourself, even recording yourself as you're taking a trade. What can we do to collect the data and then also start building a structure around that?
Yeah, great question. I think knowing your numbers, I think, is kind of the entry level position of, okay, what's your average win, what's your average loss, what's your P&L structure, understanding all of those things.
Mhm.
Where is your trading edge? What makes that moment, whatever that moment is, an edge in your trading that's repeatable? And everybody has a different version of that. And I think being able to be as specific as possible. I have a guy who is actually a cardiac surgeon as a client, and worked with him for a while. And over time, he was able to communicate to me what he was trying to do with such clarity that when he would say, oh yeah, I'm looking at whatever, Australian dollar.
Mhm.
And I would pull the chart up. He's one of the guys, or was one of the guys, who I went through charts with. I would pull the chart up and I'd know where he got in within a day or two. To me, that's the type of structure that we need. We need to have that type of clarity around what we're trying to do. Without that, all the other stuff is harder to make a difference with. Did I answer your question? I don't feel like I did.
I think my question was maybe more about not the technical edge, but more getting into the trading psychology edge and using the emotions. So collecting, make working on that, stretching that muscle, working that
Yes.
muscle. Yeah.
Yes, sorry. So yeah,
No worries.
definitely externalizing that thought process, whether that's writing it down, whether that's speaking it out loud, whether that's working with somebody who doesn't have skin in the game, who can listen. In my career, a risk manager was okay. They still had skin in the game. But I found that externalizing it helps create clarity. A client of mine said this to me one time of, it's really helpful for me to be in the space with you and say something that I'm thinking out loud. Because if you understand it, then it's clear. But sometimes it's not clear. I had this experience in one of my classes. I was thinking through this psychoanalytic concept in my mind, and I brought it to my class. And I asked my professor and the students, I kind of laid out this question, and they had no idea what I was talking about because it wasn't very clear. And so my point is that told me, okay, I need to think about this more and work on it more, let it saturate a little bit more before it becomes clear. And I think that journaling and speaking things out loud, when we go back and read them and we look at it and say, wait, what is this again? That means, all right, I need to highlight this because I need more clarity around whatever concept this is. And there will be other times where it's very clear. We read it, we remember the trade, we remember the moment. And so maybe that's an area that's a strength that we don't need to work on quite as much.
Yeah, that makes sense. Yeah, very, very interesting. And one more question before we dive into intuition and that side of things. I want to ask, as a performance coach, have you kind of made any observations or found any commonalities between high performers, whether they're top traders or athletes, or really there's kind of a diverse makeup of personalities, whatever, however you want to describe somebody, and kind of everybody can find that path to be successful in a performance type type environment?
Yeah, another great question. I think that the best performers are the ones that are all in. They are totally committed. I work with a baseball player, a pitcher, and he was totally committed to his craft. His workout sessions were unbelievable. He worked on very balance, and he was able to, go through his pitching motion forward and backward in slow motion. So total commitment to craft and being very focused on what you're trying to do. And I believe the best traders do the same thing, or investors or whatever. They're totally committed to their craft. They not understand exactly what they're trying to do. Not that they don't try to get better, but they introduce things slowly into the process, where they have something. I'll go back to the pitcher. This pitcher was really good, and he was introducing a motion that would slow it down or speed it up and try to mess with the player's timing. And he became very, he didn't commit to that as much. And so it came in every now and again, but only when he was feeling really good. And to me, adding something like that in practice, in trading, we can do that via going back and looking at charts and adding this little thing, and then slowly introducing it into real-time trading, maybe at a quarter size, and seeing how that works and how that really plays out in real time with the pressure on, with the feeling of the game or that. And so I believe being very specific, understanding what you're trying to do, and adding learnings or nuance in slowly throughout the process. I also believe that with the highest performers, this nuanced side of emotion and intuition has an outsized ability to increase its performance.
Interesting. And you kind of mentioned there, or mentioned previously, that it's the guys who have been doing this for decades who don't really tap into that intuition. What do you kind of make of that phenomenon that it might be their greatest edge or a great edge if you've already built up that skill over time, but they're not trusting it or all that? I'd love to hear your thoughts on kind of that concept.
Yeah, well, most of them use it in some way, but it's not explicit. And when we start to make it explicit, it's a little harder to add into the process. So what I mean by that is that, traders who have been doing it successfully for a long time know exactly what they're trying to do, but they may not have it spelled out step by step, which is fine. But when they come to me, they usually come because they're trying to make things more explicit. They're trying to grow and learn a little bit more. So that's when I really start to dive in and ask these questions and then try to explore these things. Like, for example, I have a client who's an asset manager at a $3 trillion asset management company. It's massive, and they run a lot of money. And so initially we started asking about his process, and it started to slowly creep out that the CEO and the CFO were important parts of his process, and how they answered questions about the numbers, how passionate they were about their employees and the business, and how clearly they were able to communicate those things, and really how forthright were they without crossing the line. Those were the things that he used, but we were able to then really say, all right, this is probably one of the more important parts of the process. After these 3 steps, this jumps to the top. And we were able to reorient how he really thought about things. He was doing it anyway, but we made it more explicit so he was able to more fully focus on those things, therefore make better decisions about his investments.
Yeah, that's cool. And analyzing a management team, that's not really something you can objectively create it is very intuition based and, soft skills. So that's really cool.
Yeah.
And taking a step back just for a second, just because some people watching this maybe aren't super used to the idea of tapping into their emotions. we're kind of taught by a lot of resources growing up, you got to push everything down, be as robotic as possible. Could you talk a little bit about the process of decision making and how emotions can come into play and either, help with that or negatively impact kind of our judgment making?
Yes, another great question. And I suppose I should have gotten to this sooner. So thank you for bringing this up. So we know that we're always predicting the future. You're predicting the words that are going to come out of my foot, right? Like good comedians use this prediction against us and create that disconnect that makes us laugh. And so our brain is always, or we're always using the memories from the past and feelings in our body to predict the future. That's why in neuroscience, they talk about memories are about the past, but for the future. And so emotions are embedded in memories. That's how we remember them. And so when emotions come up, they create this prediction. And as I talked about earlier, sometimes in the past, we create predictions that aren't accurate. They don't match the reality of the world. And there's this idea of the free energy principle by Carl Friston that talks about this idea of prediction error. And so when we make an error in prediction, we can do a few things. We can update the prediction based on new information. We could ignore it because we think we're right, or do something in between. And so when something is automatic, meaning we have the feeling, we have the response, that's when we ignore the new information. But through bringing that process up, externalizing it by talking about it, we're able to then create a better response. And sometimes I talk to my clients about it. It's this idea of, we make that mistake, whatever our mistake is, we get out too early. And we realize it, that we did it, and it doesn't really mean anything. We know we do it. And then we start to externalize it. We journal about it. We think about it. And then we realize that, when you journal at the end of the day or end of the week, I did it again. And then slowly, as we become more aware, that timeline moves back to before the decision needs to be made, and we have a choice about what to do. And really, the choice is where we need to be. Sometimes we're still going to get out too early, and that's going to be a conscious choice. And once we get to that spot, then we're able to really make changes because, okay, why was that the choice? Well, I was afraid, right? We get to the point where you are, Richard, where you're really thinking about, okay, this is happening and it's happening for a reason. Why is that? And when we start to dive in, we get to this idea of, it's coming on again. What would I like to do? And that gives us the choice. So does that answer it?
Yeah, I think that's a great place to start. And these externalizations, how do they kind of show up often? Is it something like getting sweaty palms, tapping your foot, stuff like that, or is there a different way to think about it as well?
That's great. So for me, on the trading floor, my ears would get red when I would feel that pressure, and I'd get stuck on a trade, or there'd be a juicy one sitting there, and I wanted to make sure that I felt what was going on with everybody else, so I jumped it before everybody else did. My ears would start to get red, and on the trading floor, that was kind of a thing that we could make fun of. So they did, and they pointed it out every time, and so I was able to make that connection. Yes, it's the sweaty palms. It's the tapping of the foot. It's the stomach ache. George Soros used to, there's lore of Soros when his stomach ached, he needed to get out of his position or get into his position. I forget what it was, but using that somatic input, excuse me, as information, because that's information too. Oftentimes what happens is if we're unable to process the emotions psychically, they get expressed through our body. And that's the sweaty palms, the racing heart. And I believe that we have this range. Again, a concept from neuropsychoanalysis is kind of homeostasis. We know about homeostasis with our bodies, blood oxygen levels and all sorts of other homeostatic things that get taken care of by our body naturally. I also believe there's homeostats for arousal. And so, for me, I like to be a little jacked up, a little excited. So if I get too calm, I can't make good decisions. I've learned that over time, even though, to your point earlier, when I was on the trading floor, it was all about, take your emotions out of it.
Right.
And so naturally, I learned over time that that was nonsense, because when I did that, I traded terribly, made bad decisions. I was always nervous. And for me, I love adrenaline. I love being excited and nervous. But conversely, or I guess the same, if I was too excited, then I couldn't make good decisions. Then I get stuck in the moment. And for me, it was this idea of mad cow, wow, exploded. And it was crazy. And I loved it so much that I didn't do a very good job recognizing it. It's kind of over now. So I wanted to hold on to that past feeling when I really needed to realize the game's over. I need to get out of all my vol and get really tight and manage it closely. And so, those are a couple examples of how we can kind of figure out what our range is. And everybody's different. Some people are super subdued. So they need to be, from 1 to 10, they need to be 2 to 6. I'm more of a 4 to 9 type of person. So again, that's what I try to help my clients figure out as well.
Yeah, and when you were saying that, I was kind of thinking, one of my favorite pastimes, and I grew up playing competitively, is sports and athletics and soccer specifically. And during when you're in a tournament final, it's about to start. There's this like tension, adrenaline, buzz you're feeling, and you're elevated, but you're at a point where it like focuses you, and it's not distracting. But there's also those players who, in the moment, they get way too heated and then they make a foul or become overextended. So there's a balance, like you said, an arousal level that's helpful, beneficial, that helps you stay focused, see the game sharper. And then there's either too less where you're not in the game, or too much where it might cause you to do something else. So any thoughts to add on that? Because I think that's pretty cool.
No, I think that's really well said. And for me, like I said, I get excited, and I remember I was going out to play golf. It didn't mean much. I was playing at a course I love with a person I haven't played with before. He was actually a sports agent, but he was a friend of a friend, brother of a friend, and my hands were shaking. I was nervous, but my mind was saying, wait, there's nothing to be nervous about. But my body was telling me that I was nervous or excited or whatever. And so instead of saying, this is ridiculous, I turned to everybody. I'm like, look at my hands. They're shaking. I'm nervous. And this great conversation ensued where the agent, who was also a minor league baseball player, said, yeah, I was nervous before every game. It's just part of the deal. And so by just recognizing that and saying, my body's telling me I'm nervous or excited or whatever, it was able to kind of normalize it. And I played great because I had that arousal level that was appropriate. If I would have told myself, no, what are you, crazy? There's nothing to be nervous about. It would have been a disaster. And that's kind of the idea of emotions are there to help us. They're there to tell us something matters. And when we notice them and are aware of them and embrace them, they flow through us like the breeze. When we try to ignore or change or make it different, they get stuck. And it's almost like, I like this image of trying to hold a balloon or a ball underwater, right? You can do it for a while, but eventually it pops out, and it usually pops out in a different spot than it started. And so the idea with an emotion is it has this emotional energy. And if we try to hold it down, on the trading floor or in an athletic event or whatever, it comes out later where, I'm screaming at somebody because they cut me off, or, something happens at home and I get mad. And this is another checkpoint I use. If the emotion doesn't match the situation, it's usually about something else. And so if I get super angry about something, I say to myself, is this an appropriate reaction? No? I wonder what that's about. And sometimes just the question is enough to kind of ease things down. I think that's a nice place to start. And again, this idea of emotions, of writing down emotions when we're trading, is a great place to start. If there are no emotions, which is sometimes the case with people who start doing this, write down I don't have any emotions. I don't feel anything right now. My left foot hurts. I'm hungry. Anything, just write down anything. And eventually the words start to change into emotion words. I had a trader who traded natural gas in Asia. And he was this way. He couldn't have any emotion words. And it was early on in my coaching. So I kept asking, well, what emotional words can come up? Terrible. And so I was consulted or advised to say, well, what thoughts are coming? And so the thoughts were very mechanical for a long time. And eventually these emotion words started to come into the equation, which to me was showing that he's making progress on understanding what he's really feeling. And so again, this is a great thing to do. Write down when you're in a trade or about to take a trade, any emotions that come up, any thoughts that come up, any feelings that come up. And starting with anything up to and including nothing's coming into my mind. How could this be possible? Or whatever's there is a great way to start this process.
Yeah, that's perfect, because my next question actually was going to ask you, when working with clients, what kind of exercises and tactics do you use to get them more aware of their emotions and recognize not just the emotions they're feeling, but the severity of the emotions that they're feeling, so they can start to build that sense of when to pay attention to something, when not to pay attention. It seems like journaling and just doing that constantly, working that muscle, getting better at it, that seems pretty much your guys' process. Is that kind of right?
Generally, yes. And obviously talking about it with us. One thing that a fair amount of people have trouble with is anger or being upset. And so part of my process with some people is, expressing that anger or asking about anger. A lot of people get super uncomfortable with anger. But part of my job is, when I feel that, is to say, well, that would make me very upset, and try to get them to recognize that being angry it's just another emotion. And just because we have have an emotion doesn't mean we have an action, right? People, me included, oftentimes are afraid of anger because I'm afraid I'm going to act it out. And just having the feeling is so intense that I'm so afraid that I'm going to act it out, I try to push that feeling away. But once I start to understand personally and get my clients to understand that just because we have a feeling doesn't mean we act it out, then the feelings start to be able to come more frequently and more fully over time. And people start to trust themselves of, oh, this is just a feeling. I don't have to act every feeling out, just like I don't have to take every time I see a trade. It's just part of the process of being human. We have all sorts of feelings. And the more feelings we can have, the better off we are.
And is that difficulty with anger specifically because it's viewed as like a negative emotion that, if we're a good person in society, we shouldn't be angry at all? Is that why it's specifically hard with anger? Do you think that's the case?
I believe so, yeah. And think about it. Growing up, we were generally told, don't get angry. Why would you be angry about that? We're questioned about it. Well, what, you shouldn't get angry about that. And like you said, the societal perception of, angry people are, threatening, and we're afraid of them. And we certainly don't want to be perceived as this negative person. And again, it's just an emotion. And like I said earlier, when we're able to have our emotions, they don't stick around, right? Like, I admire people who can be angry 1 minute and then back into balance the next, right? When sometimes things happen that make us angry. If somebody God forbid, breaks into my house in the middle of the night, I hope I get angry and use rage, because that's the appropriate reaction. But, again, walking down the street, getting angry and having rage probably isn't the appropriate action or response, and definitely not to be acted out upon. And so again, it's this idea of, you're right, society says nice people don't get angry. You have to be a nice person, and we need society to work, and all of that stuff. So I think that's a main part of it. Yeah.
Yeah, very cool. And once a client has been journaling for quite some time, they've built up that awareness a lot better. They can recognize what emotions they're feeling. what's kind of the next step to use that data to try to get them to improve their performance, or recognize, I guess, the state where they think most clearly, make the best decisions, perform the best. Yeah.
Yeah, I'll take that. I'll take that a step further and say when we can really understand our feelings, that is where the unconscious pattern recognition or intuition really opens up.
Mm.
I think that when we can have feelings and understand them for what they really are, then we can apply that to the market and know that it's not going to be impulse. Oftentimes, when we first start out and we start to raise the volume of the intuitive voice in our heads, it gets close, at least in my experience, it becomes very close to the volume, how I experienced it, of the impulsive voice. So it became very confusing to me for a while. You know, I had this voice and then I had this other voice, and they were very similar, but I learned over time that the intuitive voice is a whisper. If you don't listen to it, it goes. The impulsive voice just doesn't give up. It's like a toddler, right? You know, can I get this gum? 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 Finally, I say yes. Like with the intuitive voice or impulsive voice, at times, take this trade, take this trade, take this trade. Sometimes I would say yes and take that trade. Where the intuitive voice is just a small whisper, usually accompanied with a feeling, a bodily sensation for me. And so it would be kind of in my stomach area, this calm feeling, and then I would take it. And I believe that happens when we can start to understand what we're feeling and the emotions flow through us more. The chatter in my head went way down. So then I was able to separate out what was impulsive and what was intuitive, because there was less chaos in my mind. And I believe that was because I was able to label what I was feeling, and that it would just flow through. Okay, your brain says, okay, you've received this information. I don't have to stick around it. And it flows through you.
And do you have kind of a definition of intuition? Because it's definitely a complex topic concept. But do you guys at the Rethink Group kind of have a standard way to describe it, or how you like to explain it to others?
Really, unconscious pattern recognition, I think, is the cleanest. So, and I like embedded in that is an experience time-wise aspect, because, you know, it's the Gladwell 10,000 hours type of thing, even though maybe that's not totally accurate. But the point is that for somebody like me who's looked at a million charts, and you who looks at a million charts for hours and hours, at some point there's an intuitive understanding, because you have this just unconscious pattern recognition. And I believe within the context of a trading system or style, that's where it really flowers or starts to develop. I think we need to be careful saying that if you looked at a lot of charts, you have this intuitive feel, and you can just look at a chart and have an intuitive feel that's accurate, right? Like, I think anybody who's looked at a lot of charts, like, I could pull up a chart right now and my mind automatically makes a decision about what's going to happen. To me, that's not intuition, that's just habit. Mm-hmm. And so I would not say, I look at a chart and my mind says it's going to go up, so I buy it. No, not at all. It has to be within the context of how I trade. And then when that happens, to me, it's important. I used to think that these patterns that we had, these feeling contexts, these repetitive type things, I used to think that I wanted them to go away. But I don't think that anymore. What I think now is that I want the volume to go way down. Like I said before, that idea of having a stop. You know, I want that volume to go way down, but I want that feeling to be there so I can get information out of it. And the example I gave earlier was, eventually I realized that that feeling was telling me something. The feeling of, I don't know what's going on, but I have a stop. That combination to me over time told me, okay, great, I need to get out. But if that feeling totally went away, then I wouldn't have that anymore. So I think that having these feelings that we have And for you with this trade, you know, you want to get out or you want to take risk off. For me, I don't think it's best if that goes away for good, because there's information embedded in that feeling. Right. And so for me, I'd rather really understand it. And then, by the way, start to use it to make things better.
Yeah, recognizing the feeling, but not necessarily being compelled to act based on that feeling, because it's conscious now, it's not unconscious.
Yes, correct.
Very cool. One question I wanted to ask you, and I think everybody watching this can kind of relate to this situation to some extent, is there's times with trading where you've got a big position, news comes out of nowhere, there's a large gap down, you suffer a significant loss that's much bigger than what your system is planned for. And then it kind of really decreases your confidence. You're mad at yourself, you're mad at your system, you're mad at the world, at least for a little bit.
Yeah.
What would you say to traders to kind of work through that, process it, and be able to recognize, you know, I'm on the right path, this was kind of an outlier event, you know, how to kind of get back to center, I guess, recenter yourself emotionally, technically, intellectually, once a like significant traumatic event, if like you want to call it that, obviously that has its own connotations and everything, but yeah, when basically a trader experiences a really significant loss, what would be the path to get back to normal and move past it and process it?
Yeah, so we're assuming that they got out or did the best thing at the time. Yes.
Yeah.
Okay. Yeah, because that's a whole other question of what do you do when that initially happens, and so I'll leave that part of the question and move on to the next part. So the way that we think the best way to go about this is to really sit there and feel the feeling of being screwed over or being neglected or being bamboozled or whatever the right words are, and journal about it, think about it, and process it, because it's almost a grieving process that needs to happen when something is traumatic, like you said, traumatic like that happens, because you know, when we have a big position on and there's something out of the blue, there's an outlier that happens, you know, there's nothing we could have done potentially to see that. And again, the assumption is that the position size was within the parameters of being positioned in the portfolio such that, you know, it wasn't 80-90% of the portfolio. So we're assuming a lot of things here, but we're assuming good risk management tools. And, you know, then going back and really processing it, walking through that trade again, walking through the chart pattern and saying, okay, did I miss anything? Was there a little tremors? Not to beat ourselves up. This is the hard part. Not to beat ourselves up, not to wallow in, I'm using my words here, I'm an idiot, I should have known this should have never happened. That's the first part of the process, where we get all those emotions out. The second part is to go back and look at the trade and say, okay, did I miss anything? Was I true to my trading style? Was the stop in the right spot? You know, was the position size too big? Maybe, but not out of control. Walking through those things to learn something from it. Again, this is hard because most of the time, I think most of the time people walk around searching for a stick with which to beat themselves until they get through this process where they start to understand their feelings more. And so, again, I had a guy just recently do this sort of process, and he, you know, sent me a text and said, I'm really feeling bad about myself. This is really hard. I don't know that I want to do this anymore. And I said, yeah, you know, it really is hard to look back at these things, and it really sucks to see the mistakes we've made. But maybe is it possible to look at it from a learning point of view? What did I potentially miss? What can I do to make it better next time? And again, it's really hard, but I think the first part of the process is to kind of grieve it. And then the second part of the process is to really kind of deconstruct it and see if anything was missed or anything could be learned. and I had some guys in my pit during Mad Cow who had the wrong position, and they had to dig out of that issue. And on the trading floor, it was a little bit easier, but it was still a similar type of psychological process.
And if you don't process something like that, I assume it can impact your trading, thus going forward until you actually grieve and recognize and accept it. Just like something kind of from your childhood that you haven't fully recognized impacts how you make decisions and all that.
Without a doubt, I think,
Mhm.
and I've seen it time and time again. But others may have different opinions, but I think that once that happens, again, it's the emotions getting stuck and then circling back. So maybe if somebody in this situation didn't process it, positions would be much smaller, stops would be much tighter, and their trading P&L would go down and down and down and down because they became so risk averse.
Right.
It's kind of like this. I have this idea of uh, the cycle of confidence where we first start out and we're really, because we only take the right trades and we only trade maybe 80% of the right trades, and they do well because they're really good trades, and the P&L starts to go up and up and up, and then we say, man, I'm really good at this. This is close enough. I'm going to take this trade. I'm going to take that trade. I'm going to take this trade. And next thing you know, the P&L starts to go down and down and down. And then sometimes we create a bigger structure, so it becomes harder to trade. We have 48 parameters that need to be met before we could take a trade. And then that starts to happen. And then we start to strip away the trades and the cycle starts over again. And eventually we become very clear about what we're trying to do. And there's no reason to have that cycle anymore.
Yeah, I was actually just gonna kind of ask about confidence. So it's funny you brought that up, because pretty much what you just said, we've got our plot of our equity curve, which has ups and downs. Hopefully, it's going lower left to upper
Yep.
right, ideally.
Yep.
But our confidence kind of overshoots the highs and the lows.
Yes.
So I wanted to ask you if there's a tactic or a way to think about it to try to even that out a little bit. Because to use the situation, just if you're going through a normal drawdown for your system, in our style, a market cycle has ended. The leaders from that cycle have broken the key moving averages, and obviously there's going to be a drawdown from peak. You're never going to get the high, but you've exited correctly for your system. You might still have a 10% drawdown in your account, but that's completely normal and that's typical
Yeah.
and expected. But your confidence might be really have taken a
Yeah.
hit, even though it's a normal thing for your system. And then going forward, when the next market cycle starts, if your confidence is still, you know, overshooting to the downside, you might not act like you said. You might not size high enough. You might not risk enough. So, is there any kind of clarity that you could provide there, or kind of guidance for those types of situations? Because I think people go through that, like I said, kind of every cycle.
Yeah, for sure. So I had this happen to me. So I was trading a mechanical system, end of day system based on volatility. You don't need to know the details, but the point is that I had traded the system for a number of years. I understood the kind of range of outcomes. And this is something that's important, path dependence, right? All of us want to make our average return each day, right? We all want to make 200, whatever the numbers are, $200 a day. So we make $1,000 a week, blah, blah, blah. But that would be nice to do it that way, but that's not how reality works. We have this path dependence, and understanding the range of outcomes is important. So I had traded the system. It was on the set of outcomes where there were a lot of runs of losers. And I remember the risk manager coming to me and saying, "Hey, what's going on here?" And I said, "Well, this sucks. I'm down a lot of money, but this is within the predicted range of outcomes. And I'm going to continue to trade it as it's supposed to be traded. And we can revisit this in 15 days or whatever the case may be. I forget what it was." And I was way out there on a limb because it was a lot of money, but it was within the range of outcomes. And so what did I do? I traded the system according to how it was supposed to be traded. And it went on a run where I got more winners in a row than I typically get. And so again, understanding what we're trying to do and the range of outcomes associated with that is super, super important. I traded an algorithm for a while and we talked to the risk people. We said what the range of outcomes could be. We could lose this much in a week or month. I forget exactly what it was. And, we're looking to make this much. And the first week we lost that downside number. And the risk manager came to me, he's like, what's going on? And I said, I don't understand the question. He said, well, how could you? I said, remember 4 days ago, we talked about this. This is the number we said could happen. It sucks. I'm not happy about it, but I'm not panicked either because this was part of the range of outcomes. And, again, it's this idea of it's easy to understand risk until it starts to happen. And then our perception can change. And so understanding that for me, understanding, okay, this is the downside that I'm willing to accept, and then accepting it is important. So walking through that, if we're not willing to accept, in your case, your example, that 10% downside, well, then we need to change the system in some way. And there are levers to pull to make it less risky and to understand that. So when we get in a situation that becomes overwhelming emotionally, we need to really try to figure out why. Oh, I didn't expect to lose this much, even though it was part of the range of outcomes. So if we can't accept all the range, we need to do something. We need to pull a lever to make it less risky, which again, risk and reward are the opposite sides of the same coin, right? We can't have a lot of, generally, unless you trade, an algo system that takes the little microseconds, but we're assuming people don't do that here generally. The more risk we take, generally the more reward we can expect. And the less risk we take, the less reward. So again, it's this trade-off. In trading, there's all sorts of trade-offs. We're giving something up for something. I think in life, we're giving something up for something else. We take time to go on vacation, like I am. We give up sometimes some of the stuff at work. And those are the trade-offs that we have to decide which is worth more to us. So I'm not sure I answered that question or it was an expansive answer, but those are my thoughts.
No, I think you did. And just to kind of summarize what I heard there, it was recognizing the realities of your system and those trade-offs, and then accepting that as part of staying even keeled in the moment when you're actually experiencing that drawdown. And just kind of another situation that's very common when on a individual trade level for our style, you'd enter at a pivot point, set your stop loss at a certain technical level below that, and in the moment, like when you're buying it and it's moving up, you're like, yeah, that's a good stop loss. I can accept that. That's 3%. That's within my system. But then when the stock turns around, starts feeling the breakout, but hasn't yet hit your stop, you're reevaluating. All the emotions are coming up because you haven't truly accepted that stop. Yeah.
Yes. And again, having the emotions is important because it gives us information. In your case, your example, you're saying that this person really wasn't okay with that 3% stop. So there's lots of ways you could trade smaller size. You could, vary the stop, but probably trading smaller size is the answer until, again, you're able to do it without having outsized emotions of this example of it goes in my favor and then it starts to get out, go toward the stop without hitting a stop. Most people can't take that stress and they get out right away. I mean, I can't tell you how many people I talked to, it started to go my way and then it started to go towards my stop and I got out.
Yeah.
And then I said, well, did it hit the stop? No. Did it ever hit the stop? No. Okay, then why did you get out? And then really, usually it's because there was too much risk or the perception of too much risk.
For sure. And it takes off without them. And then there's all the other emotions involved.
Well, and then we're in a state that our emotions are kind of heightened. So I've done this a million times where, then I get long. Like if I was long and I got out, then I'd get long again. And then I'd have a tight stop because I couldn't risk as much because, it really needed to go. I get a terrible location, I get stopped out, and I think, well, it's going down, so I get short. And then I get stopped out, and I say, well, you know what? I was right. I knew I was right. I'm going to get long. And hopefully nobody understands what I'm talking about, but I've done that more than most people here, and it's a process of learning. You know, when we don't have an understanding of what we're doing and a trust of what we're doing, it lets this emotional side, this intensity, at times can take over, and that's when we get into real trouble. Yeah.
Yeah, I think everybody can probably, unfortunately, relate with you there. Um, and I wanted to ask a little bit about FOMO, which you kind of touched on just a little bit there. First of all, is FOMO real? Is it just kind of an amalgamation of different emotions that you're feeling? And, you know, if traders say they're feeling FOMO, which social media I don't think helps, where everybody's posting that they're winning all the time and getting, you know, 100% gainers, that skews the perception, but that's kind of a separate thing. For traders who are experiencing a lot of FOMO, what would be kind of your guiding points for that, if you do have any?
Yeah, I think FOMO is real, but I think also defining it, saying FOMO, but why? And what is the real feeling? I know it's fear of missing out, but what's the real fear? Oftentimes, the hardest place to get into the trade is the right place to get into the trade. And I can't tell you how many people I speak to, oh, you know, I just needed a little bit more confirmation. And so what does that do? It means we give up price for time, right? We sit in a trade and we don't make a decision. This is kind of a Robin Mesh, who's a brilliant market profile person, kind of taught me this idea of price for time. So we wait for the confirmation, which means the price goes our way and we're still not in it. So we get a worse location, which means the stop is further away. And it sets us up to be in a situation where either we're risking too much or we don't have enough on. Both are bad. And so again, for me, really leaning into that moment where it's most uncomfortable, but it's the right moment for our setup, taking that trade as a trade, because again, we have all these emotions about it, but at the end of the day, it's just this positive expectancy moment. And when we get in a trade, I like to think when we really trade a system, like I traded in my mechanical system, I knew the future. I knew 70% of the time I was going to have a small winner, 10% of the time I was going to have a big winner, and 30% of the time I'd get stopped out for my initial risk. Boom, done. There was nothing else to think about. And for me, when we're that clear, we know what we're trying to do, but conversely, we also know all the things we're not trying to do, right? You have this setup and it's a breakout setup. You know, when a mean reversion trade sets up, it means nothing. I mean, you could still take it, but it's not your trade. And so for me, again, really understanding what we're trying to do helps us to be able to focus the emotional thoughts process within a moment to become more clear about that moment. Because, you know, if you have whatever emotions about the mean reversion trade, they're probably just ancillary impulsive type feelings that we don't need to focus on because that's not our trade, at least in the context of trading. Yeah.
Yeah, and what you said kind of at the beginning there, understanding what you're feeling, and why you're feeling it. I forget the exact phrasing, but Denise says that so often. Could you kind of expand on that and kind of what that means?
Sure. So what you're feeling and why is a superpower, because we're always feeling something, and it always, like I explained earlier, is there for a prediction. And so when we can understand what we're feeling, we can generally understand what the embedded prediction is. And then we get to extrapolate out, okay, is this a prediction that is valid, or is this a prediction that has worked in the past but doesn't work now? And so by understanding that, we can really dive in. And the other aspect, as I've spoken about a few times, is the idea of by understanding and putting a name on the emotion, it usually vents the energy of that emotion. So it becomes more information than this kind of trigger to act out.
Excellent. And I just have a few more questions. This has been fantastic. Coming back to circling back to something that you said at the very beginning, that your health is itself an edge. Um, I wondered if you could kind of elaborate on that. Maybe tactics that you guys recommend or tactics that you use personally to get a good night's sleep. Make sure you're taking care and pushing yourself properly through exercise and all that, nutrition. If you wouldn't mind kind of touching on those concepts, because they're very, very important as well.
Yeah, absolutely. So again, I think any sort of physical fitness is good for stress management, but also to create a reserve for stress that comes on, resilience. It embedded in physical activity is a mental exercise as well, because as we do something we don't want to do, we're creating a reserve to say, okay, I can do hard things. And within the context of what we're trying to do with emotions, we can say, okay, this feels really hard, but let me wait a minute. With the trade, for example, I really want to get out, but let me wait a moment. And when we're training our bodies, we're also training our minds. We're also training our emotions. And embedded in my practices is some meditation or visualization at the beginning of my workout. I do a physical workout with a group via Zoom, and then I try to do something walk. And one thing I think is important is getting outside and walking and not having headphones in, not having the phone. You can have your phone, but just go out, look at the leaves on the trees, look at the neighborhood, see the grass, see the colors. I think it's really good to be able to do that. Now, I am type A like everybody else on this call, so I have to remind myself of that, or else I'm going to say, I really want to listen to this podcast because I think it'll be super interesting, which is true. But again, getting outside, unplugging, I think creates the room for the intuitive side of ourselves, the unconscious side of ourselves to speak to us. So
Love
it's
that.
kind of a twofold thing. Yeah.
Yeah. And I'm somebody who loves to go on a walk, but I do often have a podcast in or a book. So maybe I need to have a podcast walk and then a reflection grounding walk. I think that might be a good balance. Perfect.
Love it.
John, this has been really great. I wanted to kind of ask, not to close, I got one more question, but what kind of books or resources would you recommend for traders who were really fascinated by today's discussion, and they want to learn more about trading psychology, as well as specifically what you folks do at Rethink Group, and stuff that really aligns with your guys' methodology?
Yeah, absolutely. So Denise's book, Market Mind Games, obviously is the top selection for us. I love Josh Waitzkin's The Art of Learning. I think that's an amazing book. It talks about how the principles of learning can be applied across different disciplines. I think that's true. I actually think Arnold Schwarzenegger's book, Be Useful, kind of describes that same sort of mental emotional approach across different disciplines. The Body Keeps the Score is another good one. And I have a blog section on our website, therethinkgroup.net, where I talk about a client I had who decided that he could only hit 9 home runs. And once we spoke about that, he hit 20 that season. And just, ideas about, mental barriers we put up without even realizing them. I'm sure I have more, but those are the ones that I can say off the top of my head right now.
Yeah, perfect. And the Rethink Group website, do you know the URL offhand? We could put that in the chat and all that.
Therethinkgroup.net.
Perfect.
Yep.
Yeah, excellent. John, I really enjoyed this. To kind of close, if you had any general advice, it could be trading psychology focused or just trading advice focused, for everybody watching this, what would you kind of say to inspire, guide, elucidate them in some way? What would you kind of give them as a final bit of wisdom?
Yeah. So know what you're trying to do specifically and directly. Understand that emotions are information, that every emotion doesn't mean an action. And the more we could become clear about what we're thinking and feeling, the better we can understand ourselves, which means we could be more fully ourselves in the world, which I think is what the world needs. So I think a little grandiose, but I think it's the truth.
Yeah, excellent. John, thank you so much for your time. I really enjoyed this. I always learn something. I feel dumb talking to you guys at the Rethink group, but I always learn something as well from the same time. So thank you very much for your time. To everybody watching, I hope you guys enjoyed as well. Make sure to leave a like down below. Thank John in the chat as well. And check out the resources that he mentioned. John, thank you one more time for being a part of the TraderLion conference. Really appreciate your time and for the great discussion.
Yeah, thank you. My pleasure.
Yeah, cheers. With everybody, we'll be right back with our next speaker, so stay tuned, and yeah, we'll see you in just a minute. All right, everybody, welcome back to the TraderLion conference. It's my pleasure to introduce the next speakers at the event. They are repeat presenters. We always love hearing what they have to say, and they always share very valuable insights. So I'd like to introduce Roy and Wes Mattox, both at IFS Invest. Roy is the Chief Market Strategist and Portfolio Manager, and Wes is the Chief Technical Strategist. Thank you guys so much for being part of this today. They'll be discussing the market trend, how to determine it, how to look at those turns, and going through some very valuable case studies today. So Roy and Wes, a pleasure to have you guys back. And yeah, looking forward to this.
Thank you, Richard.
Great. Thank you, Richard. Hello, and hello, everyone on the stream. Thanks so much, Richard and the TraderLion team, for having us back for, I think, our third year on this conference. So, we're happy to be a part of this partnership, and we love what TraderLion does, and the growth on the platform has been really impressive over these couple of years. So Roy and I hope to add some value to that, and we can hopefully help some people learn something, or just reiterate some ideas too for some experienced traders today. And this is just a disclaimer, right? We're not going to give financial advice here. We're offering some information for educational purposes, so please discuss your investments with your investment advisor. And so just a little background about us. Roy and I, we're co-portfolio managers at Integrated Financial Strategies. It's an registered investment advisor based in Charlotte, but we have clients all over the world. Roy has nearly 40 years of experience in this business, and his career began as an analyst at a major bank in Houston. After graduate school in 1985, he was employed by A.G. Edwards and later moved to Charlotte as senior vice president at Payne Weber. He holds a degree from LSU, an MBA from LSU, and he's been leading the Charlotte Investors Business Daily meetup group for several years now. I'm Wesley Mattox. I graduated from Chapel Hill in 2015 with majors in economics and math, and started in equity research in 2015. I covered financial technology stocks initially, and later moved on to support top-ranked analysts, one at UBS and another at Wolfe Research, covering transportation sectors there. And I joined Roy in early 2022 at Integrated Financial Strategies. And like I mentioned a second ago, Roy has been leading this Investors Business Daily group for Charlotte for several years now, and me as well now for a few. And so I'm sure most of on this call are familiar with the book How to Make Money in Stocks by William O'Neill and his often cited CAN-SLIM acronym for leading stock criteria. Much of what Roy and I do at Integrated Financial Strategies is grounded in William O'Neill's work, where we are trying to hold a concentrated portfolio of leading stocks for our clients. And so we host this meetup group, which is open to the general public. It's on the second Tuesday of every month. We share our thoughts on the market and go over candidates for who we think are the current and next leading stocks of the market. So if you have any interest, please visit this link on the slide, and don't miss our next meeting. So on this slide, we want to show a broad list of what we consider in technical analysis. We break technical analysis into 4 different categories: of price, breadth, sentiment, and ratio analysis. So if you don't have a technical analysis background and want to know more, it's a good comprehensive list of things to look at. And we monitor all of these things in our routine on a daily basis. So by far, the most important part of technical analysis is price. And so we're going to focus primarily on the trend today. And so trend is the primary consideration for investing based on technical analysis, and paramount for success to stay on the correct side of the trend. So there are a few other indicators listed here that you can look into on your own time that measure things like momentum and if a stock is, quote, overbought or oversold. But for this presentation, we will really be looking at the short-term trend and how you can take this very simple signal of the 10-day and 21-day moving average crossovers to amplify trading results. And so, why is there such an emphasis on trend? And what about fundamental analysis? Doesn't that matter? I mean, of course it does, but we find that there's so much noise, information that you are bombarded with regularly through TV, internet, Twitter, friends and family, and there are all these news stories and concerns that people have all the time. So it's nearly impossible to sift through everything, and there's always worries in the world, whether it's the U.S. debt downgrade, an upcoming election, recession fears, the latest PCE report. We know Price is going to incorporate all of this information, and it's the best source of truth when you have to sift through all the noise that's out there. So in this business, there's going to be no certainty, right? You've got all this changing information, all these new inputs, but you have to learn to be comfortable with uncertainty. And we find that technical analysis keeps you objective and gives you an ability to act with incomplete information. It can never be complete because there's new information coming out every hour of every day. But we do believe the price and trend give us the most complete picture of the economy that we could ask for. So now we're going to get into the sort of meat of this presentation, and Roy's going to take over and look at some charts. We're going to review some key trend changes in past bear markets and starts of new bull markets. So we're going to look at 11 snapshots of the past and then look at where we are today. Our focus will be on what we consider short-term trend changes with the 10-day moving average crossing the 21-day moving average. And so as you can see, William O'Neill from his book, The Importance of Market Direction here, he states, if you're wrong about the direction of the general market and that direction is down, 3 out of 4 stocks will plummet along with the market averages and you will lose money big time. And so that's why we're so focused on this, because he's obviously right about this. It's really hard to find winning stocks and have a winning trade when you're fighting the trend. So with that, I'm going to hand it over to Roy, and he will start with 1987.
Thank you, Wes. Okay, so Richard and I, we'd had this conversation and Wes chipped in. We wanted to really achieve something simple but elegant in its simplicity in the presentation today. And that is, we wanted to help you and educate you in terms of what is a trend, how do you determine a trend, how is a trend developed, how can you utilize the trend in terms of incorporating that to assist you in making your investment decisions. We firmly believe that this simple, elegant approach can be the difference between you flying first class or flying coach, or really achieving your retirement objectives, achieving your wealth objectives, and so forth, if you employ these techniques properly. So we wanted to lay it out for you over the last 40 years and show you, well, what's the trend? What was the short-term trend in these major bear markets in the past? How would we illustrate that? How would you identify that? How would you react to that? And how would you utilize that in your investment decision? So quite simply, the short-term trend for us is determined when moving average crossovers take place. When the short-term 10-day exponential moving average is above the 21-day exponential moving average, we believe that indicates the market is in a short-term uptrend. When the 21-day is below the 50-day simple, we believe that's when the market is either in a short-term or an intermediate term uptrend or downtrend. And when the market is below the 10-week moving average, and really we're looking at the NASDAQ and we're looking at the S&P primarily for this to occur. We believe the market is in a long-term uptrend or a downtrend when you have 2 closes below that 30-week moving average. We're going to just concentrate on the short-term trend today, on these 10 various illustrious examples. So we think that you will benefit from that. So in our chart, the green line is the 10-day exponential moving average. The magenta line is the 21-day exponential moving average, and the 50-day is the simple moving average. So you see that in 1987, when we hear everything that occurred in 1987, and we had the crash, the biggest crash that the market has experienced since the 1930s. And in 1987, what happened was economic growth slowed for three quarters. We were coming off the stagflation in the 70s. The market had already declined 10% before the crash, and investors were jittery. So in this particular case, you see where the market peaked in August. And then we had this double top in October, and you had adequate warning to move out of the market. At all these tops that we're going to look at today, you had individual stock participation that waned. You had this breadth decline. You had momentum that was declining, and you had this distribution days that were mounting up. So that was the backdrop in terms of the macro conditions in 1987. So we see that the 10-day crossed the 21-day. You can see where the downtrend began in 1987, which was a week before the crash. Now, what's interesting, and Wes made a nice table on this so that we'll take a look at this from a summary perspective, but in every particular case, we took the time when the crossover took place and we measured the difference into the market low, and that is what you would have achieved if you actually exited the market at those particular crucial points and got in at the market bottom. Now, note you will find that these short-term downtrends from a market top, they don't occur at the top. They don't occur exactly at the top. Typically, it happens within 5%, and that's when the momentum is waned, and by the time you get the crossover, you have exited your positions. But if you haven't, if this is a novel approach to you, this is basically illustrating that if you did not exit your positions because the leading stocks were topping, you had less and less participation at the top, you had distribution days that were mounting at the top, this would have forced you to go to cash and get out. So that's the point, that the primary point that we're making on all these charts is there's the downtrend, and notice the market bottomed, and notice the market did not follow through and go into an uptrend until several months off the bottom. But believe me, those 2 months off the bottom was so devastating in terms of the declines that people had experienced, and the news headline was so negative that people that had gotten kicked out of the market or that sold at the bottom, those guys probably never even got back in. So when the trend changes, you have to change your opinion, and that was the time to move back into the market. You can see in that 1987 period that we've illustrated on the chart. So next. Okay, in 1990, this is the 1988-89 bear market. And in this particular time, let's see here, it was caused by a combination of factors, such as we were in an 8-month recession, and we also had the Gulf War that we were getting in front of. So you can see this is in 1988-89, the market peaked. So this is the 1990 peak.
90, yeah.
okay, the 1990 peak. You can see the month, and notice this downtrend, how devastating a downtrend like this might occur. And what we're pointing out for all of the participants that are watching the show today is that in these downtrends, it is virtually impossible. There might be a 1 in 100% chance that you can make money being long when the market's in a downtrend. We think that the market direction is the most important part of the acronym, and the market direction is very, very important. It's going to be very, very difficult to find stocks breaking out to new highs when the market is in an uptrend. Excuse me. And so these simple techniques will keep you out in the market downtrends and get you back in when we start a new uptrend after a bear market. And that's when all the money is made on the long side. It's coming out of a bear market. And then as we transition from a bear market where everything is in a stage 4 decline, everything moves to stage 2, and you have a plethora of stocks that typically break out, and new leadership emerges. And those are the stocks that lead typically the next cycle that can power gains of 100 to 200% up if you're able to identify the true market leaders. So we're not going to be talking in the presentation today about identifying those true market leaders. When we do cover that in our presentation and our monthly meetings, our meetup group, but we're simply discussing trend today, which is a snapshot in time for us. You can see the follow-through day in 1991. There was a follow-through day right at the bottom that nailed the bottom. You had another follow-through day in 1991, and that was a rare 3-day follow-through day. I think we've only had one of those where we had a 3-day follow-through day. Typically, your follow-through days are day 4 to day 7, or sometimes a little bit further than that. But in this case, you had a follow-through day 5 days off the bottom to signify a potential trend change, to get you ready for a potential trend change. That should, when you have those follow-through days after a bear market, particularly the first ones, that should alert you to now is the time to do your homework, to pin your ears back and get some of these new leaders. And you can see we had, again, that follow-through day in January 1991 that led to enormous gains in 1991 in stocks that I owned at that time, such as Amgen, Costco, I think US Surgical, and Microsoft. That was a huge winner as Microsoft converted over from DOS to Microsoft Windows and so forth. Next. Okay, the 1998 bear market was caused by a number of macro factors, notably the Asian financial crisis, and we had the Russian ruble crisis at that particular time as well. And incidentally, this would have, if you were using these simple trend signals back then, I wasn't using them before 2000 to 2002 because I had not gone through a devastating bear market like we had in 2000 to 2002. That's where I came up with these short-term trend signals to put us on the right side of the market. So it took me it took me 12 years to come up with this, and that's only going through the 2000 to 2002 bear market that I developed this strategy. But since then, it's helped us navigate through all the bear markets with minimal declines, and it's kept it's kept our capital intact. So you can see here in 1998, the top, and then had the big break. And back in 1998, the leaders were, and this was just a huge break in the market. These were the internet stocks like Yahoo and AOL. I wish that I could go back and pull those charts up, but my software doesn't, it deletes them when they're no longer, if a company is bought out, or if a company is delisted or inactive and so forth. But I had, and I owned a tremendous amount of AOL and Yahoo that I got stopped out of on actually the second move down. You can see where we had that market bottom in September, and then we had this brief move up from September, October, followed by the retest in October. And that October retest right there, that's where the real bottom took place. And that's when AOL and Yahoo then subsequently took off for many hundreds of % gain from there. Qualcomm was a big winner of ours as well from 1998 to 2000. So you can see that the follow-through day that occurred there on the retest in October signaled an early potential trend change, that a potential trend change might be taking place. So you had that in September. You had another one that was there in October. So basically in October, you really started counting again because you actually undercut that September low. But if you were, during this period of time, if you're out of the market and you're not investing using that follow-through day methodology, the trend you can see where we went into that uptrend when the 10-day crossed the 21-day, that satisfied our the necessary burden of proof that we're looking for, where the 10-day is crossing the 21-day, and now we are in a new, at that particular time, short-term uptrend. So long-term uptrends don't occur unless you have short-term uptrends first. You can see the short-term uptrend was definitely, of course, intact at that particular time. Okay, the next was in the 2000 top. And again, the 2000 top, Bill O'Neill, after the 2000 top, came out with a book that's entitled The Successful Investor. That is, that's a tremendous resource because it brings you back and helps you understand what happened in 2000 at the 2000 top, and how did that 2000 to 2002 bear market unwind, and how could you have avoided it? So that's the most important takeaway from what we're trying to demonstrate today. So in early 2000, you can see on the NASDAQ, we had the double top, and stocks had a tremendous move. And from 1998 to 2000, we had what was known as the internet bubble. You had dozens and dozens and dozens and dozens of stocks that went straight up, that blew off, that had no earnings. It just anything that was associated with .com went up. Companies were changing their names and adding .com, pet.com. They were adding a .com to the end of their corporate name. And any of those companies that did that, the stocks just took off. And so it was a bubble, and it was a feeding frenzy. And in fact, at this particular time, we had just had 5 years of 20% returns. And just to show you how bullish the sentiment was and how excessive it was, everyone that you did, that you conducted surveys with during that time expected another 5 years of 20% returns. And so anytime it gets that good for that period of time, you can understand that we're going through just an irrational period of time. and that's not going to last. The market is going to revert back to the mean, and the mean is, the market is averaged with 8-9% for the last 80 years, on average, despite 14 to 16% pullbacks that you can be assured of that you'll get once a year. So here, the bear market lasted from 2000 to 2002, and we'll take a look from that March 2003 day, because we are utilizing these patterns and to look at currently to see, well, how does this compare to the 2003 turn and also the 2009 turn? So that's important information for you to look at. So this is the first half of the year in early 2000. You can see the downtrend. And so again, with that double top, you would have been kicked out of the leading stocks by the time the downtrend was in force. But again, you didn't, in this particular case, the NASDAQ dropped from 55,000 to 4,500 before before it triggered. And so, you're not going to, because you're trend following, it's going to be a lagging indicator. When you look at trend, you're not going to get it out exactly at the day of the high, but you can see that you got out within 5% of the high. And here you can see the market then was in this downtrend. And notice, you can see when you're in a downtrend, you can have brief 2 to 3 day rallies, but if you're trying to trade those, you must sell those. It's very, very difficult to trade, in particular your entire portfolio, for 3 or 4 reflex days, rallies in a bear market. It's psychologically defeating, and it's fatiguing, and it's exhausting as well. That's why we think it's important to just avoid these downtrends and just participate in the uptrends, as much as reasonably feasible. So you can see here the uptrend took place, a few months later. You avoided all the carnage that took place from that downtrend to the market bottom. And let's take a look at the next slide, Wes. And in this particular slide, this is from a lower level. And you can see in this particular case, the late 2000 bear market, the market dropped another 57%. And I am happy avoided the majority of all this downtrend. And so this is the whole key, that the market is going to repeat itself. There are going to be people's behavior and fear and greed, supply and demand will never change. And so this is just a simple technique to keep you on the right side, of the major trend.
Yeah, and
So
Roy, I was just gonna jump in, because you see how long this particular downtrend was, and you've kind of got that fake signal at the beginning of 2001, sure, and then back to the downtrend. But if you don't have something that can keep you objective like this, it's just, you think about, if you just stay out, how much mental capital you get to maintain. And because it's really, really hard, I know, to stay out for, this is almost like 12 straight months. So anyways, that's what I really, enjoy about this, especially when you get in these prolonged downtrends. I think it's super valuable to really, help you stay on your hands, versus, trying to guess a bottom. It's just, that's exhausting. So I like, this period of time shows you how helpful it can be during a particularly long downward move.
And just jumping in as well, I think it's very relevant. Obviously, in recent history, we've got the 2022 bear market, which is kind of similar to this. There were multiple false breaks up to the downside. But Roy, I like how you pointed out earlier, the follow through day and also the 1021 EMA signal, it's the start of a mindset shift where you have to start thinking positively and looking for longs. And I think that's one of the keys that you guys are trying to share today is having an objective measure like this. Like you said, Wes, make sure that you protect yourself during the worst of it, but also you're ready and ready to take action once a new trend starts taking hold. You start putting on exposure, testing the waters, and that way you're participating during the uptrends, the long-term uptrends, which awesomely are usually a lot greater in magnitude and duration than these downtrends, which you guys are sharing.
Well said, Richard. Well said. Okay, next. Okay, and you can see this is the 2002 the bottom, and you can see Wes has just blown this up to show you again the devastating decline there, and that accompanied this bear market that we had. You can see the market, the market bottom there, October of 2002, and then I believe we actually had a retest in 2003. But notice where the market bottom place, and then we had the follow through day, and sometimes you'll have a follow through day, sometimes you won't. In 87, we didn't have a follow through day until after the trend change, which is quite unusual. In other periods, you have follow through days and the follow through days that don't work. I think Richard is going to probably, is Eric Kroll speaking?
Yep.
So he'll have some great information. We look forward to listening to him and his team as they talk about the follow-through days and the ones that are significant, those that weren't, that didn't work, and so forth. Just looking at the data and so forth. But again, when you're trying to establish market exposure, where you're trying to establish where do I dip my toe in, you have to do everything incrementally. And we certainly have learned from Martin Benny how, in terms of incorporating his trading style into ours, in terms of how important it is to make incremental exposure. So just because a follow through day occurs doesn't mean you should go 100% invested on margin, and that would be a recipe for being chopped up, and could be a recipe for disaster if that follow through day of course doesn't work. But what's nice is that your mental capital is intact during a period like this, where everyone else is basically in the fetal position. Everyone else, they're not opening in their statements. They're listening to CNBC to see what the next pundit might say to bail him out. And people are not making their own investment decisions. They're listening to someone else. Here we're clearly laying it out for you so that you can see that this is what we're talking about here is unencumbered by market noise and market opinions. We're just looking at price. We're just looking at trend. Trend is the only thing that pays. Next slide, Wes. Okay, so in 2007, that 2007 to 2009, during that bear market, that was perpetuated by the housing bubble, the subprime mortgage debacle, and banks being overexposed and over leveraged on their balance sheet. So you can see this during the great financial crisis, the NASDAQ was in a downtrend at this particular point. You can see where we went into a downtrend. And this was followed, so this 2007 was one of my best years trading the market. I had a big winner in Google in 2007. And but it was followed by this bear market from the 2007 top to the 2009 bottom. But you can see the downtrend and look at how long these downtrends last. And you will just, I mean, it's always great when you're making money in the market, when the market is in an uptrend, particularly when the averages are at all-time highs. But this shows you the flip side of the coin. And what I want you to take away from this is you can see that these were months where you should have been out of the market. So for guys that are addicted to the market, addicted to trading, they're addicted to, quote, action, the market's not the place for you. This isn't a gambling casino. It's a license to build your wealth if you know what you're doing. So we're showing you this simple technique to keep you out of the bear market and keep you in the bull market. So that's what we want to illustrate to you today, so that on the next bear market, you can navigate it successfully by adopting these techniques and these tactics that we're laying out for you so that you can visually look at them yourself. Notice here, there's a 43% drawdown right there. Boy, that's enormous. And believe me, from 2007 to 2009, you had stocks that dropped 90, 95%, because remember, growth stocks drop twice as much as the indexes, typically, in many cases. And this year's winners are next year's losers in many cases too. Just look at Zoom after the 2020 top, Teladoc after the 2020 top, DocuSign, Fastly. We could go on and on and on. Next. Okay, so in 2018, we had a trade war with China. We had a slowdown in growth, if I remember correctly. And we had the Fed raising interest rates too quickly. In that 2018, that led to that bear market. And you can see the bear market, that bear market took 20% off your capital after the top. Notice how this is pretty darn close to the top, right? You can see the double top up there, the trend change. And incidentally, occasionally the trend might change, but it can occur at the same time that you're breaking the 50-day on volume too. So many times the 50-day breaks first. It breaks hard, and then a day or two later you'll have the crossover as well. So you're going to have individual stocks that break. You're going to have the averages that go through the 50-day in many cases, and then the trend changes. So, so if you're watching closely, you'll see distributions mounting. Stocks aren't participating, and that will bring us on our last slide. We'll talk about, well, what's happening today. So we'll bring you up to present on that. But you can see here in that 1988, if you're out when this trend is clearly down, then the market finally capitulated on the as it cascaded to that bottom in 2024. And we were credited with coming out with a piece on December 24th after the close, saying that we thought that's the market bottom. And we were exactly right during this capitulation. That happened to be on Christmas Eve. And so that's really one of the best quote calls of my career on as the market bottomed out there on the whoosh down and so forth. Notice that if you don't have the tools necessary to try to gauge bottoming action, you had the trend that took place a couple of weeks later. So the market went from this downtrend to an uptrend. So you had, remember, you're not getting out at the top. You're not necessarily getting out at the bottom, but you're getting in so that you can enjoy 80% of the uptrend and miss 80% of the downtrend. Next. Boy, this was amazing. And I mean, this was amazing. Obviously, this was the COVID crash of 2020. And notice in this particular case, see, you had the break of the 50-day on volume. Notice, and this is, Wes, will you illustrate that on the chart there in February of 2020 over there? Thank you. So you can see the 50-day, the break, and there's your exit point to get out right there on the break of the 50-day. And then the trend followed a couple of days later. And this was the most brutal and the quickest bear market that we've ever experienced, over the last 4 decades, in my view, where you were down 35% in a month, in 4 to 8 weeks, and you recovered the entire move, in the next, 8 weeks. It's very, very, very rare to ever experience something like this. And this is when the news headlines, of course, at the bottom was as bearish as I've ever seen it in my career. And so we had the follow through day, you can see after the bottom, and then the market went into an uptrend after that. And, if you're not looking at these tools and you're licking your wounds, and if you got out and it's okay to get out, but you have to know when to get back in and when are you forced and to get back in? When are you forced? You're forced when the trend changes. Now, in reality, as you study and you go back and you look during all these time frames, go back and look at who were the biggest stocks during that, during the bull markets. And you can see that many of them, you don't know in the bull market the new bull market, who they're going to be. So in many cases, it is easier to just buy the indexes like the NASDAQ or the S&P when you have, when the trend first changes. So it's okay to get market exposure if you're not following individual stocks or you don't know who those leaders are. Sometimes it doesn't happen simultaneously when the market bottoms. You don't have stocks that break out to brand new highs. They typically happen over the next 4 to 6 weeks after the lows take place. So there's an incubation period where the setups take a little time to present themselves. And, so it's interesting. Go back in 2020, for example, and look at the Tesla bottom when the market bottomed here on 2020. Look at Tesla. Look at Shopify. Go back and look at some of these stocks, and you can see where they looked on the charts. They weren't at new highs at that particular time, but they were setting up to launch themselves to make a major move over the next 2 to 3 years. And then 2022, we really did what we think is a really sound, legitimate execution that we executed, pretty well in 2022, considering the NASDAQ dropped 35%, and I think the S&P dropped 30% from the high to the low. here you can see the downtrend that took place the beginning of 2022. And I believe we went to cash right here when the market had topped after 2021, and we were forced into cash. Notice the break of the 50-day on volume there, right before the downtrend was commenced. Actually, the next day, the 10-day crossed the 21-day. So you had an early warning. The break on big volume, a big break on the downtrend there in 2022 to signify, okay, it's going to be difficult and choppy. And that's what occurred for the majority of 2022 until you finally bottomed. Okay, let's take a look today. And you can see in 20 there, we believe that a new bull market in growth took place it began in November 1st, 2023 with that follow-through day. And so during the last few years, it's been choppy, it's been difficult. And the trend, the way that we, by observing the stocks that have participated from the November follow-through day to today, we believe that we're in a new bull market of unknown duration and of unknown magnitude. So you can see that's where we are today. And just to give you an idea, well, how would you utilize this? Well, for us, we were 100% invested during this November through this period of time, all the way through this to March, April period of this year. And then we saw this topping action that took place. So we noticed, you can see, we had some distribution that was cropping up. We had periods of time where the market opened strong and closed weak. In those cases like that, where Wesley has indicated that, and we can, so what we did, we were 100% invested, and we started selling. So we went from 100% invested to basically out. Wes, did we get 100% out then, or were we like 15 or 20% long?
So what I remember is a Thursday where things looked like we were about to get going, break out. Friday there was this Israel news, and a reversal day, kind of expectation breaker type of day. And I think we started probably selling that Monday a lot. And we wanted to hold on to Nvidia being the leader, but we know during that period of time, when it peaked to the bottom, probably down here, April 14th or 18th or whatever that is, that was a 20% drawdown. So I think we held on to that until we saw it breaking the 50, the last kind of leading stock breaking the 50, whenever that day was. So yeah, I think by that point, on that day, it was a Friday, I believe, too, where we went fully to cash. And then just wait. Again, we're looking for just a simple trend change. We were out for 15 days, and then we saw the trend change again.
Yeah.
And we're, very quickly, nearly fully invested again, early May.
Yep. So no, that is, and Richard, you can probably chime in here in terms of how, what happens when you're trying to, when you're seeing a situation like this, in your experience, when you're a potential trend change, raising cash, and then how difficult is that to employ cash again, Richard? What's your experience?
It's something that I'm still improving on, especially kind of the rapidity, not rapidity, how quickly I'm getting back exposed. That's like the tough part for me. But
Yeah.
I've started developing like hard rules about, when that trend changes to the upside again, I have to put on TQQQ or QQQ to a certain amount. And even if I don't know exactly what the leaders are right at that moment, because some of them may develop, in the next few weeks, having that exposure initially if the trend starts working, gives me that profit cushion, that then, gives me confidence, things are working, and then I can redeploy that capital to new leaders as they break out, or just kind of keep riding that core of TQQ. So that's actually a question I wanted to ask you guys later in the Q&A, is that transition from cash to when we're in a new uptrend. How do you guys go about it? How quickly do you guys look to go back to close to fully invested, or how much you guys want to be invested, and what kind of things you look at in terms of if you have any rules about, hey, I can't change my exposure levels more than 20% in a day or something like that. So I don't know if you guys wanted to touch on that now, or just kind of table that for the last Q&A, but I'm sure that's that's a very hard part about trading. That's catching those turns. So kind of up to you guys if you want to address it now, or table it for just in a little bit.
Well, what we and while you have me here and it's on the tip of my tongue, now what we did was we ended up selling and taking a lot of profit in like selling. We sold half of a lot of our winners. We incrementally moved out.
Right.
And what we did was the stocks that we sold, and we sold stocks like DraftKings and Uber and other stocks. We sold them correctly, and then we bought them back as they came in, but they didn't hold. And so we found that on the pullback, we were buying on the pullback, and they didn't hold, and we got kicked out because we had probably 5 to 8% losses in them, and then we had to pivot and determine, well, who are going to be the new leaders in the uptrend. Normally, the stocks that were leading the uptrend, they're going to, in a pullback like this, it's going to be the same leadership, but you just need time for those leaders to breathe and set up for 2 and 3 week type patterns. For example, like right now, we had this market that made a new high on Friday, and you had potentially a key reversal day. You opened strong, closed weak. What does that suggest? Well, Wes is going to take a look at on the next slide about MACD and a couple of things. And we're not getting into using tools a lot, in terms of dialing down into the specifics, in terms of looking and pulling that up right now. But you can see that the momentum is somewhat waning, just a degree. But we think this is setting the stage to pause for semis. And we think that, that semis aren't necessarily over, but they're breathing and they're going to pause here, while other groups like software is coming back into favor and some other stocks are rotating. Again, small caps and mid caps were up on Friday, and we think a potential rotation may be taking place there. But we waited for that for the last 2 years, right, for that quote rotation to take place. But until large cap, mega cap stocks are going to lead until they don't. But it is important to watch them right now to see, well, do they have another leg up to go? Are they going to participate in this AI bonanza, or is it over? We think that there by no means is this over. We think that you're just getting started in AI and the ramifications of indoctrinating AI through our whole society. Mm-hmm. And we think that's going to lead to great productivity, higher prices in the market, higher valuations, better earnings, and a better market environment for the second half of the year, fueled by also the seasonality of the presidential election year and other things.
Yeah,
and
go ahead.
Well, Richard, I was just going to mention something about that question. Mm-hmm. I think you said you put on the Qs, made the TQQQ. I think we do the same thing a lot of times, especially on a fall through day when everything's kind of beaten down, and because of fall through day, right, coming off of the low, there aren't a lot of stocks, of course, going to new highs. So We find that definitely index exposure is just a good way to get that exposure. I think on this day too, where we broke above the 50-day, I think Nvidia was probably breaking above the 50-day. I think we were looking for a number of those to kind of, not necessarily be at new highs, but the leading stocks would recover their 50 days first. So I think that was probably those were a couple of actions I bet we took that day. And then you see when the short-term trend change right there over the next 5 days, it did give you a lot of time to see things, and you can see the market was consolidating and having this sort of short handle, shallow handle. I'm sure a lot of stocks were doing the same thing, but I would say we're not going from 0 to 100% either exposure in a day. It's certainly going to be more measured. I bet 30% changes would be like the most we would do in a day. Maybe going from 0 to 30% could be reasonable for us.
Yeah, perfect. And when we're kind of in a trend like this, so this is stepping forward in the trend a little bit, and maybe also talking about the trend that started last fall. As we get further on in there, and you start to see, downside reversals like we saw in March, and we start just kind of treading water sideways. How are you guys changing things with regards to aggressiveness of new positions if you're taking them, as well as balancing taking profits on maybe your weaker holdings if you start to notice the market's getting a little bit extended from the moving averages, if that's something that you guys do?
Well, we just sold. We de-risked about a week ago when we saw the momentum waning just a degree, and we sold. For example, we have a core account that's more a longer term strategy that we employ, and we have a swing trading account. And in our swing trading account, we sold 100% of Nvidia. We had a 20% position, and that we made 50 to 60% on the last trade, the last time we put it on. So that that trade right there provided with over 10% of return to all of our accounts with one stock. So that shows you the benefit of concentration, Richard, of course, as you know. And if for our long-term accounts, I think we sold 75% of Nvidia at that particular time, about on the peak, when the stock peaked at the day that it peaked. I think we sold it for 139, 137 the day. I think the high was 139. And that allows us to now trade around and be able to buy these positions back without having much of a drawdown, if the market rose here. Now, based on the market trend here, you can see where the market came back to the 21-day a couple of months ago. We would expect the 21-day to be in play next week. So we would think that the 21-day would be in play, that you'd come down here, shake you out a little bit, and then see what happens. Now, what's nice about these shakeouts is it's going to allow you to see who leaders are. And we think that Nvidia is setting up again, that the stock can go much higher from now, but it's going to go through, it needs to go through, and it maybe going through a brief consolidation or digestion point. So what also is useful, Richard, is to go back and study America's Greatest Winners from AOL. That those models that they put out, so that you can really see how these green line breakouts take place on stocks that have many moves before it's over a number of years. So that's what we're looking, that's what we're trying to identify right now. We think that Nvidia, of course, might be a major winner from here. It's going to be the most valuable stock. It could be the biggest stock of all time before it's over. But if that's the peak, and stock's got to consolidate, it's got to come down to support, it's got to make new highs for that to happen. So this is it's a sort of a watch and wait period in in a stock like that to see how see how they set up or not.
Great. So if we want, I guess we can kind of proceed a little bit more through this. We've got a few more just things to touch on and get back to Q&A shortly. But Roy, did you want to go through this, kind of summarizing what we just looked at, and then I'll talk a little bit more about the today trend and some other thoughts.
Okay, this shows you the date the actual crossovers took place. So guys that are watching, go ahead and, of course, print this out, write this stuff down. So you can go back and you can incorporate this in terms of your, your analysis. But, we wanted to address it while the market is in a firm uptrend, the market's as bullish as it possibly can be, to prepare you for the next leg down whenever that occurs. And we don't think that we don't think that we're going to have a major leg down until we think that this market can rally to this time next year before you've got an ultimate peak in the averages. Next.
All right, so yeah, the next couple slides we'll talk about, this is just kind of like a checklist, basic checklist if you want to take a look and just step back and see what are all these indexes signaling. And this is just looking at what we consider trend over different time frames. And so NASDAQ, S&P 500, checking all the boxes, right? Short-term, long-term, medium-term uptrends. We know that the story has been similar to 2023. This first half of 2024 has been the narrowness of the market, and that kind of continues. And you can see that with the Russell, after a great November, December, has really failed to move anywhere and has had, trouble breaking out, right? There's been several false breakouts, I guess, of the Russell over the 6-month period. So, we're still not there on that basis for the Russell to be in I guess, an uptrend, but it is turning. It is turning. Very recently, where the short term has improved for the Russell. And so we didn't touch a whole lot on momentum, but there's a few ways to look at momentum. And what we were seeing perhaps is finally that rotation. I think that was kind of the consensus view in January, that small caps will outperform. Has not been the case, but we're always looking for that signal. Okay, when is it going to happen? Because when that does happen, that's when the trading environment gets very easy. So we're kind of looking at the Russell as that indicator to us if we're going to enter an easier trading environment. And so, of course, we have that backdrop that still is about inflation and rates and all that. And it seems like we're getting closer to real conviction that the inflation rate's coming down to 2, but I think that when there is confirmed market conviction, we're going to see this positive trend change in the Russell. Maybe we saw that within the last week. The daily MACD, the moving average convergence divergence indicator that we look at for momentum, that turned positive for the Russell as well as the price phase. And meanwhile, the NASDAQ and S&P 500, which have been those kind of top heavy, heavy concentration indexes, those have actually seen slowing momentum. So we're looking at, the possibility, sure, a little bit of short-term weakness, a little bit further, like Roy mentioned, coming to the 21-day, sure. That seems like a possibility in some of these major indexes, but the weekly momentum on these indexes is positive. Not yet for the Russell, but it's very likely that momentum on a weekly basis turns up for Russell if we get an actual breakout in that Russell index. So momentum, it's just a derivative of price. So it's telling you the same story as the trend and everything, but you can see right here, like the Russell maybe is giving you a day or two early signal with the momentum change here. So you can kind of incorporate this into trading and hopefully improve your edge a little bit. And then just a couple more confirming resources for the market, like direction or market health. Some of the things we consider: new lows, point figure, all positive. Are we within, 15% of new highs? Because that's, really a more healthy pullback, or really even less than that would be ideal. But also just wanted to point out this Minervini stim model. We use his service for, and he's got this sort of monitor of what, for the stock trading environment, and it can be red, orange, or green. And orange makes a lot of sense. We had some success in breakouts for a couple weeks, and now it's kind of a bit of a mixed bag with that. IBD, they offer this exposure kind of suggestion. So right now they're at that 80 to 100% exposure suggestion on their website. And so that changes, based on if, for instance, distribution days are racking up, or if, we're just pulling back more and, maybe breaking the 50 on the indexes. There's, I guess there's a number of things. So, these are other things you can use to kind of confirm, hey, are they seeing the same thing as us? Like, what are we missing, if anything? So some more things to consider with the market direction. And we'll end it here. So, Roy mentioned this quote earlier this week, and it spoke to us, and we thought we'd just share it to end it on. Your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. And so, long-term success we think is absolutely achievable and probable while you're investing, because we live in the United States and we're just lucky to have this fishing hole to cast our rods into. That is the U.S. stock market. So people are, constantly doing amazing things, working on the next big thing. And we're here to emphasize trading with the trend, because there are always going to be reasons not to invest. The most fundamental thing you can do and incorporate into your trading is trading with the trend, because year after year and decade after decade, the U.S. stock market tends to move up and higher as companies are created, and as those companies grow, and how they change the way we live, work, and play. So with that, that kind of concludes our presentation. If we have time for more questions, happy to take them if you have a few, Richard.
Yeah.
But again, here's some links. Let's see, helpful investor resources. We really like William O'Neill's work, of course, and I know you guys at TraderLion do too. And a reminder, join our meetup if you'd like. It's open to everybody, just once a month, and we share some thoughts, and would enjoy having you guys there. And, if you want to reach out to us, connect with us, you have our email and Twitter handle. So please do so if you'd like to.
Yeah, perfect. Well, thank you guys both, Roy and Wes, very much for putting this together. It's such an important reminder of, both the devastation you can avoid if you have, objective measure of trend like you guys presented. And also, of course, you have to have a way to also objectively, make the mindset shift to get back in at the same time. I do have a few questions here. I think we've got time for a few here. First, could you guys kind of differentiate between an intermediate term correction within the context of a longer term uptrend and something more like what you guys were sharing with the snapshots of, more significant bear market corrections? I think that'd be a good distinction to mention.
I think intermediate corrections, Richard, would be something along of 10% or more. So, the market's going to have, many of these 3 to 5 to 8% corrections, and we view that as being in a short-term correction, short-term drawdown. Intermediates are 10% or more. And then, of course, a bear market would be exceeding 20%. So, you never know. You never know when the short term is going to turn into an intermediate term.
Right.
You never know when the intermediate term is going to turn into a long term. But these are tools so that you can react And again, we showed where when the trend, at that, that May time frame where we, when the trend changed, we were bending. We're not buying when the trend changed and it's going down. We're selling. But then, but when the trend, when we were confident that the bottom was in and the trend reversed back up, then of course we put money back to work. And how, it takes a little bit of experience to be able to dial that up and dial it back accordingly. But, we're not going to be buying, and we don't advocate buying stocks, when the market itself is in a downtrend. Nothing is going to work. So that's why it's crucial to watch these indexes. We do know that individual stock participation is everything, but you're just not going to get setups when the trend is down. So that's how we recently, reacted, and we're up, I think 35% in our swing trading accounts this year, and in the 20s in our core accounts. And that's despite having the drawdown, the pullback, and getting out and then getting back in. But that's insurance that you pay. And we think it's important to always have insurance on the largest part of someone's wealth, their investment portfolio. If you have insurance on your house, you certainly should have insurance on your stock portfolio. And that insurance is being able to sell and de-risk and reduce
Richard, I was going to say though, for this first pullback that we kind of experienced, I think for months leading up to that, let's say February, March, April, we were talking to our meetup group about it, and we had said, okay, we were looking at the 09 and the 03 starts of bull market. So I think that context was important. That in our opinion, we were about 5 months into this actual bull market, right?
Right.
And so, we were all looking for this, okay, 7, 8, 9% pullback. And that is exactly what we got. So I think that gave us some confidence that, okay, it's probably one of those intermediate corrections, not necessarily the start of a new bear market. But at the same time, even knowing that, that 8% pullback manifested itself in a 20% pullback in NVIDIA, and we're not going to hold that stock for a 20% pullback, especially when we have 10, 15, 20% position, in that stock. So that's the whole thing. It's all fine to hold these indexes through pullbacks like that, most likely, but we can't do it in stocks just because that volatility is 2-3 times as much.
Yeah, excellent points there. Another question that I want to ask you guys was, you mentioned multiple times today, momentum was waning to the upside. So you're kind of not necessarily like predicting that there'll be a pullback and a signal that comes, but you're expecting it maybe and preparing for it. What are some signs that you guys pick up on in terms of the price action of momentum waning that could lead to, an intermediate term correction, or, something more significant? Obviously you don't know at the time, but, just to make sure you guys are protecting yourself, setting up that insurance. So if we do get the pullback, you guys are ready.
Well, that's a great question. And I didn't know if we were going to pull this up or not, but let me pull it up since you asked such a pointed question, Richard.
Sure.
Okay, so let me share my screen and I'll show you. I'll answer that for you. And this might be useful for the investors and traders on the call today. So let me share my screen.
Yep, it's coming up.
Okay, this is the program that I use the name of it is AIQ. I've been using this over 30 years. And do you guys see this? This reflects the NASDAQ chart right here on AIQ.
Yeah.
Do you see this clearly?
Yep,
we do.
Okay, so this is what got our attention, Richard. Okay, price phase is one component of the MACD. The MACD is, it's a technical indicator that it's quite common. It's very, very useful at market turning points from the tops to the bottoms of the correction. What we wanted to point out And we pointed this out when we de-risked, Richard, and this was a week or two ago where the price phase, you can see that it's measured by this histogram that it turned from up to down. Do you see where the stop made a lower high on this price phase on this day? You can clearly see that right there on that day. And this is what Wes and I were using to say, hey, okay, be ready for a momentum change right here. And a momentum change isn't a trend change. It's just telling you that momentum in individual stocks may be waning. So it's important to look at this at market peaks and market bottoms. So that's when it's useful. So, it's not necessarily a great useful indicator, if you're not using it and incorporated it properly. So there's the price phase. And that's why right there, where we started de-risking right here. The market, the 10-day, we haven't even broken the 10-day and we're de-risking some. And you can see that's followed by now over the last subsequent days, the moving average convergence divergence indicator turned to a sell signal. You can see that like 4 days ago. And you can see we're in this uptrend. The momentum is quite robust. Everything's normal. You had a brief pullback here on that May period, that pullback moved to new highs. And now the momentum here is you're on a sell signal. So we don't know if this sell signal, Richard, will just be, something, that's very short term and we recapture and recover this, or if this will turn into something more ominous. But this is how we were utilizing this is while we were utilizing things like the MACD and price phase and so forth to see, to let us know, to alert us that, we don't have a trend change, but we have a momentum change that might be significant. So that's why we're watching this closely, right now. That's why we de-risk, and that's why we've got so much cash in our trading accounts, because of these momentum might be waning right here.
Yeah, perfect. And how much do you guys typically de-risk? Is there a percentage amount that you like to take off, or does it kind of depend on the situation?
Wes, go ahead and answer that one.
How much would we de-risk? In our long-term portfolios, I think when we want to de-risk, we'll probably look at where we can take profits on stocks that are extended. So we did that, with NVIDIA. We did that with Eli Lilly. We sold Pure Storage. So that probably, we probably raised like 25% at that point in time with that. So I think that's what we try to do first, right? Case by case, de-risking and thinking about that. It's mostly on an individual stock basis anyways with that. An example of a stock we had to sell Friday was PWR, for instance. That was, it was below the 50 or, close to the 50, and it broke that low from like 2 or 3 days ago. And that. So, if we're de-risking to the upside, it's certainly on an individual stock basis, but, always we have these things that don't go our way, and you just have to take that with you. But the thing is, in our long-term, what we call our longer-term portfolio, we do give everything, like we say, we give it as much of an opportunity to succeed as we can, right? You want to let it go through that, and, leading stocks go to the 50-day. That's fine. That's very normal. And so, we were giving Power, this Quanta Services, every opportunity to succeed by letting it go to the 50, and then finally, having to cut it just based on the action. But I'd say that's anything to add there, Roy?
Yeah, and we actually sold this, taking out the prior day's low, Richard. It was down 2 when we sold it on Friday. So, it came down to the 50, went sideways a day, and then it came unglued. And again, you don't know. No one knows if this, if buyers are going to show up at the 50-day or not. And, you just have to assess and identify if and just take a look and be situationally aware of what's going on around you. But there's the break, and you don't always get it right. Let me just show you, for example, we were, this arm, ARM. Yeah, see, look at this arm, and I'll point this out. And this was a big winner of ours, Richard. We bought it way over here at 65, got a double out of it, sold half, kept the rest, and we ended up selling it here on the break. And this is when you had that April correction where it held the 50 and then it just came unglued. And so you never know where they're going, where they're going to dump it, but you just have to respect the technicals. And you can see right there that it didn't hold. And during that period of time, while we were bending with the market, we actually sold Kava, Richard, right here the second day, because it broke the 50. And we said, man, this thing is about to come unglued. And it did not. And it held up. And unfortunately, that's one of the big mistakes that we made this year, is not participating on this Kava from the break of this down trend line to today.
Yep.
But trading. It is trading. And let me just point out this NVIDIA, so you can see this. So the NVIDIA, there it peaked. Or excuse me, the price phase peaked that day. So we were watching this closely, and on the gap up, we started selling, Richard, right here, because we're up 50% in the stock in the course of a month, and we had a huge position in it. So we actually sold into this, and you can see the next day, that day, the price phase turned down, the day of the reversal, and we sold the rest of it in the trading accounts, and we sold, or during this period of time, we sold 50 or 75% in our core accounts. So we took this way down, and we're waiting to see if it holds here. See at the 21 day, but you can see the price phase is still, the momentum is waning there, and we're on a sell signal on the MACD. So we want to see what happens. Remember, price trumps everything. So we know that we've got support here at the 21 day. We know this is a leading stock. You had a mass reversal day, though, where you should have de-risked. And so we'll see if we can hold the 21 day, and we will trade accordingly from here. On it, we'll either add exposure or we'll sell exposure, taking out that low right there that we put in 4 or 5 days ago.
Yeah, and this is more of a clarifying question or point for people watching. Just because you guys are talking about selling into strength or selling more aggressively when momentum wanes, it's not that you don't believe in the stock anymore. The longer term trend has changed. Just at that moment, it doesn't make sense to have that exposure on. And like you said, with NVIDIA, it could continue to be a strong performer. You're just waiting for the next setup, the next opportunity to increase exposure again. Once the conditions are right, the risk, the spot to manage risk there is there. But so that's just kind of my take, but anything to add or clarify with regards to how you guys view things?
Well, barely maybe to add, but we were talking, we've been, since it was a big position, we of course we're looking at it every day, every hour, and we know, okay, it's very normal for stocks to come into the 10-day, 21-day, all that. Of course they're going to. And we were just doing the math. Okay, it opened up at $140 that day, and we're not willing to give back 10, 15, 20%, just because of a normal reaction, even right. So we're, it's partly because of the position size where you can't handle the, normal.
Right.
So we're more cognizant, I guess, of those normal reactions because it might be a little bit bigger than, some people's typical position.
Yeah, for sure. Roy, anything that you wanted to add?
Not really. I think we've covered quite a bit. So hopefully, hopefully your clients, Richard, the thousands and thousands and thousands of people that follow you and read your stuff, and that have enjoyed your great interviews over the past. We've listened to all your interviews over the last 5 years, and we got to say that they've been remarkable. And we have those all stored away. And we actually go back and listen to those occasionally with your friends, Lee Sorday, Oliver Kale, and all your constituents, Mark Ritchie, Mark Minervini, Stan Wiseman. And so we thank you for what you do to the community. You're a terrific pioneer. Your vision is amazing, and we're excited to see where you go and where you bring us over the next 20 years, Richard.
Well, thank you very much for the kind words, Roy. I wasn't expecting that, so thank you very much.
Yeah,
thank you guys for your work, for putting this together. Like I said before, we always appreciate having you guys here at the conference, and I think today was very valuable for people and addressed a lot of important questions and key problems that traders face. So thank you guys both for the time. To everybody watching, I hope you guys enjoyed. Make sure to leave a like down below. Thank both Roy and Wes in the chat. And check out the links that they shared as well. Any last words that you guys wanted to end everything with? No,
Wes?
No, I have no final words.
Cool.
Thanks,
Have
Richard.
a great day.
Yeah, cheers.
We appreciate you, Richard.
Yeah, thanks everybody, and we'll be right back. Cheers.
Bye-bye.
All right, welcome back, everybody. I'm very excited to introduce our next speaker, John Pocorobba, who is the founder of the Blue Sky event, Rain King Insights. He's also a veteran growth stock trader with over 20 years of experience, and he's also the Boston IBD meetup leader, co-meetup leader, and he'll be presenting about building confidence, trading gaps, definitely a very interesting setup and edge that you can master. So John, thank you so much for being a part of the TL conference. Please give him a warm welcome in the chat, and looking forward to hearing your presentation.
Thanks so much, Richard. It's great to be here at the conference this year. Really appreciate the invitation. As you mentioned, my talk today is really about building confidence trading earnings gaps. Just as a reminder, the presentation is for education purposes only. I'll give you a little bit more background. I am a part-time growth stock position trader. I have a full-time job, so many might relate to that. I do have a wealth of experience, about 25 years. As Richard mentioned, I've been running the Boston meetup for the past 8 years. I am going to be launching a website soon, Rain King Insights. But I've been studying this topic of gaps, earnings gaps, for literally years. Done some research, done a lot of study. So I think I have some things to share that if you're a position trader, this might be a worthwhile talk. So what we're going to cover in the presentation today is, why do we trade earnings gaps? A little bit about looking at a few key insights from some of the research I've done over the years. We're going to look at the 12-week earnings cycle, something we call power earning gaps, and some key insights we learned over the years. And then we're going to go a little deeper about what we call key signposts, and that's what things we look for in the first 10 days after an earnings gap. And again, this all the context here is for position traders. It's not really geared. You could adapt it possibly for swing trading, but I'm going to share a specific buy strategy that it relates to buying gaps, earning gaps post gap day, because I know they're fast moving sometimes, and people say, well, how do I get in if I miss the day of the gap, if I have a full-time job? So earnings gaps can be very, very tricky. Obviously, they can be kind of scary. Something sticks straight up in the air. They can be perceived as very risky. There's no doubt there's a lot of volatility around earnings gaps. I think we've seen it in the past 12 months. It can be devastating with some of these growth stops that miss, or even if they hit their targets, if they're not bullish enough on their guidance, it still can be potentially devastating. And they're very emotional. So there's a lot wrapped up in this. And one of the reasons I studied this over the years is because I believe that if you're going to trade growth stocks, I think you need to have an earnings gap strategy. I just think there's a lot of, if you can manage your risk, there's a lot of potential upside, but you got to know how your strategy works and managing risk around these types of events. So they do present opportunity. Obviously, when you get a gap up, that represents change. Something's happened with the company. The street probably has not forecast what the earnings and sales will be, and everybody scrambles to say, wow, this company might be worth more, and there's a lot of demand. So we're trying to look at the data and research we've done over the years to say, how can we produce some edge trading these, and how do we just build our confidence? As I mentioned, these can be pretty scary to buy something that's up 10, 20, 30%. But I think we're going to try and give you a little bit of technique on things to look for to hopefully build your confidence. So I wanted to start with what I call the 12-week earnings cycle. And I've just drawn this fairly simplistic diagram. And this is just looking at, again, from a position trading point of view, if we have a stock that's in some sort of base or consolidation, and then we have kind of a marker, we have an earnings reaction, the thing gaps up. And we believe that the first 10 days after that gap are pretty important to understand, I'll say, the odds that maybe you might have your hands on something that really has some rocket fuel, or if it starts giving us some negative feedback, maybe it's not going to work out. So the first 10 days are pretty important. And then as a position trader, the first 8 weeks are pretty important. And we kind of call that the alpha window. And that's what I say is kind of position building. We're trying to build a position, whether we're buying on the earnings gap day, but somehow in this window, we're trying to build a position for the first, 40 days Then, of course, about 1 or 2 weeks before the next earnings report, particularly about a week or two before, you're kind of in a situation where you have to decide, well, how are you going to get positioned? How are you going to play this? You know, how much cushion do you have going in and preparing for this next earnings report? Do you need to hedge? Do you need to reduce your position or sell your position if you're in a vulnerable spot, depending on the chart and your cushion? Or being prepared that if you get another earnings gap up, how do you add? How do you build your position? So this is a pretty typical cycle as a growth stock trader. This is kind of what we're trying to achieve, to get positioned well from the first gap, but also the second gap. As we know, sometimes these things work out and we can have things continue with a gap, but we also have to say, well, how do we control risk if these things flop out completely? And just called up a couple. Obviously, probably the people on this webinar are very aware of, we've had some great earnings gaps in Sweet Green and on, but we've had some pretty bad ones in Nutanix recently, Palo Alto, Dell, et cetera. So it's a pretty tricky environment. Now here is a chart, and this is going back to Pinterest from 2020. One of the things, again, I've looked at in doing our model book for the COVID bull market from 2020 to 2021 is, again, looking at an earnings gap, in this case, very strong one from Pinterest, up 36%, huge volume, and looking at that first 8 weeks. You know, what's happening in the first 8 weeks, and after you get an earnings gap, how much additional gain can we get by week 8? In this case, in addition to the scary 36% gap up, we actually were up 43% by week 8. We gained an additional 16%. You can see some positive things. You know, we have a high volume close, which we're going to talk about in a lot more detail in a little bit, but some support off the 20, et cetera. And again, trying to get positioned. In this case, it acted very, very well. And if you were positioned in the stock, there was another big earnings gap. So you had another big surprise. And if you caught both of these well, you could have been, you know, really in a great position. So let's move on to power earnings gaps. So these are what we refer to as pegs. I think a lot of people have a lot of different names, but when I describe the action, you know, I think everybody will relate to it. You might call it a different name, but a power earnings gap, in my mind, is you have to have at least a minimum of 10% price change, a gap up. In addition to that, we want to see at least 200% minimum above the average daily volume. And the third component is we want to see an earnings surprise on that earnings report, a minimum of 20% above the consensus estimates. And we'll explain why that is so important. So you hear these called pegs or power earning gaps. So this is a bar chart looking at some of these power earning gaps with these characteristics. And the table is looking at from the study that, a recent study that we did, you know, we're looking at what was the volume percent change, what was the peak gain, and how much earnings surprise by the green dots here. And you can see pretty big earnings surprises across most of these. And these are the pegs. So these were some of the best performing gaps in the sample size that we looked at. Now, one of the things in the data that we looked at was we looked at what we call the rear view mirror. Relative to all these earnings gaps, we said, well, how much was the earnings surprise? And I'm showing this in yellow. But we also looked in the rear view mirror, what were the last quarter's earnings percent change? Did we get earnings per share acceleration for the past 3 quarters? What was the percent change in the last quarter's sales? And did we get sales acceleration for the last 2 quarters? Because we were trying to understand if there were any clues in the rear view mirror going into an earnings gap. But then we also said, well, let's assume we have the earnings gap. What do the next 2 quarters look like potentially? Do we get more earnings surprises? And do we get more sales surprises in subsequent quarters after we get a big peg or a big earnings gap? And we learned some pretty interesting things by learning about the front view window. So this is a bar chart. I'll take you through this slowly. Again, these are referring to, we're looking at some power earnings gaps, which are the blue bars, dark blue bars, and a bunch of other names that we had in the study are kind of the light turquoise bar. And when we look at this rear view mirror, you can see here's average earnings per change from the last quarter. Here's the sales, and we asked if it had earnings and sales acceleration or a surprise. So you can see under surprise, the pegs had an average of 110 or 12% surprise versus many other names which were successful earnings gaps, but they were only 24% surprise, and they didn't outperform. So you can see almost most of the quarters, the pegs had better numbers other than the average earnings in the last quarter before the gap. So that's our rear view mirror. But again, looking at the front view mirror, the front view window, looking forward, you can see here that 88% of pegs had earnings surprise for the next 2 quarters. And that makes a little bit of sense, because when we think about an earnings gap, we're saying there's a surprise to the street. The street's caught off guard. They eventually say, we got to buy this stock, and they pile into the stock, and there's a lot of demand. And then subsequent to that initial gap, all the analysts have to revise all their spreadsheets and valuations, and they've got to do all their numbers again and say, well, what do we forecast for this company for the next 6 to 12 months? So they all scramble to try to get updated with what the company is actually doing. And what that results is, and sometimes even doing that, they're still a little bit behind the curve. If the company really has strong earnings and sales momentum, that's when we see more surprises to the upside. So the front view mirror pegs are really strong with surprises, and even the rest of the study was still good, strong numbers. And you can see the gains to the peak are comparable. Pegs were a little bit better, but very interesting data about how relevant is the rear view mirror versus the front view window. So moving on a little further into this, just to summarize some of this, again, 88% had earnings surprise for the next 2 quarters. And these metrics for the pegs were just far better than the other, and I'll say successful earning gaps. They were actually very good earnings gaps. They had gains, they did well, but the pegs were just superior. So when you're trying to figure out, well, how do I know which gap ups should I be in? A very simple screen is using some of this criteria about at least 10%, at least 200% volume, and a surprise of 20%. And to re-emphasize, those of you that are CanSlim, O'Neill type investors, model book stocks typically run for, 18 to 21 months to have a really good model stock run. So it's very key to say, how do I build cushion? Because you're going to have to get through some earnings reports. You'll have to go through at least 4 earnings supports if you're really trying as a position trader to capture the big move. So your positioning is very, very important to try and have the cushion to withstand normal pullbacks, potential base building by a stock. So some insights on some of the stronger types of gaps. Now, just important is also understanding that there was actually very little correlation in some of the research that we did to the most recent quarter. This was not such a big factor looking backwards, probably because the company surprises. They surprise to the upside. So whatever they did in the last 2 quarters, it's probably meaningless because things have changed with the company, and you need to be open to saying, what has changed? What is the theme? What is the story? What's the new product or service that is driving a big upside in a gap? So really, what's the most important with earnings gaps is it's institutions. It's the institutional reaction that matters the most. The institutions are the ones that have the capital to drive price and volume, and they do extensive research, and they try to see what's coming next. They have teams of analysts that get into every detail with a fine-tooth comb, and recognize that even they can be taken off guard and be wrong. That's why you're having a gap where they basically have missed it and something has happened and they say, we got to get that stock. We got to buy. They don't care what the price is. They're saying, we got to pile in, and it creates extreme imbalances of demand. So I've covered this, just the entire study. The front view window was really the most important, with earnings surprises for the next 2 quarters. So here's just an example of something that worked really well. Now, what's interesting is, ELF was probably the #1 growth stock during the bear market. In the bear market, growth stocks were not working. But here's one of the rare gems that actually did. And I'm just pointing out simplistically, here's the initial earnings gap, 11% gap, and an earnings surprise of 105%. And you can just see, I just plotted. What did it do? Well, another gap up, earnings surprise, 65%, another gap up, 15%. So it continued to surprise again, 106%. So the analyst didn't quite understand fully what was driving the changes in ELF. And they kept surprising, and you can see the stock run. It's a very strong run, and it's 1, 2, 3, 4, 5 quarters. So again, it just is an emphasis on how this plays out in the marketplace when one thing leads to another, and what your expectations might be if you have your hands on a really powerful stock that gaps. Now here's another one. This is NVIDIA. Now, I'll remind everybody, this is the old NVIDIA. This is the 2016 to 2018 NVIDIA, which also had an incredible run. Here's the initial gap up in NVIDIA, and this occurred right before a follow-through day in February of 2016. And you can see this did not reach the PEG criteria, but it was a strong gap up, and it had big volume and an earnings surprise. And then you can just take a look at these numbers. There is consistently more surprise, for the next 12 months. And then eventually the law of large numbers slowed down the stock. You can see the price action starts to flatten out a little bit. We go sideways. And even though they were still surprising, you can see that all of a sudden the reactions are not the same reactions we had on the way up. These are clues that something is changing. The institutions might be starting to distribute stock because it's a surprise, but stock didn't react well. Here's another bad reaction. So you need to pay attention to these to understand the character change in the stock. And it's all about the institutions. Their reaction is what matters. So if you start to see this and a stock that's flattening out, maybe the moving averages are flattening out, you just want to have your guard up. And here's the more recent NVIDIA, the king of the market. You can see here's the market bottom. NVIDIA broke out in early 2023. And then you can see the subsequent earnings gaps here on the chart. And again, the key to NVIDIA has been these huge raises in guidance, big raises, big gaps, incredible demand for their chips. So very strong guidance. So it's just been a powerhouse stock, and one of the leader probably of the entire market right now. So let's come back to this little diagram again and just kind of put our frame of mind around what we're trying to achieve here. There's a gap, there's a 10-day window, and we're going to look at this 10-day window a little closer now. But again, our goal is to try and build positions and hopefully get into a position where we can catch that front view window of hopefully more surprises, more gap ups. So I'm going to move into something called key signposts. Okay, in some of the work I've done and looking at these over the years, here's a diagram of some of the key things I look at in the first 10 days post gap. Now, there's a lot of things listed on this chart. I mean, I've got high volume close and the undercuts and, what is the gap day low, gap day high, some key moving averages that I use. So there's a lot of things on this particular chart, which I consider signposts that help me monitor if the action is consistent with some of the research, and I'm seeing signs that I might have a very strong stock, or if we get violations, maybe this is not the strongest earnings gapper. So we won't have time in this presentation to go over all of this, but I do want to take you through one of the elements of the signpost that I think is very, very important that you should be aware of. And that signpost is the high volume close. So the high volume close is a pretty important marker, and we're going to look at some charts. We're going to look at how this might play out. But the reason the high volume close is really important is it really represents institutional activity. You know, the reason the stock gaps up is because institutions are buying in bulk and they are really pushing the price higher. And we know that institutions, you know, they're at least 80% of all the volume on the market. You know, they are the one that create a lot of the volume of the market. And I was reading a statistic about 2 weeks ago that said almost 20 to 30% of the total daily volume happens in the last 10 to 15 minutes of the day. And we'll talk about why that's important. It's important because institutions need liquidity. If they're buying hundreds of thousands of shares of stock, they need liquidity. And they use that last 5 to 10 minutes of the trading day to soak up shares, as they don't forget, the institutions can't buy their full position in one day. Usually it's a position for an institution takes weeks to months to build a real big position, or even a 1% position in a stock. So, you know, at the end of a trading day, day traders are closing out their positions, and these institutions are saying, okay, we'll take that stock, we'll take that stock, we'll take that stock. And they just start gobbling up shares in the last minute of the day. And the reason they're doing that, institutions have to try and manage risk too. And it's very difficult for an institution to manage risk kind of in the middle of the day. So we know that, you know, on the open, in the first 10 to 30 minutes, there's this initial surge, and then eventually things kind of settle in. There could be gap ups at the open. There could be a lot of volume at the open sometimes. And, you know, once things settle back in, institutions don't do a lot sometimes in the middle of the day. Of course they do, but they tend to get back in the last 15 minutes of the day because they can control the price and they can avoid severe declines where they get caught. So they do trade a lot in the last part of the day. Now, reaccumulation and support is another important concept. You know, post-gap day, you know, sometimes the institutions will purposely let the price fall back a bit. They know that retail traders are probably taking a stab at a gap up, but they'll let the price fall back a little bit and undercut that high volume close. And, you know, most traders, you know, might have a stop at 3, 5, 7% below a purchase price, and they will get stopped out. If the institution stop buying, it's pretty common for the stock to come back, shake out all those stops. And what happens? The institution says, we'll take all those shares because we're building a real big position. We'll take all those shares that you just gave us on the little shake. So they tend to reaccumulate and they create support around this high volume close. And the high volume close represents what the institutions closed that stock at that particular day. So it's important. Demand is number 4. And again, after the kind of absorption, as institutions pick up all these small orders and shares of retail and other institutions that maybe are trying to get out of the stock, there eventually becomes this imbalance of demand. You know, the shareholder float starts to shrink because institutions are going to be buying for maybe weeks to months, and they're not going to flip the shares. So essentially, when they buy 100,000, 200,000, 300,000 shares, they are basically putting them in the bank, and they're not going to be traded for a while. So their float starts to shrink, and they tuck those shares away. And then when other people start to buy, they literally have to pay up. It creates demand. So it's all about supply and demand in the market, and the stock really becomes mature, and you'll start to see the stock move up into an uptrend. So that's a little bit about why this high volume close as a marker is important. So let's talk about a few statistics and some research around the high volume close. This is a little chart just to give you a little visual. So if a stock gaps up, here's the close of that stock on a candlestick chart. I typically will draw a line. That high volume close to me is an important line to be aware of, as we just mentioned, the institutional activity around it. Now, I've studied this and really studied how much undercut of the high volume close is acceptable and is normal in the big winners. And we want to know this. So in this data, we looked at high volume closes that only get undercut by 0 to 3%. Pretty strong situation. If a stock gaps up 10, 15, 20%, but it only undercuts by 3%, that's a very strong stock. And you can see the results of this are in the next 10 days, 7% gains for the bulk of the stocks in the study. The pegs, though, actually the pegs, this is not showing the pegs, but 30 days, you're 18% ahead. Again, small undercuts are showing that the institutions aren't letting that stock fall too much because they want it. Then we looked at 5%, say, what's the 5% undercut do? Still very, very strong numbers. As soon as the undercut gets, maybe about 10%, greater than 5%, it gets a little bit iffy in the short term. 10-day gains are not nearly as strong if you're undercutting by more than 5%. The 30-day gains still were pretty strong. So these undercut levels are important to be aware of what might be normal and strong conditions. And in some of the research we did, 60% in this pie chart didn't even undercut by more than 5%. And so that's important when we talk about how do we manage risk. And you say, if you keep it fairly simple, you could say, if I just carry a 5% stop, it's, that's a fairly simple way to control your risk. And you're still saying the odds are still in my favor that we don't get that undercut if this is going to be the biggest winner, the strongest gappers. So fairly simple. Again, as a position trader trading part-time, it's a simple way to manage some risk. So let's look at this a little closer. So if you get less than a 5% undercut in the first 10 days, again, it's a very strong situation. We looked at the power earnings gaps that I mentioned, that grouping of the strongest of the strong, almost 70% of them only undercut by 3% or less. Very strong situations. And if I expand that and say, if I get into a power earnings gap, and we've defined what that means, and I allow a 5% stop or a 5% undercut, 75% did not undercut. So that's an important key signpost. So again, if you were to buy this gap at the close, if you didn't catch it off the open and you said, well, I want to buy it right at the end of the day and just put a simple 5% stop and the stock exhibits peg characteristics, it can give you some edge because it should not undercut by 5%. Now, we looked at a 10-day swing strategy, which we're not going to have time to cover here, but there is a strategy to basically play the swings and selling stocks after 10 days. But we won't cover that in detail here. But these small undercuts can be very strong situations, particularly if you get a small undercut of 3 to 5%, and then the stock comes back up and recovers that high volume close, that's a buy setup. And we're going to talk about the specifics of that setup. And again, key thing is the institutional demand at these high volume closes. And you'll see many times that the high volume close will hold as support as institutions use it to accumulate more and more shares over the 30, 40, 50-day kind of window, as I mentioned, between earnings reports. So let's get into something a little more fun, get into some of the buying technique. And again, I just want to preface, this is for a position trader. Okay, it's not really meant to be, you could adapt this for swing trading or even other time frames, but this is geared as a position trader. So putting some context around this again, when we have earnings reactions, there's pre-earnings reaction. Once a stock releases their earnings at, say, 4 o'clock, there's all this after hours activity. And those in itself can provide buying opportunities, which we can't take the time to go over here. But there's also pre-market. The following day, you've said, oh, wow, this thing was gapping up in after hours. Maybe it's still strong in the pre-market. And then we have the actual day of the gap, the actual day of the chart, and you see things gap up. And this is where you're most likely, as a position trader, particularly part-time traders, are probably getting involved here. Though, if you're an active trader, you might be playing the aftermarket hours. Once we have the earnings gap, as I mentioned, this key 10-day window, and then the 50-day alpha window, and then the extended move, we're going to look at this in a little more detail as we try to look at some ways to buy. Now, before we get in and start buying all these gaps, I want to put some context around this. And this is very important. A big consideration is, what is the environment? And by that, I mean a couple different things. One, are stocks being rewarded or punished recently in their earnings gaps? I think, as we all know, guidance seems to be a huge, huge factor recently. Even when you hit your numbers, if they're not good enough on the guidance, they still could gap down. So, if we're in an environment that things are even giving good numbers and the reaction is poor, that's a caution sign that the market is not rewarding growth stocks. And you need to be very cautious about how you position size and be choosy about which gaps you might want to consider playing. What is the theme? What's the story for this name? Do they have a driver that's driving this unexpected gap up with a new product, a new service? Is it in the right theme, such as AI? So what's the theme? And another thing I look at is I usually look backwards and say, what did the stock do on its last 2 earnings reactions? Just to get a gauge of how the stock behaves around earnings. If I see a stock that has had more than 10% gap ups and gap downs going into this report, that gives me a little bit of pause. It means that stock might be a real volatile stock, and you want to look probably at the average true range of that stock. Is this a stock you want to try? Because if it's really, really volatile, if you find a stock to say just stock for the past few reports only moves maybe 3 to 5%, okay, it's fairly calm, it's controlled. Doesn't mean we can't get a super gap up, but you might want to look at that for clues to say, is the volatility in this name something I'm willing to accept and take a shot at? What were the past earnings and sale? What's forecasted? Are growth funds actually increasing their positions, the couple quarters before this earnings report? It's another guide. These are the smart people. They got teams of analysts that are studying this. And if they keep seeing more and more funds, that's a good sign that they see, 1 year, 2 years, 3 years out, that this stock has potential. And usually a good guide I use is, I want to see I'll say the sweet spot, about 400 funds at least in a stock. And that 400 funds could grow to 1,000 or 1,500. And you need that buying power behind the stock. If it only has maybe 100 funds or 150, it's okay. But I get a better edge out of it if I see over 400. That's a number that I use. So let's look at a strategy. Now, there's a lot of different strategies to buy gaps. So in this presentation, the context is, let's assume you're a position trader and you did not see the stock, you didn't gap up, you were tied up at work, and you say, well, how can I get involved in the stock and buy it post gap day? So that's what we're going to look at. And I'm going to look at, there's ways to do this on buying on strength and buying on weakness. I'm going to share a way to buy it on weakness. Okay, so post gap day, and we're looking at temporary weakness. And that's why I preface this all with talking about the high volume close and undercuts. Now, another tool I'll use is the 5-day exponential moving average, and I'll show that on the chart. And I also use the gap high and the gap low for some other context. As I mentioned, those key signposts, a bunch of other things, but for the strategy we're going to use, these are pretty much the three important things that I would use. So here's a simple template. Buying a gap, post-gap day on weakness. And the strategy is if we have a high volume close, I want to see that visually on the chart. Typically, as I mentioned, the institutions might back off the stock and let it fall a little bit. And in a strong situation, the stock might fall 3 to 5% below that high volume close. And that gives the 5 exponential a chance to kind of catch up. It's a faster moving average, much faster. And it kind of, you'll be surprised at how many times the stock will come down, tag the 5-day exponential moving average and get some support. And it sometimes coincides with 3 to 5% below. So giving some wiggle room below that high volume close and using the 5 as a guide to give us. So the strategy is if we can see support at the 5-day, the undercut's not too bad. And then when we come back through that high volume close, I'm a buyer right there. That's telling me that there's support for this stock, and I want to be buying right as it comes back to the high volume close. And in this case, this is the gap day high in red. That could be, depending on how aggressive you are, that could be an add-on point to your position if you're aggressive and how you want to play it. But it's a good sign to say the stock is taking out that prior resistance level there of the gap day high. So let's look at a bunch of examples of this. And again, we want to see the big volume occurring on the gap up. Okay, this is another 2020 gapper. This is Celsius. Now, Celsius was a peg. Now, what was interesting about this one, this is an example where this stock gapped up, but it had really a poor close. Not a good close. And if you had bought in this intraday, let's say you were trading it during the day and you bought up here and you used a simple 5% stop, you got stopped out. So we're assuming we see the high volume close, we're buying the next day. So in this case, the high volume close was undercut by quite a bit. This is an 11.5% undercut, and it actually closes the gap. So this is not what I would call good action, not great action. But you'll notice that even though this poor action kind of closed the gap, it did get some support at the 5. And then it actually got a little shakeout here at the 5 again and got some support and came back through the high volume close. That could have been an opportunity to take a shot at this particular stock, because I would take a shot at this stock only because it was a power earnings gap, because I don't like the action of the undercut. But you say, look, it was a power earnings gap, maybe it's worth a shot. And then if you had gotten in this particular one, Celsius had a really powerful move that came forward from that. And you can see at day 10, this stock was actually up 40%, which is quite good. Now, looking at it on a candlestick chart, again, here's the high volume close recovery. And if you're a candlestick aficionado, you'll notice that there was a wick setup in here that you could have added to your position. So that's a technique for another day, but there was a wick setup that actually gave you another chance to potentially add on to your position. Now, Celsius, let me show you this one. I'm going to go to Celsius, the broader picture. Same Celsius time frame chart, but looking at it, the whole move. So we can see here a couple things. Here's the data at the time of the gap. It was a big earnings surprise, over 233%. Last quarter's earnings were crappy. The sales were good, no acceleration, but the sales were picking up. So sales are picking up for the product, and we had a big surprise. That was enough to be a catalyst for the stock. And again, you can see here, here's that 10-day window. We got a really nice move. And then you can see the stock really settled in. It digested this move quite nicely. This line in teal is the 10 EMA, and this purple line is the 20. So you can see we respect the 10. We never broke the 20. So that's very, very strong. And you can see it kind of rides the 10. And you got a really good move. Look at the markers, 30 days, 40 days, 50 days, really, really strong. And what do we have here? well, you would have been positioned pretty well and you got another gap up. So this one actually worked out with Celsius. Got a little bit of a shaky start, but again, I think it was worth a shot because it was a peg. So here's another one from 2020. This is Peloton, which you're all familiar with. Big winner from the COVID bull market. This is May 20 of 2020, and it was a power earnings gap. Now, sometimes these things are tricky. They don't always work. So I want to be realistic here that these aren't always going to work. You can see here, here's the high volume close. We're waiting. We get an undercut of about 6.6%. So that's our first clue that maybe this is maybe not the strongest situation. It's a little wider than we'd like, but we stayed above the 5. It actually came back up through. You might have bought it here, or maybe you waited. We had a shakeout. So this was tricky. This is volatile. It was a very volatile time during COVID. But if you use the technique, you would have bought off that support off the 5 coming back through the high volume close. You would have made your purchase and probably set a 5% stop. Fairly simple. Stock tried to make a move, didn't get very far. Very bad reversal bar here, closed below the high volume close. I know myself seeing this bar, I would have just simply sold. It's just not good action. I would have just gotten out. I wouldn't have waited for my 5% stop loss. You can see it actually tried to stabilize, but then it shook out again. It was a really tricky one to get in. And sometimes these earnings gap, you got to stay with it. Take a second shot at it. You'll see here that I've pointed out, if I drew this high volume close all the way across, you could have attempted this again and gotten in right here on the recovery of the high volume close. Again, it ran for a couple days, came back down, definitely tested you again. I'm not sure if this is a 5% stop out depending on where you bought. But my point is, don't be afraid to try twice. If you think a stock has, it's a power earnings gap, you think it's a good story, you think it has good product, you see the institutional support for the stock, you might have to take a couple shots at it. So they're not all perfect. So here's something more recent. This is AppLovin. This chart is from November of 2023, which we had our last big bull leg up till May. So May of this year. So I just wanted to put this in perspective. This is a daily chart. You can see long basing consolidation. And you'll notice that looking back, here's the last earnings report. It was very, very wild. The stock actually tried to gap up and break out. It was a very wild day. I was watching this stock and it tried to break out, reached resistance. It flushed all the way down. It came back up. This was a crazy, crazy day in the stock, and it was big, big volume. So clearly there were some institutions probably trying to buy it, but there was definitely overhang with some institutional seller that was just looking to get out of the stock. They wanted out of it, and it created a lot of volume and a lot of volatility. So it based for quite a long time. And it was February of this year, though, the stock really reached a situation of demand. We had a nice earnings gap up. We get a breakaway gap up here, nice 25% gap up. That's a big gap up. So let's look at this a little more detailed on a zoom in. So here we are zooming in. Here's the gap up. Again, AppLovin was a peg, had a 25% price gain, a 41% earnings surprise, and the volume is over that 200% above the 50-day moving average. So it's a really strong candidate. And you can see here, I've drawn the high volume close, and I've also drawn this kind of 10-day window that we look at carefully. Now you'll see here that the stock got above the gap day high, which was a good sign, but then it pulled back in. And the undercut on this one was 6.8%. But in the context of a 25% gap up, that's not too bad. If we go up 25%, 7% is not too bad. And notice how it got support right here at the 5 EMA. So came back down, got support, and using this simple technique is saying, okay, got support. I'm going to look at buying the stock as it comes back up through the high volume close. So you could have gotten involved in the stock in this area here and managed your position maybe with a simple 5% stop. And you'll notice that the stock made a little move up, came back down. You never got stopped out. We got a little bit of support at the 10 EMA. And notice that support came in right at the high volume close. That's a good sign that the institutions did not let this go down too far. And in 10 days, you actually had some gains on the stock, which is good. Then we moved higher, and then we came back with a kind of a bad day in here. But you'll notice even this bad day did not undercut the high volume close. So it stayed well above it and above the 20. So still acting normally at this point. And if you hung with it, you actually got a good move. You got a good move here. We came back still above the 20 a couple times. So by day 40, again, this is this alpha window where we're trying to position build. And by day 40, you had a 22% cushion, but it definitely tested you because look what happened. It came back in. You had to be willing to give back a little bit of gains because you came back down to this red line, which is the 50-day simple moving average. So it came down and tested you. It actually came and tested you one more time. And this is that window, 1 to 2 weeks before the next earnings report. If you hung with it, you actually had about a 28% cushion going into this next earnings report, which is, to me, that's plenty of cushion to hold the position, but it depends on your position sizing. If you want to take some off or if you want to ride it all. But you were rewarded here. You got another gap up, 14% on big volume. So you were rewarded in here. And it turned out to be a pretty nice trade using a fairly simple technique. Here's another more recent one. Here's Uber. And this is from February of 2023 to April of 2024. So this one had a news-related gap up. So it wasn't earnings. The earnings were actually back here. You can see this was the earnings day. So it pulled back in. Then it had some, I forget what the news was exactly, but there was a news event and it gapped up. So again, sometimes you can use a news event. And again, looking at the high volume close at 79.15, using this simple technique, it came back in, undercut by very acceptable 4.1%. And you can see this light blue line. This is the 5 exponential. It grabbed it twice. And as it came back through the high volume close, you could have gotten involved with the stock right here. You could have used a simple 5% stop, or maybe you used one of these lows in here if you were more risk averse. Stock pretty much chopped sideways through the first 10 days. Not bad, but it's basically hovering around the high volume close. It's not running. And probably that's worth noting because you want to look at it in context with the general market. Stock went sideways. You can see the relative strength line starting to deteriorate a little bit in that period. So maybe some other names are moving faster. So the context is important. Now you'll notice that it tried to move, couldn't really get going. It was getting support at the high volume close 1, 2, 3 days. Then you had this kind of bad reversal day. It tried to go into new high ground and then came right back. Now, it's a tricky one because it held the high volume close, but it was not a good day. And then the following 2 days, it got a little bit worse because you lose the high volume close. But on the positive side, you came back into the 20 and got support. But, detailed wise, look at the high volume close here. All of a sudden, the high volume close, it gets rejected trying to get back through that high volume close there and closes below it. That's a negative. So there's some mixed signals in here that are, some look okay. They're getting support, but it's not completely a clear picture. We get this rejection. That's a caution sign. And then you can see that 5% stop, you got stopped out. At day 22, you were stopped out of this position. So being realistic here, they don't all work out. And you can see this stock, after you got stopped out, it kind of threw it in your face a little bit and it rallied. And then it actually came back. But look, ultimately, it went into a slide. So it wasn't ready. And I think the other clue, and this is so important, is look at the relative strength line during this choppy period. It really is deteriorating. You can see that it's making new lows. So when you're looking at that relative strength line making new lows and you're seeing these kind of mixed signals, you may want to be cautious and you may want to move your money to something else. This is just not a good sign that other names were outperforming it. And the last example I'll show is Qualcomm. This is a more recent one from March to June. And this chart is as of, I believe, yesterday. So this formed a really kind of a double bottom basing structure with a little shakeout in here. And the stock had earnings and it blasted out of the base. Now it was an earnings gap, but it was not a peg. So it's not a peg, so it's not the strongest of situations, but using our technique, we have our high volume clothesline, and you can see the stock actually tried to make a move a little bit. The institutions probably backed away as volume started to decline, came back down. This one came back all the way down, had only a 2.8% undercut, not much at all. It's less than the 3% that we say is really a strong situation. So that's a really good sign. Kind of broke the 5 a little bit, but then it recovered the 5. And actually, I took this trade. I bought right here at the close of this particular trade. So I bought this, and you can see from this point, the high volume close really was never really challenged. It was touched the very next day, but it held. And then we get this nice kind of glide along the 5-day, many, many days. Now, this is really occurring with the AI chip push. Good news from Apple and NVIDIA, and you can see you really weren't under no pressure for quite a while. Then the stock came back, normally came back a little bit, and you'll notice that it gets support at the 10 EMA 3 times, 1, 2, 3 times. So still very normal action. Nice move. We get a little normal action. And then we had this push about a week ago, and it had this really a shooting star candle, a reversal bar. And that was a sign that probably this stock is going to come in. So you're expecting it to come in to some degree. Now it came in pretty hard. This is quite a drop. This is almost a 20% drop. I think it's 18 or 19%. But you'll notice if you put it in context, the 50-day moving average is still right here. And we're still way above some of the high volume close. So depending on how you're positioned will determine if you're willing to hold through this. So I'm positioned down here. I'm holding, hoping that the institutions will support this stock. Don't know. And I obviously have a plan to get out if things don't work out. But so Qualcomm has worked so far. We'll have to see if it completely breaks down or we get some support here and maybe it becomes a buy setup off the 50-day if the stock continues to rebound. So it could be an add point for a position trader. So we've covered a lot in this thing, and we've covered about all these different topics. So hopefully this is something that you've gotten a few nuggets that maybe you can bring into your trading or adapt to your trading. Maybe this simple buy strategy helps some of you who might miss the initial gap, and maybe you can buy something post gap day. So there we go, Richard.
Yeah, wonderful, John. Like you said, you covered a lot today, so I want to thank you for that. I definitely took some notes and got some key takeaways from it today. So thank you so much. I definitely have a bunch of questions that I want to run by you. First, I really liked how you showed kind of some recent trades and recent action. I wanted to ask you kind of what your biggest personal takeaway from doing this study was. And maybe just share some, maybe a few that might be helpful for everybody watching today.
Yeah, the reason I've kind of studied earnings gaps in the last 3 or 4 years, more from a kind of a research point of view, is I just think they present a lot of opportunity for growth stock investors. But you can't take them lightly because they can be very volatile. And if you're not controlling risk and you don't have some strategies, you can get really hurt. They're sometimes very fast moving, there's fast reversals. But I also think that if you can control your risk, there's tremendous upside if you get your hands on a winner and you get something that, again, the research told me that, earnings surprises should continue in the best earnings gappers. And you say, well, what one's the best earnings gappers? Well, the power earnings gap. So those are really important. So it really was done to try and add another technique into my tool bag. Mm-hmm. They're not, if your psychology is not comfortable with it, then maybe it's not for you. But it's a strategy that I've been using. You get stopped out, as I mentioned, I showed some examples, say, look, you do get stopped out. These don't all work out, but there is tremendous potential if you get your hands on a big growth name and the right theme, and you could have a good winner.
Yeah. And what I like about them is they also, you can kind of understand very easily the market dynamics at play. And you kind of went into this with these huge surprises, earnings surprises, sales surprises. all the institutions have to reevaluate their models and therefore reevaluate their positioning in a particular name. And that can create the trend that we can take advantage of traders. So I really like that you can very simply understand the dynamics behind it. I don't know if you have anything to kind of add on that front. You definitely already mentioned it in the presentation.
Yeah, I think we just have to always remember, us small little retail traders, we don't mean much in terms of moving stocks. It's all about institutions. And as I mentioned, institutions drive, they are the engine. They are the ones that are creating the high volume close. And don't forget, institutions take weeks to months to build a position. They're not in there for just one day. So if you can get in there and kind of get on their backs while they're going to accumulate, you could get a nice trend.
For sure. And one other question I want to ask in terms of how you've applied the study, on average, and obviously it changes based on market dynamics and all that, and if they're being rewarded, but how often would you say you focus on earnings gaps and take an earnings gap trade versus a normal base breakout, moving average pullback, maybe, percentage wise, which setup you kind of use on average? And again, everything's kind of market dependent, but just wanted to see if you had any insights there.
Yeah, for me, I really pay attention to the market environment. How are gaps in growth stocks being treated? So if I see, Nutanix getting clobbered and Dell getting hit and Palo Alto getting hit, then that environment, to me, the odds are stacked against you. So I'm just saying, this is not probably the time to play an earnings gap unless I've already got a big cushion from a prior buy.
Right.
If that's the case, I probably will either hedge a little bit or I will, go into the earnings gap. But if you're seeing these negative reactions, I tend to stay away. I want to see how the street is treating growth stock gaps. If we're getting some good gaps that follow through, then I'm more apt to try and take those trades.
Yeah, excellent. And I also wanted to hear a little bit more about the scope of the study that you did. So would you mind kind of mentioning, for people who aren't familiar, how did you go about doing this research? What periods did you study? How many stocks did you study? Because that might help provide some context for interpreting all the excellent charts and graphs that you shared today. I think that'd be great.
Yeah, the study started with the bull market from 2016 to 2018. That's where and we looked at the big winners. We looked at the big winners and we were trying to say, well, what characteristics do we want to really look at? And we looked at technicals and fundamentals too, so that you saw how we looked at kind of the rear view statistics, the front view surprises, and we also looked at technicals about moving averages. We looked at high volume close. We did some Fibonacci studies. We did a whole bunch of other things that I couldn't get into in this presentation. There's just too much there. But we also expanded it to look at some of the big winning trades from the COVID bull market. So you'll notice I had some of those charts from 2020. We looked at those charts as well and folded them in, and then actually took it one step further. Throughout the bear market in 2022, I tracked earning gaps during that to say, well, how does this work during a bear market? Now, interestingly enough, obviously gaps in growth stocks don't work well in a bear market. But what we did learn is we specifically studied, well, did they hold up for at least 10 days? And we have a bunch of data that even in a bear market, if you have a 10-day strategy, simply by buying the gap at the close and selling 10 days later, no matter where it is, you actually can come out ahead. Believe it or not. At least it happened in the 2022, which is a smaller sample size, but it was interesting to say that if you really needed to trade a gap in a bear market, I think you're going to want to really have a swing strategy to say, you're going to take gains at 10 days. Because anything more than that, they can collapse quickly.
Yeah, very cool. And I want to have a follow-up question about how you guys chose what technical and fundamental characteristics to include. a lot of it seems very rooted in the canceling methodology, which makes sense. But yeah, just from designing the study perspective, how did you decide what factors to include, and maybe the reasoning behind that? This might be helpful for other people who are designing their own studies or want to take a look at gaps themselves.
Yeah, I originally started the study myself, and I was looking at a series of variables, some of them CanSlim related. And then about halfway through, I brought in Jason Thompson from Ticker Monkey, and he's really an expert at candlesticks. And so we started to overlay candlestick patterns and combinations on some of these gaps and say, can we find more edge? Then we started to also look at Fibonacci, some of these Fibonacci retracements and targets. And so we added that layer on top, and we found some more edge relative to Fibonacci levels. So brought Jason in. It only made the study richer, and we got more insights, and we kept scrubbing it to say, as you know, Richard, we're trying to stack as many edges as possible. And so we went really deep to curate a whole bunch of edges that I couldn't get into in detail here today, but kept layering things on to say, how can we get as many edges to put the probabilities in our favor?
And do you have any plans to kind of expand a little bit on the study, and maybe you've noticed some technical characteristics that you might want to add on in the future? For instance, just hearing you speak, I was curious about how does the closing range on day one impact things? How does thinking about the gap up in terms of ATRs versus percentage change things? So I wanted to hear whether you guys had any plans. Obviously, it was a very substantial study, and you might be a little burned out, thinking about it for the short term. But in the future, I was curious if you had any plans to, dive a little bit deeper in any direction.
Yeah, actually, in doing the study, there's a whole bunch of variables that we studied that basically didn't mean much. So this trial and error. I mean, we did study how many days before you break the gap day low. We did study and say, a bunch of variables, and they really were nothing significant came out of them. So you just say, I have the data, but they just, it didn't really relate to anything that provided an edge. So, it's, and Jason and I are actually working on a couple things to overlay into the alpha window. We're looking at something called a milestone moving average. We're looking at ATRs in terms of can we get some edge about how we place stops and manage risk. So there are some things that we're continuing to do to build our expertise in earnings gaps, and hopefully they will turn into different trading techniques.
Yeah, and knowing what doesn't work is just as valuable as knowing what does work. So that's excellent.
Yeah, there's a lot of failures along the way. You think something's meaningful, and you say, "Geez, this really had no impact."
Yep, absolutely. And one thing, and first of all, taking a step back, I think I really like how you angled your presentation more towards people in a similar situation to you, that they take this seriously, but they may also be working full time, which I'm sure a lot of people watching, that's kind of their current situation. I want to ask, what you kind of do personally, routine wise, to make sure that you're staying on top of potential earnings gaps and make sure that you're able to review them, take a look at their characteristics, see if they match, the models that you guys created using this study. But just make sure that you don't miss any excellent opportunities, routine wise, especially in the context of people who, only have a few hours a day, maybe are working full time and don't have, aren't able to just review it, every day, post market, that type of thing.
Yeah, good question. What I do is, I obviously have watch lists of, I'll say, growth stocks that are showing, leadership characteristics, relative strength. And then what I do is, I'll know all those earning dates, probably 3 to 4 weeks. I know the earnings dates of those stocks. And so that's when I start to pay attention and say, I have a chart. I say, what are the reactions? How did this one react? How did that one react? So I'm kind of already pre-filtering what I think are the leading growth stocks in the market, showing relative strength, showing good price action. And I just focus on those and say, here's 20 names that I'm interested to kind of watch. And I said, maybe there's one, the first couple come out and I'm not trading them, but then there's one down the road to say, boy, I'm really interested in these three. And I use that. So you can get kind of I don't run screens to say I want to look at every earnings gap of every stock. That's just too overwhelming for a part-time trader, in my opinion. So I'm focused. I'm focused on my watch list that already has a pre-selected list of probably 20 leading growth stocks that I'm interested, that think have the right theme, they got the right story, and they're showing good price action. Those are the ones that I think I know I focus on, and hopefully our potential trades.
Yeah, and how important, and maybe you don't have any hard numbers on this because it's kind of a harder thing to objectively define, but how important is that theme in a successful earnings gap? I don't know if you could take a look at, what an ETF is doing, moving average wise or trending wise at the same time that a post gap. It's harder to do in a study, but yeah, if you had any kind of insight regarding how important is a gap to be in the right theme at the right time. I'm sure that might have a pretty big impact on the performance.
Yeah, I don't have hard data on that, but I will say that if you're considering a growth stock, it's important to I think to maybe glance at the ETF, because it's like, for instance, let's take the cybersecurity stocks. They didn't react well, most of them in recent quarters. Palo Alto and Zscaler, and CrowdStrike has held up probably the best. And I do have a position I continue to hold in CrowdStrike today. I've had it since November. Hasn't been easy. It's been volatile, but I'm still in there. But if you see that the group mates are all gapping down and not getting good reaction, you have to consider that, to say, do I really want to play this next stock in that same group when the sector ETF is not doing well, telling me that the group is losing relative strength? I would shy away from that, or I'd be very cautious. If you're looking at a stock that's in a group like semiconductors or whatever the right ETF is, and you're saying, wow, a couple of semiconductors are gapping up, they're getting good reactions, SMH is doing well, or the Soxel's doing well. Again, stacking your edges. So be aware of what the whole sector is doing to try and get yourself aligned with as many edges as possible.
Yeah, excellent. And I really liked how you showed Uber, which was kind of an unsuccessful gap, because obviously, as we all know, not every setup is going to work. But were there any kind of characteristics that you guys noticed in doing this study that maybe not it's maybe not predictive, but analyzing the stock in the moment as you go through it would differentiate between an Uber, which tried to build versus that HVC and set up, but ultimately rolled over, versus a Pins, which also had a pretty frustrating period going sideways during 2020, but ultimately led to a really nice trend that we could take advantage of?
Yeah, that's a very good question. I can add a couple of points to make. One is I mentioned key signposts in the first 10 days, and we didn't go over all of them in detail, but those are some of the key things we look at to say, how does it react around these kind of basket of things? Because what we're trying to do is saying, we want to be able to monitor each day for the first 10 days. Is the stock acting right with the characteristics of big winning gaps, or is it not acting right? So we look at that. The other thing that I know Jason and I do when we're getting prepared for earnings season and some gappers, we're plotting what are the key levels in this particular stock. What is the high volume close? What is the gap day high? What is the Fibonacci extension? What is the, all of these things that we're saying, let's look at these to see where we see a good risk reward. And when you do that, sometimes you say, this doesn't have a lot of edge, even though the chart looks okay. It may be running up against some resistance levels. Jason's very good at looking at sometimes quarterly charts, which might be new to some people, but zooming out to weekly charts and quarterly charts, sometimes you can find key levels in those charts that would be relevant on a daily chart. So they're kind of hidden. So there's a number of things you want to be prepared for, because it's all about monitoring it as it unfolds to say, are we seeing the action of big winners, or do we say, look, this trade is just not giving us good feedback and we should just cut it?
Yeah, and something that when you're going through that Uber example that stood out to me was you were monitoring the RS line, how it was comparing versus the rest of the markets, and also those subtle candlestick patterns where, you know, it tried to break out from the HVC, got rejected, and then that HVC level turned into resistance. I think that that's some great key things that you shared previously. And I love that HVC level. I watched that as well. I learned that from Ray as well. A lot of people are monitoring that. And I think you didn't show it explicitly on the ELF chart, but if people watching this can go plot the HVCs from ELF on each of the earnings gaps that you show in the chart, it's amazing how it, you know, retested those levels, found support, and kept going. I just think that's a really good example.
Yeah, it's kind of I mean, it's fairly simplistic, but it's kind of a hidden level. Some people know about it and use it. Other people don't use it. But all you're doing is saying, just draw that line and let's see what the action is around the line. And you say, well, why that line? Well, because that's institutional activity. And we've talked to that, you know, quite a bit.
Yeah, I like simple. It keeps things easy. So perfect.
Yeah, right.
Yeah, and John, I know you guys have done extensive work on this study. Where can people learn more if they'd like to, if they want to dive deeper and investigate all the different strategies that you guys investigated?
Yeah, I mean, you can reach out to me on this email and this slide if you want. If you're interested in earnings gaps, some more information, you'll see at the bottom here, support@rainkinginsights.com. You can inquire about earnings gaps, as well as I am going to be launching my new website in July. So if you have any interest in that particular product, just send me a note and we'll get you some information as we get close to launch, and you can check it out and see if it's for you. It's essentially a educational product. It's geared towards people. There's 3 levels. It's geared towards people with 0 to 2 years experience, and there's a level between 3 and 8 years experience, and there's a more advanced level with people with 8 to 10 years plus. So there's a lot for everybody in there, and hopefully we try to provide a lot of coaching to help people improve their trading.
Excellent. And just to close things out, John, do you kind of have any advice or words of wisdom that you'd like to share with everybody watching to kind of close it out? Could be earnings gap related, but also just trading at large, especially considering your expertise trading while also working full time. I think you might have some valuable insight there.
Yeah, I would just emphasize that trading earnings gaps can be very intimidating. But I do think it's important as a growth stock trader to develop a strategy for your toolbox, whether that's buying pre-market or buying the day of or buying post-gap, or I do think it's something you need to have in your toolbox. So that's a key thing. Don't be afraid to say, well, I just can't trade earnings gaps. Try to be open to learning more. And if you learn more about it, like this presentation shows, it's trying to help you build some confidence to do it in a kind of a risk-oriented way.
Excellent. Well, I think that's a perfect place to end it. Thank you very much, John, for your time and for putting this presentation together. Love the graphics, especially all the chart annotations. There's a lot of depth there that, you know, definitely rewatching this back, I'll be taking more notes on. So thank you very much for your time. For everybody watching, I hope you guys enjoyed as well. Make sure to thank John in the chat. Leave a like down below, subscribe to the channel, and we'll be right back with the next presenter. Cheers. Okay, everybody, we did it. We completed day 1 of the 2024 trading conference. Thank you guys so much for sticking with us. I hope you guys got tremendous amounts of knowledge and enjoyed the previous presentations. Day 1 was fantastic. So thanks so much for tuning in. Here is the schedule for day 2. Some great presentations in store tomorrow. We've got Oliver Kell discussing swing trading from entry to exit, Jared Tendler discussing correcting damage from high expectations and perfectionism, Jeff Holden of SMB Capital discussing strategies for winning in trading. Then we've got, of course, our lunch break. Then we come back right back at 2 p.m. with Deepak Upal discussing risk management for consistent returns, Himanshu Sharma discussing visualizing relative strength with RRG charts, Brian Feraldi discussing the business growth cycle. It's great to get that perspective as well. And finally, we've got Stephen Goldstein discussing understanding and minimizing the performance gap in trading. So a great list again tomorrow of speakers. So make sure you guys tune in tomorrow. It'll be right here, and we'll be posting the link and sending out an email later today to make sure you guys know where to go. So again, definitely make sure if you enjoyed today to go ahead and tune in again tomorrow. We look forward to seeing you guys there. Also, just want to give you a quick reminder, if you want access to the slides from today, as well as other bonus resources, you can go ahead and scan the QR code and access the VIP right there. It's 100% free, and this allows you to enter special giveaways such as signed copies of Mark Minervini's books, as well as model books, classes, the Ultimate Trading Guide, podcast resources, so many great learning opportunities, 100% free over on the TraderLion.com site. The link to that will also be down below in the description. Lastly, again, just one last ask. If you did find value in today's conference, it's 100% free, but we do ask that you pay it forward and show your appreciation with a very small donation to St. Jude's, the charity that we're doing a fundraiser for. It's an amazing cause, and it's a great way to show your appreciation for access to these learning materials. So if you did find value, if you got at least one golden nugget today, just one, go ahead and donate. Even $1 is amazing. Just click that button down below the chat right now, and it would be great to see a ton of donations flooding in right now. So if you're even thinking about it, please go ahead and do that. Thank you so much in advance. And lastly, thank you guys all for tuning in once again. We really appreciate you guys coming here. Hopefully you enjoyed. Make sure you leave a like down below, subscribe to the channel, and we hope to see you guys right back here tomorrow for day 2 of the trading conference. So thank you guys again. Have a great rest of your evening, and we'll see you guys right back here tomorrow. So take care. Bye.